Good morning. It is 9 a.m. on Monday, February 14th. Happy Valentine's Day, everyone. This is Yahoo Finance Live. I'm Julie Hyman here with my partner in crime, Brian Sozzi, on this Monday morning. Let's take a look at what's going on with the futures here this morning. We've seen some bouncing around, which I'll get into in more detail in just a moment. Right now, we are seeing indications for a lower open. NASDAQ down 0.4%, leading the pack downward. The S&P and the Dow each off about 1/4 to 1/3 of 1%. This as the world braces for war. Markets, especially commodity markets, being whipsawed as U.S. and European governments try to convince Russia's Vladimir Putin not to invade Ukraine. We will have the very latest. Who's the pets.com of 2022? Why the crypto Super Bowl, with a rush of ads touting trading platforms and tax services aimed at crypto traders, is drawing parallels with the dot-com era. And burning rubber. After a 27% tumble on Friday, we'll tell you why one analyst says investors should take another look at shares of Goodyear. But first, we do want to start with what's going on with the Russia-Ukraine situation, really heating up over the weekend with a lot of telephone diplomacy, as well as the German Chancellor Olaf Scholz heading to Kiev to try to moderate the situation. He is due to go to Moscow tomorrow. And then this morning, the Russian Foreign Minister Sergei Lavrov proposing that Putin continue talks with the West. It seems, according to reporting, that Putin is open to those continued talks. So if you take a look inside the Yahoo Finance Interactive here this morning, just want to walk you through some of the market gyrations on all of this. First, S&P 500 futures. We had seen some negative trading overnight into this morning on concerns over the implications of all of this, and then a recovery here when we got those Lavrov headlines, though still in the red at this moment. And taking a look at some of the other reactions that we've been watching for in markets here this morning. Here's an index of Russian stocks. It is still down on an intraday basis, although you can see it's well up off the lows of the session as well. We're watching a host of different asset classes on all of this. Here's the dollar ruble. Dollar still trading lower now, actually trading lower versus the ruble, which is interesting. It was trading lower before, so that's not necessarily a change here. Here's another index of Russian stocks, and this here is down 8% on an intraday basis. There's also a way to track it here in the U.S., the RSX. This is the Ranak Vectors Russia ETF, which has been sort of a proxy here in the U.S. for everything that has been going on. If you look at it on a year-to-date basis, it is off by 13% on these increased tensions. And then we're seeing evidence of all of this across Europe as well. Here's the Deutsche Börse, the DAX. It is down by 5% for the year. It's down 2% in today's session. So even with those Lavrov headlines there, it's more of a blip on the screen. And then, of course, there is the commodity, and I'll run through these quickly here. There are a lot of implications and concerns about what all of this could mean for supply from Russia. Russia actually produces 1 out of every 10 barrels of oil used around the world, consumed around the world. So any concerns about disruption to supply is really creating some turmoil in those markets. Natural gas, ditto. Natural gas about 3.5% higher on the day. Russia also a wheat producer. So that's another commodity that we're watching. And finally, where are people going because of all of this? In part, we're seeing some of the metals rally, but also Russia palladium producer. So there just are a lot of different tendrils here, Brian Sozzi, when you're talking about this Russia situation.
There is a lot. And Julie, the market might be taking a little bit of a wait and see approach this morning, especially after that big downdraft on Friday. But Wall Street strategists, they're not waiting this one out to react. And I'm looking right at Morgan Stanley's Mike Wilson. Now, he's the most bearish strategist on Wall Street. He came out with a note this morning, Julie, just saying that the risk of a global recession could happen if a war ultimately unfolds. That increases the odds of what Wilson calls a polar vortex for the economy and earnings. Wilson never at loss for words in describing what could happen with stocks. So he's calling for a potential polar vortex for stocks in the economy if there is, in fact, a war. What does that essentially mean? Basically, that economies globally, they slip into recession with a spike in energy prices, like you just mentioned. And all this comes against the backdrop, of course, Julie, where inflation is already high. So the market very much right now is in a bit of a pickle.
Seems so, doesn't it? And then there's inflation to throw into the mix also, so there's a lot to consider there. Let's talk more about the Russia-Ukraine implications. Let's bring in David Towle. He's ProChain Capital president is joining us this morning to talk about all of this. So, David, as we are watching the Russia-Ukraine situation, the sort of back and forth attempts at diplomacy here, it seemed like the market was mostly sort of putting it to the side, but it seems to come back to the fore. How much of a concern is it for you, and do you think more broadly for the markets?
I think it's a major concern. I don't think we're going to war anytime soon. I think Russia is going to want to go ahead and essentially dance along with us. And I think there is the point where we might have to get used to a protracted period of time where we have uncertainty around Russia, around Ukraine, around a lot of commodities for those reasons. Much like COVID, we may have to go ahead and live with this for an extended period of time. That will not be taken well by the markets in the short term, but I think over the long term, we will go ahead and digest that and be able to go ahead and move on.
But David, does this warrant? You just heard Mike Wilson over at Morgan Stanley suggesting that we could get a polar vortex for stocks. Let's say, I know you're not looking for war, but if it happens, how should investors be thinking about the market's next move?
I don't think we're going to go ahead and slip into recession. I think if we go to war, I think the Fed's plans will immediately change. And I think the government, the presidential arm of the government, their plans will immediately change as well. And they will get support from the legislative branch as well. So frankly, I don't think that everybody's going to go ahead and stand still while we go ahead and go to war and potentially slip into a recession. I appreciate the fact that oil might go higher, but at the same time, again, they're only one of every 10 barrels. And do we have the capacity to go ahead and turn things on a little bit here in this country while we're waiting for the prices of oil to go ahead and normalize a little bit more? We do. Certainly, it conflicts with our current policies of being much more environmentally focused. But I think for a period of time, we go ahead and wait that out. And I don't think it'll be, a straw that breaks a camel's back.
And so if this sort of back and forth goes on for quite some time, and it doesn't seem, even if this particular situation is de-escalated, Vladimir Putin doesn't appear to be going anywhere, right? So is this just sort of a risk that markets have to price in over the long term?
I think so. I think the way Vladimir Putin thinks about this is in terms of eras, not in terms of election cycles in the United States. And that's the way we think, right? We've got an election cycle essentially every 2 years. And so therefore, Putin is saying, look, if I can't get what I want today with agreement or capitulation from the United States, I'll go ahead and wait. And there'll eventually be an administration that essentially will give me what it is that I want if there's an appropriate quid pro quo. So that's why I think we're probably not going to war anytime soon. But this is a set of circumstances that we're going to have to go ahead and live with. And as with all new circumstances, the market initially reacts a little bit violently, but after a period of time, fundamentals go ahead and take over, and we will go ahead and frankly move on. And so the bottom line for me is, to the extent that the market pulls back here, I totally disagree with Morgan Stanley that we're going into a recession. We're going to have some polar vortex. I think it's a buying opportunity to the extent that that the market goes down heavily in the hopes that, in the expectation, frankly, that it will go ahead and rebound after matters normalize.
But do you think, David, that this is the type of situation, of course, it's still developing, that makes the Federal Reserve back off from a potential 50 basis point hike in March?
I don't know if they're going to back off from that hike in particular. They may come out with that hike and then say something about future hikes. I think the Fed needs some credibility at this point. I do disagree with the Fed on a very hawkish move to go higher. I don't understand what the pressing need is to raise interest rates. I actually think they're going to hurt the economy as opposed to cool inflation. I think inflation is more driven by the fact that there was a ton of money that went into the system, during COVID. That has now stopped, and we've got supply chain issues that are a mile long that will eventually work themselves out over time. And I think those things are going to go ahead and cure inflation more than if the Fed goes ahead and raises rates. As a matter of fact, raising rates too fast may be the thing that goes ahead and puts this country into a recession. So I think that they will go ahead, do that 50 basis points unless there's something incredibly urgent that pulls them back. But I think after that, there will be some language about the fact that they're in somewhat of a wait and see approach now.
David, good to talk to you this morning. David Towle is ProChain Capital president. Thanks for joining us. Well, coming up next, stocks get no love on this Valentine's Day as we see the futures pull back, although not a big pullback here this morning. We'll have more on what's next for markets and focus in on the inflation situation as well after the break.
Fed's response to red-hot inflation and rising tensions between Russia and the U.S. are two not-so-small factors on the plates of traders right now. Let's welcome in Hamrick Berg CIO Stephanie Lang to get a sense on how to play all this. Stephanie, good morning to you. The reality is that investors should probably just go more defensive. There are a lot of risks out there, of course, Ukraine and Russia. You also have, we're also looking at a potential rate hike of some sort in a couple weeks. How do you play it?
Well, that's exactly right. We've come off an incredibly strong couple years with a massive fiscal and monetary stimulus. Now we have a lot of that off the table, so you don't have those tailwinds. You're moving into a weaker economic backdrop. You have the Fed that is supposed to raise rates 6 times this year with quantitative tightening on the back end. So what are investors to do? I think they need to play into this volatility, meaning how do you position to win in this environment? You need to be with those names that will have some, protection in that downdraft. So as you mentioned, those defensive names are a good place to be. One being the dividend growth stocks. So those are companies that can grow their earnings over time, be defensive in those down markets. And in contrast to those tech names, they're shorter duration. So you can really have that return on a year-to-year basis, not waiting for those earnings in the long time. So I think, to your point, it's very volatile. It's going to be all about inflation and what the Fed does. But if you want to position correctly, you got to take that defensive stance at this point.
Stephanie, to take a step back for a minute before we dig into more of how to strategize, I'm curious what level of confidence you have in the Fed here engineering a soft landing, particularly when we get somebody like James Bullard, who in an interview with CNBC this morning talked about the interest rate increases being sort of front loaded in the year, that they go big and go hard to begin with, and then maybe soften as the year goes on.
Well, Bullard is one of the most hawkish Fed members. And I think that if you look at what's been going on, so the Fed hasn't really done anything at this point. It's all been telegraphed. They are still buying bonds. There is still quantitative easing going on. And you've already seen a huge run up in rates. I mean, if you look at just the 2-year Treasury, you've gone from roughly 0.11 in the last year to 0.9 a couple months ago to 1.5. That is a massive move. You've also seen globally rates go up quite a bit. 14 trillion in negative debt in the last 6 weeks. That's gone down to 4 trillion. So without even the first rate hike, you've seen massive moves, and that really is already playing into the tightening that's going on. So I think we don't want to get ahead of ourselves. I know a lot, including Bullard, are calling for a 50 basis point rate hike, for faster rate hikes. And I think we have to wait for this to play out. We don't want to surprise not only the market, but a lot of these things are self-fulfilling. So if investors and consumers get concerned that this is going to be self-fulfilling and we could go into a recession quicker. So I think it's very fragile ground right now, but I think the Fed needs to play out with what they had planned. And, it might be a little quicker than the Fed dot plot, but I think that's adequate to slow demand when we're already going into an environment where really it's a naturally slowing environment from what we've seen in the last couple of years.
As someone managing money, though, do you have confidence that the Federal Reserve gets this thing right?
Well, it's tricky. And I think, if you look at what history says, a lot of times the Fed has, created a policy mistake, which leads us into recession. But I know that Powell and the rest of the Fed is acutely aware of that. So that's why they're going to be very measured in their rate hikes. And they're also, we called it the Powell put in the past. And while they're not supposed to be reactionary to the stock market environment, the fact of the matter is they have been. And if they see that the market is really reacting to their action and the market is, forward looking, they are going to react to that. So I feel that it's going to be tricky, but I think they're acutely aware of history and how that, movements too fast can cause a recession. So I think that they're going to be very orchestrated and measured, even though you have some hawkish players like Bullard calling for more.
You mentioned, Stephanie, that you really like dividend payers. How do you find some of these companies? If an investor is at home right now, really scared out of their wits on what might happen to the markets next, how do they screen for names like this?
So, first of all, the dividend payers are going to have strong earnings growth. So you're going to see them consistently growing their earnings over time. Then you can also screen for who has consistently raised their dividends year after year. And these are going to be quality names, as I mentioned. There are certain ETFs that, play into those themes, so you can tack it that way, or you can go for the individual names. But as I mentioned, what I like about these names is that they are, tend to be stalwart in their sectors. They tend to be steady growers, and especially in a slower growing, not only economic environment, but earnings environment, that these companies tend to go well. So if you lean into these quality names, as the market is volatile and we expect to see, really slower growth in the stock market, you really need to protect on the downside. And if you look at certain periods and you pick out these names, whether individual names or ETFs, they tend to, when these big risk-off periods, you're going to see them lose less. An environment where we expect to see a lot of that, that's going to be a winning game, in our opinion.
Good tips. Hamrick Berg, CIO, Stephanie Lang, always good to see you. Have a great rest of the week. All right, Cisco could be on the hunt again, this time eyeing a potential $20 billion purchase. More on this one coming up.
This is Yahoo Finance Live. We're looking at futures this morning that are showing a bit of a dip here ahead of the opening bell. And we are seeing not the lows of the session, actually kind of creeping back towards little changed here at this point, Brian Sozzi. So we'll see how things look when we open up. Let's take a look at some individual movers, though. And this is a situation that you were watching over the weekend. Cisco, which of course is a company that's been acquisitive, maybe acquisitive again. There was a report over the weekend that the company had been in talks with Splunk and that they didn't agree to buy each other. The talks probably aren't even going on anymore, but it's enough to send those Splunk shares 7% higher, Saz.
Yeah, both Cisco and Splunk declined to comment to Yahoo Finance on these deal talks. But to me, Julie, it makes absolute sense. I've been covering Cisco for some time, going back to when our friend John Chambers was running the company. Cisco has acquisitions in their DNA. That's what they do. The modern day Cisco has been built through acquisitions, many of which were undertaken by Chambers, and that philosophy has continued under the CEO who picked to lead or just follow him as a successor. Of course, that's Chuck Robbins now. And I went back to look at some comments from Cisco's Investor Day, Julie, in September of last year. And they really made a case to Wall Street then that they want to be seen as more of a software maker, and they want to fetch more of a software maker type valuation multiple in the market instead of being known for lower margin routers and switchers. And buying Splunk would go a long way to helping them achieve that mission. And also, let's keep in mind too, Splunk is essentially flying rudderless right now. They have no CEO. They have an interim executive running the company. CEO Doug Merritt left a couple months ago because of a poor set of quarters from him.
I've been looking at some of the analyst commentary this morning, Saz, and most of them say that Cisco would have to pay more than the reported upon price of $20 billion because Silver Lake has an investment in Splunk, and that private equity firm could potentially push that price higher to try and get a higher valuation. That said, analysts also seem to think it's probably a good idea for Cisco to make an acquisition like this. And the folks over at Jefferies, for example, said that the deal could generate a lot of potential synergies. At the same time, it would be a long and complex integration that could leave it open to some competition. Over Piper Sandler, they're saying Splunk is the most strategic company that Cisco could purchase. So even if it's not happening now, that it's doesn't seem to be off the table. And I know you've been talking to folks about where Cisco is going to go from here as well.
Yeah, and let's also keep in mind too, if this deal does in fact happen, and I suspect we're not going to get a lot of details on it when Cisco reports earnings later this week. They'll remain very focused on their earnings, what they did in the quarter, and their outlook. The street is by and large is looking for a decent quarter from Cisco when they report later this week, but it could have an impact on security players like a Cloudflare or a CrowdStrike because of Splunk's presence in the security market here too. So it could have ripple effects throughout many different industries.
Yes, it could indeed. There's another stock that we are watching this morning, and that is 3M, the company coming out with some tweaked guidance, if you will. The share's not much change here, but the company's forecast for the full year for earnings per share now $10.15 to $10.65. Sales predicted to rise 1% to 4%, or if you adjust for local currency, an increase of 2% to 5%. And I know this is a company that you've been watching closely. They've also been undergoing some sort of liability issues related to some earplugs that they designed for a U.S. military contract. There's been some lawsuits related to that. So that's sort of been an overhang on the company. So we'll see if we get any kind of commentary on the latest regarding that situation as well, Saz.
Yeah, I would say some mixed earnings guidance. The street was at about $10.35 a share for earnings, just looking on the Yahoo Finance site, seeing what analysts were looking for. So a little bit of mixed outlook for 3M, but does give the potential for upside. I imagine that upside would come if there's a little bit of easing in inflationary pressures at the company. Now, we just recently talked with CEO Mike Roman off of their earnings a couple weeks ago. Perhaps he is looking for a little bit of a cool down inflation at some point this year. But again, to your point, Julie, those liabilities with regards to the earplugs and some chemicals that they use in some products here, they have not reserved for those liabilities or put cash away for any potential outcomes regarding lawsuits that are piling up. So it could be the fact that the street just takes a continued wait and see approach with 3M until some more clarity on those lawsuits come through.
Yes, and so we'll continue to watch that as well. And then finally this morning, we're watching Coinbase also. And this is because the company, I mean, it's sort of a funny story, but it's sort of a serious story as well. Coinbase had one of the probably most memorable ads of the Super Bowl, perhaps by being not very memorable, I don't know, or being sort of basic.
Oh, wait, I'm chasing. I'm holding my phone.
Here it is. This is the bouncing QR code that was on the screen during that 30-second spot. And if you went and scanned that barcode, what came up was a link to Coinbase's site and an offer if you were a new user that if you signed up, you would get $15 worth of Bitcoin. Now, apparently this, if it didn't quite crash the site, it certainly created issues for the site. And the chief product officer tweeted that it created more traffic than they'd ever encountered, and they had to throttle traffic for a few minutes before bringing it back to normal. Now, those Coinbase shares have been trading lower earlier. You could see when we showed them just a moment ago. Now they're just down by a little bit, but it's interesting here that it shows perhaps both the interest in and limitations of some of these crypto trading platforms.
Well, Julie, I just held my phone up to that QR code. Actually took me to a sign-up page for Yahoo Finance Plus. No, I'm just absolutely kidding. But no, clever technology. If you're going to spend that amount of money on a Super Bowl ad, why not make it cool and fun? I think Coinbase did in fact nail what they were trying to achieve. But still, you would think a technology company would get technology right.
You would, but maybe they just underestimated the amount of interest. I mean, to me, this speaks to the bigger issue of, and I know we're going to talk more about this coming up later in the show, but sort of where we are in the crypto cycle, if you will. A lot of people calling this the crypto Super Bowl because there were so many, not just ads that were for crypto trading platforms, but also a lot of mentions of crypto in ads for other stuff, which was kind of interesting as well. So it raises the question of where we are in that cycle. But this morning, the big question we have to ask is what is going to happen in the Russia-Ukraine situation? What is going to happen with how aggressive the Fed is going to be to combat inflation? And what does all that mean for stocks? This morning, it means a little bit of a dip as we head towards the opening bell. Energy Vault reading the opening bell as that company debuts on this Monday morning. And as we watch that little bit of a pullback in stocks, it does, as we talked about at the top of the show, it seems like that the Russian invasion of Ukraine, if it indeed is going to happen, is not imminent in the next, say, 24 hours after Russian Foreign Minister Sergei Lavrov seems to have put forth a proposal for Vladimir Putin to keep talking with Western diplomats and representatives to try to stave off a conflict, and Putin agreed to do so. All of that said, stocks are trading a little bit lower here to kick things off. Jared Blickery is watching all of the action for us on this Monday morning. Good morning, Jared. What's standing out to you this morning?
Good morning. I'm just watching the price action in the S&P 500, and let's go to the Wi-Fi Interactive. Pretty inauspicious start to the week right now. Actually, not a lot of action that I'm seeing. We have the majors down just a few basis points, so I'm going to call that break even. But let's check out a longer-term chart of the S&P 500. This is a year-to-date. And I've been watching this range in here, 4,600 to the upside, and we actually broke, I think this is 4,450, something in there. And this could be a false breakdown, but if we sell off anywhere short of 44.50, cannot reclaim that by the close, probably going to head down and test these lows here. So really got to watch out for that today. We're also seeing volatility pick up a little bit. We're seeing the VIX by about 30. It spiked up a little bit more than current levels right now. And also the 10-year T-note yield calming down a little bit. We continue to have bouts of volatility in the bond market that just kind of spills over into the equities market. So here's the US dollar index. That's creeping higher again. And we got to check out crude oil. Now, for all the consternation about what's going on with Russia and the Ukraine, crude oil has been marching higher. You can see it made a new nominal high, but really not a lot of action if the geopolitical concerns, are justified. So maybe take that with a grain of salt. A lot of times these kind of conflicts will weigh on equities in the very short term, but over the long term, it's usually just a blip. So we'll have to see what comes of this. Of course, OPEC coming into this situation as well, with Russia being a swing producer as a part of OPEC+. But you can see energy today, is the biggest laggard. That's down about 1.5%. But year to date, let's just check this out and remind us what the leading sector is. That is up 25%. So still holding on to some nice gains there. Utilities in the forefront here. Utilities has been a leader when when the bond yields retreat. So we're seeing that again today. And also industrial, staples, financials, real estate, materials, all of those outperforming, but really just not a lot of action here. If we just take a quick look at the NASDAQ 100 heat map, mega caps under pressure, but nothing off by more than 1%. And really just kind of a mixed day so far. We'll have to see what comes of it.
Jared, I was with all these crypto ads in the Super Bowl. I was thinking Bitcoin would skyrocket. Not really seeing that.
No, and I'll tell you what. When Crypto.com bought the licensing for the name of the Staples Center, I think that was a major tell that that could be an interim high. Now, if we go to the Wi-Fi Interactive, I'm going to pull up the Bitcoin chart here, and it's in a short-term uptrend. This is a year-to-date view. I'm going to put some candlesticks here to see a little bit more granularity, but so still in a short-term uptrend. It'd be nice to see this continue, but really need more of an institutional buy catalyst to propel the market higher. I haven't really seen the institutional flows like we saw in the beginning of 2021. Those just kind of petered out. I think the reason why Bitcoin made this new nominal high to almost 70,000 and then just quickly retreated was because we didn't have that support. Now, what could garner that support? Lower prices, perhaps. I've been saying that a washout to 20,000 or below would really attract that kind of institutional flows, as all of Wall Street really has to build up their crypto portfolio. But nevertheless, things looking a little bit greener here to the upside, especially on these short-term charts, Brian.
Interesting stuff. Obviously, also Bitcoin kind of interest rate and inflation expectation reactive as of late as well. Jared, thanks so much. We'll catch up with you a little bit later. For now, though, we are going to take a quick break, and when we come back, speaking of inflation, we're going to talk more about that issue and the history of it and what that means for where we are right now. Yahoo Finance editor-in-chief Andy Serwer wrote about that topic in his weekend column. We'll talk to him next.
You sign first.
No king! Gentlemen, have you taken leave of your senses?
The people shall have the right to vote.
Even the stupid ones?
Yes.
Stupid people vote?
Yes.
That was the ad for FTX, one of the crypto trading platforms that had advertisements during the Super Bowl last night. That one, of course, starring Larry David, and he's skeptical of crypto as well. So the implication being, well, he doesn't know what he's talking about. Paul Su is joining us now. He's CEO and founder of Decasonic, which is a crypto venture capital fund. And I do want to talk about what you guys are getting into, talk about Web3 and the metaverse. But first, I do want to talk about the Super Bowl. And that's because there were so many crypto ads, Paul. If 2022 is analogous to 2000, what's the pets.com from the ads that we saw last night?
A lot of memorable ads last night. It was quite enjoyable. All these ads give me a lot of optimism for crypto adoption. Makes me bullish for a lot of the builders that are building in blockchain. With Coinbase, Meta, FTX ads, this year's game was the Crypto Bowl. Many of you will remember the QR codes and Larry David. I have my QR code up there today too. By comparison, the Super Bowl in 2000 was called the .com Bowl when internet companies took up 1 in 5 Super Bowl ads. We all remember that Pets.com sock puppet and the E-Trade baby. If history rhymes again, longer term, we could see crypto as mainstream as the internet today.
But Paul, you're focusing just on the positive part of those parallels, if I may say. That was also the peak at that point, right? Yes, we've had another peak now, but that was then the peak. And there are a lot of players, including Pets.com, that didn't survive. So where are we in terms of the parallels in that way for the crypto cycle? Are there a lot of players that are not going to make it?
We're long-term investors, early stage crypto native venture fund, investing in building blockchain innovations for the mainstream. From our perspective, it might be a bear market for traders, but it's a bull market for builders. We invest in top-tier founders. We call them outlier founders. They're optimistic. They're building use cases for the blockchain. My quick background is in building these long-term technologies. I've been building, scaling, and investing in blockchain since 2013. Earlier in my career, I was a Silicon Valley VC. And then I became a product executive at Zynga, where we built games like Farmville for the mainstream. In 2018, I founded Decasonic. And what we're seeing is that these founders are building use cases for the blockchain to solve real pain points. They have this optimism to make the internet work better for everyone.
Paul, your QR code is not bouncing around the screen. Feel free to hit that button and get it popping. It's okay. We're just live and everything. But
I'm not giving away free Bitcoin.
Okay, fair enough. I'll try to scan it before we say goodbye to you. Talk to us on how you view Web3. There are a lot of definitions out there for this, but how do you see it as a veteran in the space?
Web3 is the next generation internet. It upgrades the key bugs that exist in the internet that you and I use every day. A lot of people in crypto call that Web 2. I believe Web 3 is the biggest opportunity of our lifetime. Web 3 gives us a clean slate to do things better, especially for people who are less fortunate. A use case is around seamless banking services, especially borrowing money instead of payday loans if you're poor. Another use case is streamlined digital money transfers, especially sending money overseas if, instead of Western Union, if you're an immigrant. And then lastly, another use case is freedom to build wealth, especially selling art NFTs instead of art galleries if you're a graphic designer.
Paul, there is so much sort of idealism baked into what you're saying and what a lot of people, how they view Web3, right? But in practice, I know there have been some criticisms of how Web3 has evolved, that even though in theory it's supposed to be decentralized, power is still held in a few hands. and it has to sort of go through a limited number of pipes, if you will. How do you think that situation is going to play out? And will we see the actual promise being fulfilled of that decentralization?
With any early technology, there are always skeptics, and a lot of those concerns are valid. We're still developing this technology as adoption's taking place. Blockchain today is the internet in 2000. We're really this early. Today, there are about 28 million crypto users in the US, about 1 in every 11 people. Overall, crypto is exploding a lot faster, 300 million crypto users across the world, in Africa and Southeast Asia. These are where the use cases are growing faster. This is very similar to internet adoption in 2000. But what we're seeing today is blockchain adoption is growing faster.
Paul, is the metaverse overhyped?
I love the metaverse. There is a lot of hype around it. For builders like us, we think of Web3 as the bridge between blockchain and the metaverse. That the promise of the metaverse as a immersive internet experience that blends the online with offline with meaningful connections is something that gets a lot of us technologists excited. A lot of young kids already experience the metaverse today, Minecraft, Snapchat, and Roblox. In the business world, you might have experienced it as well. You might have attended a virtual conference that allowed you to create avatars of yourself, join immersive breakout rooms, and engage with sponsors with virtual swag. By 2026, Gartner forecasts that 1 in 4 people will spend at least an hour a day in the metaverse for work and play. So, we're still very early with the metaverse.
As I was just saying to the team, my kids already spend an hour a day in the metaverse, so I can easily see that future. Paul Hsu, thank you so much for being here, CEO and founder of Decasonic, giving us some perspective on these big Web3 metaverse ideas. We're going to take a break right now. When we come back, last week's inflation numbers came in red hot. We're going to talk about the history of inflation and what that means for what comes next. Yahoo Finance editor-in-chief Andy Searle will join us.
Red hot inflation is far from a new thing, even if it feels like it is right now. Yahoo Finance editor-in-chief Andy Sower wrote about this in his latest column and joins us now. Andy, good morning to you. Take us down memory lane a bit.
Well, I started off, Brian, with this fact that, okay, if this is the highest inflation number in 40 years, and you're not really old enough to remember something like this until, say, you're 10, that means that no one really under the age of 50 remembers inflation in the United States. And that means that basically like 2/3 of America has no idea what's going on right now. And I am old enough to remember. I am one of those people who can remember inflation. And I remember, my parents sort of teaching me to look at the cans and see the prices, and they were going up. And a lot of things happened back then that changed. I mean, it was very difficult. Money market accounts were sky high. Mortgages were, 12, 14%. It was crazy. And it kind of informed almost everything that was happening, not only in the economy and the stock market, but in terms of our society and what was going on around us, certainly in the retail sector as well.
And so given that experience, Andy, you talk a little bit about how when inflation went from something like 14% to 7%, it was actually a relief, even though for us, that 7.5% print was very, very hot. So how should we be thinking about inflation today, given that historical perspective?
Yeah, economic cycles, Julie, are funny because they're always exactly the same and always completely different, right? And if you look at inflation back in the 1970s and 1980s, it was caused basically by two things. One is the Vietnam War and President Johnson's spending on programs, social programs and government programs. And number two, the oil shock. Shocks, plural, one in 1973 with the OPEC embargo after the Yom Kippur War, and then in the Iranian Revolution in the wake of that in 1979. Today, of course, driven primarily by very different things, which is to say COVID and the government response. Again, similarity there with the government response. Government spending, a big, big thing in both instances. And then, of course, this time around, I would say there are other factors as well. The decline of globalism is another one. And then also the switch to green energy. You may be all for that, but you could argue that that's inflationary as well. So the Fed has to use those traditional tools of raising rates. And we all know that Paul Volcker finally was able to curb inflation during the Reagan administration after 1980, but it was very painful and it caused a sharp recession. We're nowhere near those double-digit rates yet, but if we get there, there could be pain.
Yeah, Andy, I was just searching really quickly. Interest rates when I was born, they were around 19%. So definitely a different situation than right now. But you do write at the bottom of your column that for some companies, this could be some very opportunistic. Companies could take advantage of this inflationary environment.
Yeah, I mean, I was being slightly tongue-in-cheek, Brian, but not really. I mean, it was sort of Newtonian physics, I was saying, right? That every action produces an equal and opposite reaction. So in other words, if there's going to be this hyperinflation or even strong inflation right now, then, there are going to be businesses and entrepreneurs that take advantage of it. And I pointed out that last time around, back in the 70s and 80s, you saw the rise of store brands and generics, the rise of dollar stores, and it really helped Walmart and other discounters get tremendous momentum back then. Because before that, people would just buy, the regular brands and not blink an eye. But then when prices started to go up, they started to really compare when they were shopping and looking for value. So I think you're going to see a whole lot of business models and entrepreneurs take advantage of these things if it persists. And we could be looking at a whole bunch of new companies and business models that come out of this.
All right, we'll leave it there. Yahoo Finance editor-in-chief Andy Sower, good to see you. We'll talk to you soon. All right, earnings season is winding down, and clearly many companies are cautious right now, as our Yahoo Finance stat of the day shows. 151 companies from the S&P 500 gave first quarter guidance, and 52% guided below analyst estimates, says Goldman Sachs. All right, coming up, shares of Goodyear are trying to rally back a bit after one Wall Street firm says the recent sell-off on Friday was a gross overreaction. We'll be right back.
Shares of Goodyear Tire and Rubber plunged by 27% on Friday. They're coming back today with the help of an upgrade over from JP Morgan. Brian Sozzi, inflation, a problem for Goodyear like it is for many companies. But what's going on here? How should investors be thinking about this one?
Yeah, Julie, I hopped off my Peloton bike late on Friday, and I pulled up the ticker Goodyear Tire on Yahoo Finance. I'm like, what in the world happened here? I mean, this isn't a Meta or some other speculative company. This is Goodyear. They make tires. We all use their tires. So the reaction definitely surprised me to their earnings. But digging into the results over the weekend, a couple reasons I think why the street definitely did not like this quarter. It was more about the outlook than the quarter, I would say, for Goodyear. Company warned on break-even free cash flow for this year. That's really twofold. One, they are being hit by inflation in the first half of this year. They called out $700 million to $800 million inflationary hit just in the first half of this year compared to last year. And then secondarily, they're placing a lot of bets on the future of tire technology, investing a lot in tires specifically geared, no pun intended, for electric vehicles. So that's also impacting that cash flow outlook. The street was expecting them to produce a good bit of free cash flow this year and use that to pay down debt that they have in their balance sheet. Also, of course, I just mentioned inflation is a problem and concerns on pricing power by Wall Street. There were some chatter. There was some chatter out there in the street. Can Goodyear push through enough price increases this year to offset the inflation they are in fact seeing? But today, you're seeing some analysts come out here and defend Goodyear. First up is JP Morgan, Julie. They're saying that Goodyear could see a recovery in global tire shipments this year. Commercial truck orders are still strong. That is something that Goodyear highlighted on their earnings call on Friday. Cost cuts. This is a very efficient company. JP Morgan thinks cost cuts could be a factor in here in helping them alleviate inflationary pressures. And then Goodyear, at least according to JP Morgan, they say that they do in fact have pricing power. JPM, they lifted their rating to overweight, which is equivalent of buy from a neutral here this morning. But overall, Julie, my take is this. Goodyear is an impressive company. I spent the day with CEO Rich Kramer a couple months ago out in their Ohio headquarters. This company really knows what they're doing. They're leading on tire technology. They will have more probably opportunities to raise prices this year because what? If we blow a tire, we're going to try to drive around with two tires and the other two on some rims? Probably not. They can charge whatever they want on tires. We need tires. Secondarily, what they have in terms of the product pipeline coming out over the next decade is very, very impressive. I would be surprised if 10 years from now we are not using tires that don't even resemble anything that is on the road today except for the fact that they're round.
Other companies do make tires. I mean, you could see price competition between the tire makers, I suppose. In theory, you have more than one choice, right?
They're all raising prices. They're all raising prices. So the tide is lifting all boats, Julie. Lifting all boats. Or lifting all cars.
You're definitely not going to drive around on your rims. All right, we're going to take a break. Coming up in the next hour, Brian's going to have a conversation with AMD CEO Lisa Su. That's after the chipmaker closed on its multi-billion-dollar deal for Xilinx. She's going to talk about what that acquisition means for the company going forward. Keep it right here on Yahoo Finance Live.
Happy Valentine's Day. Welcome back to Yahoo Finance Live on this Monday morning. I'm Brian Sazi alongside Julie Hyman, and the Bears are in control a bit to start the week on those building tensions between the United States and Russia. Overseas markets are under a good deal of pressure, and that is extending somewhat or a little bit to U.S. shores, seeing some mixed action, but the Dow is down, now down more than 200 points. The S&P 500 slightly in the red, and the Nasdaq, look at that, going in the green so far here in the early going. Now, here are some other things we are watching for you at this moment. Enter downgrades. Goldman Sachs chief U.S. equity strategist David Kostin slashed his 2022 year-end S&P 500 target to 4,900 from 5,100. Kostin says, quote, uncertainty abounds regarding the path of inflation and Fed policy. And a done deal. Chip giant AMD has completed its $35 billion acquisition of Xilinx. We'll talk at length with AMD CEO Dr. Lisa Su about what the deal means to the future of her tech giant. And a new head of the trading floor. We catch up with the new president of the New York Stock Exchange, Lynn Martin, to get her insight into her plans for the 226-year-old institution. But first, over to Inez Ferre with the tour of the Wi-Fi Interactive. Inez.
And Brian, let's take a look this morning at where oil is at, particularly WTI and Brent crude futures. This is over, of course, the tensions between Russia and Ukraine. Russia's foreign minister giving some commentary earlier, signaling some possible diplomatic efforts. That's why you saw oil dip a bit earlier this morning. Right now, we're looking at Brent crude that's down about 0.1%. WTI is up just slightly, but these prices on Friday had hit 2014 levels as we saw oil surge over the escalating tensions between Russia and Ukraine. Taking a look also at where we're at with the travel stocks, because that signal of diplomacy could have also been sending the travel stocks higher this morning. We are looking at a little bit more of a mixed picture. These travel stocks had been a little bit higher earlier. We're looking at American Airlines up more than 1%. Some of the cruise liners are also higher, the hotels as well. Then we're also taking a look at the semiconductors following the latest monthly sales data for December. Deutsche Bank saying that that data was well above expectations, but below December seasonality. Also, you've got commentary from Morgan Stanley showing that the data shows supply constraints amid a robust year for 2022. Micron up more than 2% after receiving an upgrade at Wedbush Securities to outperform. And then just looking at some of the vaccine makers, these are under pressure. This morning, you've got Pfizer that's down more than 2%. We're also taking a look at Moderna down 9% this morning. Looking over at the sector action where we're at this morning, we are seeing consumer discretionary now, the only one in the green. We are headed lower right now. We've got energy, financials, and healthcare, which are lower. And looking at the mega caps, a mixed picture here. Brian, Julie?
All right, thanks so much, Inez. All right, two things we are sure of. First, the Rock's arms looked really enormous at the start of last night's Super Bowl. And two, the Fed is getting ready to raise interest rates likely in March. Let's stay on rates rather than the Rock's biceps. David Kotak is the co-founder and CIO of Cumberland Advisors and joins us now. David, always so nice to see you. How concerned are you that the Fed front loads these interest rate hikes, and what impact do you think that will have on the economy this year?
I hope they don't front load the Jim Bullard warning, which created a lot of turmoil in the market, is less likely, in my opinion, to happen. I believe the majority of the members of the Federal Open Market Committee know that moving policy should be like moving a battleship, not a speedboat. And so I don't expect front loading. My biggest concern, Brian, is the balance sheet shrinkage, because the Fed has only done that once and their record about it is poor. So I'm okay with 4 or 5 rate hikes, get the short-term interest rate up to 1%, let money markets start to clear, let people get away from the zero bound, let them earn something on savings. I think that would stabilize a lot of issues. It's the balance sheet shrinkage that is the unknown. And it's way out in the future, but it may come at us fast. I hope it doesn't.
Well, what's the risk that you're concerned about? Is it the speed of the shrinkage, how soon it's going to happen, and what are the sort of potential mistakes they could make when it comes to that shrinkage?
Well, there's the real cutting edge question, Julie, because nobody knows the shift in bond market duration as the Fed moves from taking balance sheet to neutral and then shrinking it. And this is interactive with the Treasury, since the Treasury is still issuing Treasury debt, which I believe Janet Yellen, as Treasurer of the United States or Secretary of the Treasury, and Jay Powell, who work together, are going to balance this so there's no instability in the financial system. The Treasury may raise the amount of bills versus notes and bonds as the Fed changes its holdings. So this is an integrated task. There's only been one case study of trying to do that and raise an interest rate at the same time, and it failed. Was enough learned from it? We're going to find that out. Remember this, though. If the Federal Reserve froze the balance sheet today, there would be pay downs on the mortgage portfolio, and there would be a basic shrinkage of need for balance sheet size at the rate of 15 or 20 billion every single month, just by virtue of the growth of the economy. So I believe the Fed knows not to shock the markets. Markets, by the way, want to talk about the shock, but I don't believe the Federal Reserve wants to put the US economy in a recession, and I don't believe it will shock the markets.
Well, the markets want to talk about the shock, potential shock, so to speak, and they want to price it in, right? Which is the process that we have been seeing play out in the markets as people try to price in those potential scenarios that you're talking about. So what do you think should be priced in at these levels? What do you think that stocks are where they should be right now, given those risks that you're talking about?
Well, the word should is always a dangerous one to use. You and I, over the years, have talked about that many times. So let me just put it this way. I believe when the books are closed on the earnings sequence we see now, the stock market is going to look and say, gee, the S&P 500 index for the fourth quarter earned over $55. For the third quarter, almost 54. All the forecasts for those quarterly earnings aggregates were $2 or $3 lower each and every time. And that has been the case for the last 6 quarters since the pandemic shock bottom. What changes to keep that trajectory from continuing to rise? Well, war, Ukraine, China, a massive Fed shock that we don't see that coming. So the alternative is 55 quarterly earnings will be 56 and 57. My number for the S&P at the end of 2022 is about 48, 4,900, 5,000 earnings trajectory, getting to about $60 for the quarterly run rate. That's pretty reasonable. So stock prices at 4,300, 4,400 on the S&P right now are attractive or reasonably priced.
Within that S&P 500 target, how much are you concerned about inflation sticking around for the balance of the year, or in other words, not decelerating?
Well, Brian, I know it's a dirty word to say transitory, but I think that in pandemic shock history, transitory happens. It's just a long, stretched out process. And for me, our best guess is the inflation rate comparisons are peaking right now, this quarter, this month, next month. And as we move through the year, they're going to roll over. When they roll over, maybe this market, or at least some of the people who are talking about it, will calm down a little bit. So if I had to have one message for investors, and in our firm, we're trying to practice it, It's calm down. Don't get so excited, because we are recovering from a massive pandemic shock, and the recovery trajectory has years to go.
You know what? That's actually some good advice from me. I'm going to calm down on this. I'll just take these earnings in stride, David. Very good words of wisdom from you as always. David Kotak, co-founder and CIO of Cumberland Advisors. We'll talk to you soon. All right, before we head to break, we have to keep an eye on shares of Coinbase. Shares are up about 3%, of course. They had that very buzzy Super Bowl ad yesterday, a dancing QR code on the screen, and then the website crashed. But very interesting to see that move higher after their big and buzzy Super Bowl ad. All right, coming up, electric truck maker Rivian has a high-profile new investor. More on that one straight ahead.
The Ambassador Bridge, that's the one at the center of the Canadian trucking protests, reopening late last night. The blockade lasted nearly a week. It started over COVID-19 mandates for truckers. The closure became problematic for trade as it's one of the busiest routes between the U.S. and Canada. Several automakers were forced to idle production. The big three U.S. automakers expect to resume normal operations today. Meantime, Lockheed Martin scrapping its deal to acquire Aerojet Rocketdyne over antitrust concerns. The Federal Trade Commission filed a lawsuit last month to block the deal, saying Lockheed would use control of the rocket engine maker to hurt rival defense contractors. The deal was valued at $4.4 billion. It's the second major acquisition to fall apart in recent weeks after NVIDIA and SoftBank called off their acquisition, NVIDIA's acquisition, that is, of ARM Holdings. And despite what the commercials say, and what they said last night during the Super Bowl, there won't be avocados from Mexico coming to the U.S., at least in the immediate future. The U.S. suspended imports over the weekend after a plant safety inspector was threatened. The region that has the only full authorization for U.S. exports is now a victim to drug cartel turf battles while it's peak sales season for avocados. The import ban not having an effect on Super Bowl consumption since those avocados obviously had already been shipped. But keep an eye on that avocado pricing going forward. It's not good. We eat a lot of avocados in my household, so not great. All right, let's talk about another story that we are watching today, and that is George Soros's management firm revealing in a 13F that it had taken a stake in Rivian, a $2 billion stake. And I was just looking at some data on the Bloomberg Saz, and it looks like according to that data, that makes Soros the 9th largest holder of Rivian shares. Interesting here.
This one, very interesting. But I do think it makes sense, Julie. It doesn't come out of left field, I would say. Obviously, George Soros in recent years has really been focused on fighting climate change, has made a lot of speeches on this, has donated a lot of money to that end in various ways. And of course, what is Rivian? Rivian is, in some respects, a play on eradicating climate change via electric vehicles.
Yeah, so you get that ESG tie in there, and you also get a stock that has been battered, right? And so potentially seeing Soros and company seeing an opportunity there. Speaking of a similar theme, there was also another interesting addition that was revealed in the 13F, and that of Peloton. $13.3 million there, much smaller little nibble there for Peloton, and one that's not really helping the shares this morning. They're still off by 4%. So, you know, that one not necessarily benefiting.
Yeah, I'm looking for the Soros climate change tie-in here with this Peloton investment. Unclear to me. Also unclear to me if he's a Peloton user, but maybe he is. That's good for him.
I'm skeptical. But that's okay. All right, we're going to take a break. Coming up, you're going to talk to AMD CEO Lisa Su. She'll discuss the multi-billion-dollar deal for Xilinx, which has just closed. We'll be right back.
Welcome back to Yahoo Finance Live on this Valentine's Day Monday. Seeing some mixed to slightly down action here on the major indices. The Dow was down more than 300 points just moments ago, but now down, well, there we go, down 300 points. The S&P 500 slightly in the red. NASDAQ still clinging onto gains. Staying on the markets, on January 3rd, Lynn Martin walked through the door of the New York Stock Exchange as the 68th president of the storied 226-year-old institution. Martin is credited with turning the NYC parent company's fixed income and data services business into a financial powerhouse. I sat down with Martin to get her thoughts on taking the top job and what she has planned for the NYSE.
Took a pretty unusual route, especially for a woman. So I became very passionate about two topics when I was in college. Number one was technology. I was a comp sci major, double major in math for a while. So I was a quant at heart, learned all about coding, techie by trade, spent a lot of time coding. In fact, one of my first jobs was with Con Ed, the New York City power company.
Okay.
Longest continuously listed NYSE company as well.
So it's fate you were here.
A little bit. But I also became really passionate in my math courses about financial mathematics. So that's what led me to get a master's in financial mathematics. It led me to an opportunity with the London Financial Futures Exchange, which became part of NYSE Group in 2007 when they acquired the Euronext organization. Fast forward a little bit, did a lot of interesting things, took a couple of markets electronic, started a US futures market, started a data business for Intercontinental Exchange called ICE Data Services, which is our single largest business unit. Spent about six and a half years setting that business up, turning it into our largest business unit, 6% cumulative annual growth, and then I was offered the opportunity to come back home.
How did you decide? You were at IBM too, right?
I was. That was my first job out of college. I spent 3.5 years there coding.
How'd you make that pivot or decide, you know what, I want to make this pivot and I want to get into finance?
Yeah, that's a great question. So in college, I was studying computers. Figure what better company to start my career at than IBM, another great New York Stock Exchange listed institution. It's kind of like the preeminent company you join when you learn how to code is IBM. But that hankering for financial markets, interest in financial institutions, and interest in the financial models that really underpinned the companies that I was consulting, the financial institutions that I was offering services to, I couldn't get it out of my head, which is what led me to get that master's degree and make the pivot to the listed derivatives markets.
There's a lot to talk to you about. I want to talk about the future of the New York Stock Exchange, but when you got the call that you were going to be, what, the 68th president of the New York Stock Exchange, what was that day like?
My God, it was a day that I'll obviously never forget, as I'm sure most of my predecessors would also classify it the same way. I was floored. I was asked to meet with my boss, Jeff Sprecher, CEO and chairman of ICE, and I thought we were going to talk about the future of fixed income markets and the data services business.
So you had no idea that was coming?
I had absolutely no idea. I was floored at the opportunity, mainly because I understood the gravity of what it meant to be a woman, to be asked to have that opportunity, and given the non-traditional background that I had. But I was incredibly excited at the opportunity. And one of the reasons I'm really excited for this opportunity is because I get to work with the innovators of tomorrow, the entrepreneurs, the technology-based companies, because every company really has a technology underpinning to help them tell their story and to help them innovate, and to join such an iconic community of disruptors and innovators and visionaries.
Is there something about the culture inside of ICE? You're following on the footsteps of Stacey Cunningham. How does that talent develop inside the company, where you are the second consecutive woman president of the New York Stock Exchange, not of a lot of these big companies? Can't say that.
Yeah, one of the things that I think gets underappreciated about ICE and about NYSE is we do two things incredibly well. Number one, we develop talent. We always look to bring folks up through the ranks and give them new opportunities, particularly if they're on one side of the business, to look after another side of the business. And number two is the value we place on diversity. Stacey being the first female president of the New York Stock Exchange in its storied history, me following in her footsteps, just appointing Sharon Bowen as the chair of the New York Stock Exchange, first female and first person of color.
Female takeover. This is great.
It's not a female takeover. I think what we do is we identify talent. We identify the right talent for the position at the time. And we are really supportive of continuing to develop that talent.
Well, this is great. It is great to see it. But okay, so you have the job, you're pumped up, you're excited. I'm sure you have a lot of things coming at you. What are some of your biggest priorities?
Yeah, I mean, a couple of things that are my biggest priorities. I would say number one, telling our ESG story. We just touched on it, but the way we think about sustainable finance is very different from some other folks in the market. We are not opinion-based. We are more about providing transparency on existing risks in the market that the market knows, the market understands, but more importantly, providing transparency for those emerging risks. Clearly, environmental, social, and governance risks are emerging, particularly as disclosures continue to evolve. So it's on the top of minds for CEOs around the globe as to how they tell their environmental, social, and governance stories, what they're thinking about, how they're dealing with these risks to their business, but then also how they manage risks within their own business. So in providing them tools and services to help them do that, incredibly important. Second is continuing to further tell our technology story. We have made a tremendous amount of investment in technology in this business.
I can see it. Look around the building. It's different than, well, it looks the same as when I remember, but still, there's technology in here.
There's a lot of technology, but importantly, the most tech-forward companies are ones that use technology coupled with human oversight, allowing you to get better outcomes much more efficiently. And I think given the business I ran previously, which did that, given the way our floor model works, our market model works, we're innovators there. We can help companies navigate this use of technology to improve efficiency, but also couple that with human oversight.
Speaking of technology, chip giant AMD has completed its $35 billion acquisition of Xilinx. We'll talk at length with AMD CEO Dr. Lisa Su about what the deal means to the future of her company. Stick around. A milestone day for AMD. The company has closed on its $35 billion deal for Xilinx. The acquisition is seen boosting AMD's efforts in computer processors used in data centers and wireless networks. Joining us now is AMD CEO Dr. Lisa Su. Lisa, always nice to see you. Congrats on closing this deal. It's been a long time coming. You originally announced it in October 2020. For investors not familiar with the company, what does this allow you to do?
Yeah, Brian, thank you so much for having us this morning. It's a very, very exciting day for us. I'm actually talking to you from the Xilinx campus. We're just about getting ready to welcome our new 5,000 wonderful employees. So, look, AMD has always been about high performance computing, and our vision of the world is that you need all types of computing to really serve customers and really think about what's next in the industry. So adding Xilinx is an incredible company. They've done extraordinarily well as a standalone company. Actually, both companies have done extremely well. But putting our two companies together is really a complementary set of markets, customers, and products. And so we're extremely excited about doing it. And as you said, it's been about 16 months, but we've been planning and we're absolutely ready to have a fast start on day one.
Lisa, what's going to be your message to those 5,000 Xilinx employees?
Well, I think our message is, again, two wonderful teams, two of the best teams in the industry coming together. 1 + 1 is going to be much greater than 3. And it really is, across, we're all about products, as you know, Brian. So building great products, ensuring that we continue to deepen our customer relationships across the board, and really, continue to build upon the great growth franchise that we have already built with AMD and Xilinx separately.
And to your point, you've had a lot of time, a lot of opportunity to plan out this integration. So now that the day is here, what are your first 3 top priorities here?
Well, there's a lot of excitement across our customer set as well as across the industry. And when we think about, the benefits of bringing the two companies together, again, for customers, it's about a much broader product portfolio, right? We now have CPUs, GPUs, FPGAs, adaptive SoCs, ASIC capability that can go across the most important markets in the world. So, the data center market, the strategic assets that we have for the data center market, the communications market, where Xilinx is extremely strong, and AMD has assets that can work in those areas. Industrial, automotive, all of these markets need this collection of capabilities that we have, and we're going to be able to offer that entire portfolio to our customers, as well as build some really amazing and innovative products.
When you have been able to talk to customers over the past 6 months and just going through this integration process, not the integration process, just the planning process, what are you hearing from your customers? And do you sense a big pickup in business now that you've closed this deal?
We do sense, Brian, a lot of excitement for what we can do as a combined company. And when you think about, some of our largest customers, the cloud customers, what they're looking at is, really, what do you need for the next 5+ years? We've had tremendous success across, these large customers with our, CPU portfolio and our GPU portfolio. I think adding Xilinx adds some strategic assets, things like networking technology, which is very important for the data center business, adaptive SoCs, AI. We're really excited about enhancing our AI capabilities as a joint company. Those are some of the things that we talk to customers about. And I think, really the sky's the limit in what we can do together. When you have such talented team. I mean, we'll have over 15,000 of the best engineers, in the semiconductor industry. So it's just an incredible team that we're bringing together.
I think maybe it was 24 months ago, Lisa, where you outlined, perhaps it was an investor day, outlined 20% compound annual growth rate for AMD. Now that was before Xilinx. How fast is your company growing now that the deal's done?
Well, we're looking forward to updating our financial model, Brian, in the coming month. But what I'll tell you is, this acquisition is accretive in the first year for gross margins, for earnings per share, for free cash flow. So it's a very good deal overall. And when we look at growth rates, what we said at the time of acquisition is that we felt we could grow significantly ahead of the industry, 20% plus CAGR for the next few years. And we still believe that that's the case. And we are going to update our financial model shortly. But overall, both from a financial standpoint, a technology standpoint, and a customer standpoint, we think there are a lot of positives for us as we come together.
What is the state of the market right now? And you play in so many different industries. Let's start on the PC market. The PC market had a tremendous period last year during the pandemic. What is your outlook for it this year?
Well, I think the PC market, as you said, had a tremendous year. I mean, last year in 2021, as an industry, we shipped approximately 350 million units, which was amazing. We still see very strong demand coming in here in 2022, especially when you look at commercial and high-end consumer. We do expect that some of the lower end or education type products may be a little bit softer, just given the strength in 2021. But overall, we see it as a strong year for PCs. And within that, we believe that AMD will perform very, very well, just given the strength of our product portfolio.
In the gaming console, you guys are a key player in all things gaming. Of course, looking right at that Sony PS5. When does that console cycle peak?
Well, when you look, again, if you look at the overall industry for consoles, first of all, this console cycle has been an amazing console cycle, very high demand, extremely strong products. What we see is that typically when you look at a console cycle, you would see the peak being sort of the year 4, or which would be next year. We expect consoles to grow this year. We expect to continue to increase supply because there's very strong demand out there in the market. And, the overall environment, for our products continues to be very favorable. So, whether you're talking about, AMD's core markets of PCs, gaming, or data center, or Xilinx core markets, I think both companies have grown extremely well. And we look forward to 2022 being a very strong growth year for us.
And of course, Lisa, a lot of these gaming companies are playing right in the middle of the metaverse, whatever that might mean to certain people. Or is the metaverse something that you are excited about, and how is AMD playing in it?
Yeah, I think, Brian, the metaverse is an opportunity. And, when I think about opportunities, I think about, which markets need high performance computing and, adaptive computing. And the metaverse is one of those. I see it as, sort of an extension of much of what we've been doing in the gaming world and really trying to bring more real-time capability. Again, you need CPUs, you need GPUs, you need adaptive SoCs in that market. We have a phenomenal IP portfolio, and we're working with some of the best customers or some of the most influential customers in the industry. So yes, I see it as a growth opportunity for us.
Well, speaking of growth too, since the last time we spoke, there's been a lot of inflation everywhere you look. Inflation, inflation, inflation. How concerned are you about just inflation in the global economy right now?
Yeah, I mean, Brian, I think we all watch those macroeconomic signals, and we want to ensure that we understand and are very agile in what comes out. I will say in the semiconductor industry, though, what we're seeing is just very strong demand, and I mean you've seen that across the semiconductor peers. I think what we're seeing is more than just market demand, but we're also seeing sort of strong preference for AMD products, and so we appreciate that. Much of what we've been doing over the last year and into the first half of this year is ensuring that we're ramping up supply so that we can continue to service all of that customer demand. And so that's part of the growth that we see. And there are some investments that are necessary so that we can support that. So we're very focused on ensuring that we're watching all of the global signals. But from what we see, it's a strong year for the semiconductor industry and a very, very strong year for the combination of AMD and Xilinx.
And the chip shortage, Lisa, is that likely to end at some point this year? Give us a target.
Well, I've always said, Brian, that there's tremendous investment that's happening across the semiconductor industry, whether you're talking about on the wafer side or on some of the substrates or the back end assets. So we are making progress. I do believe that the first half of this year will continue to be quite tight. But the second half of this year, I think things will get a little bit better. I think we're very focused on ensuring that we work with our customers. So we're now planning, multi-quarter, multi-year with our customers, which just makes for a much more efficient supply chain. And frankly, one of the benefits of being a larger company for the combined AMD plus Xilinx is, we also hope to use that scale to ensure that we get more than our fair share of capacity and support in the industry.
Lisa, I remember when you were first appointed CEO of AMD several years ago. Now, it feels like yesterday, but it's not. What is it like to pull the trigger on a deal that is the largest in this company's history? Have you had any time to reflect on it?
Well, I will say, Brian, it's a phenomenal feeling to be able to bring together such amazing teams. And as the largest deal in AMD's history, it's actually the largest deal in the semiconductor industry. I think there are lots of expectations. We hope to meet and exceed those expectations. But I will say that we have had a chance to spend a lot of time together. I've had a chance to spend a lot of time with Victor Peng. The CEO of Xilinx will now become president of our adaptive and embedded computing group. There's a phenomenal team that is coming over with the acquisition. The teams have great chemistry and culture, and together we're focused on innovations and product strength and serving our customers and making sure that we make the industry a better place. So yeah, it feels wonderful.
All right, well, good luck in front of your presentation, or your presentation to those 5,000 Xilinx employees. I know the road was long to get this deal closed. AMD CEO, Dr. Lisa Su, good to see you. We'll talk to you soon. All right, coming up, we'll look back at, of course, some more Super Bowl TV ads. What worked, what didn't work. Our next guest will weigh in. Stick around. Well, there were definitely some themes for the ads that we saw during the Super Bowl last night, including crypto being a running trend, as well as electric vehicles. A lot of talk about those. And then there's the idea that rates were up to pay for the ads, even though ratings have been down for the Super Bowl. Let's talk about all of these trends with Aaron Goldman. He is the Chief Marketing Officer over at MediaOcean. Aaron, thanks for being here. So what sort of stood out for you? And let's start on that last point, that the price for the ads is up, even though ratings is down. What do you make of that and what it tells us about the current
state of the advertising industry?
Yeah, well, at MediaOcean, over $200 billion in advertising are managed through our software on an annualized basis. And that's everything from television to TikTok. But the Super Bowl really stands alone in terms of audience reach and engagement. And that's why costs continue to go up each year, about 10%, looking at $5 to $6 million for just one 30-second spot. And as you mentioned, it's not like ratings are going up at the same pace. We don't have the numbers yet for yesterday's game, but last year was down about 10% in viewership over the prior year. So I think what you have is ultimately an element of scarcity. There's really nowhere else you can get 100 million people all watching the same thing at the same time. And they're tuned in for the ads as much as they are for the game. So for brands, there's really no better way to introduce a product or reintroduce yourself to the world and show what you stand for.
Why was Peyton Manning almost in every single commercial?
Yeah, you'll see it, whether it was athletes or celebrities, there's definitely an element of trying to bring some familiarity and ultimately some levity. Peyton has kind of built a nice brand for himself with his brother, Eli Manning, doing some of the Monday Night Football broadcasting. And across the board, we talked about the cost for the ads. That's just to place them on air. What about the cost for the talent? And when you take into account bringing in all the different folks that we saw yesterday, it really does add up. But again, it can be worth it. And I think for a lot of folks who are kind of, we're in year 2 of the pandemic here, looking for a little bit of an escape. And so you saw a lot of nods sort of to the future, electric cars, crypto, the metaverse, that futuristic flavor town with Guy Fieri for Bud Light Seltzer. But you also had some throwbacks, right? There was the Sopranos theme song reboot for Chevy, the cast of Austin Powers showing up for GM. And of course, the halftime show was taking it back to the old school with Dr. Dre and Snoop. And so it's really about kind of capturing people's imaginations and transporting you to a different time and place.
Whenever we watch the Super Bowl ads, to me, one of the perennial questions is, what is the return on investment? And so I'm curious what your view on that question is.
Yeah, it's a great question and an important one. I think if you think about it in isolation, if you've just bought 30 seconds and you're trying to understand, okay, what happened? What did I get in return for my dollars? There's only so much that you can actually tell. You could do things like what Coinbase did with their QR code that was sort of bouncing around the screen like a screensaver. And if you snap the QR code, it would take you to the app. That did so well that it actually crashed the app. So that's an example of being able to bring an element of direct response, and so you can move people immediately to action. But most of the ads are more focused on just general branding and awareness. And in a time like now where everything is so seemingly polarized, a lot of the brands are trying to do what we call virtue signaling, which is showing what they stand for, and whether it's corporate social responsibility or the environment. We saw a lot of ads focused on, as mentioned, electric vehicles. You had Matthew McConaughey saving the earth, I guess, for Salesforce. And so, snack brands, beer brands, they're ultimately kind of telling you what they stand for, and then hoping that you'll ultimately feel it in the gut. I suppose, no pun intended there.
Is there something particularly just special about the 1980s that so many big companies are trying to tap into that? I saw the return of Grimace. I haven't seen Grimace in over a decade over at McDonald's. He's been put buried 10 feet under. But when I think back to the 80s, I think about inflation, high interest rates, and the Cold War.
Yeah, but you also don't think about a global pandemic that's kept you at home for the last couple of years. And so that, again, that escapism, whether it's past or future, tends to play well. And especially as you think about the shelf life for these ads, again, it's not just the 30 seconds during the game itself. The ads run before, they'll run for a long time after. For a lot of these brands, this is just kicking off of a campaign that'll run throughout the entire year. And so with that continued repetition, you'll continue to be able to see more of that engagement, but then also back to the point about getting your money's worth as an advertiser, you'll see that kind of compound over time.
And so, Aaron, 2 final questions, and it's a 2-pronged question, I guess. What was your favorite ad, and what ad do you think was most effective, which I guess are not necessarily the same thing?
Yeah, well, actually, in this case, I think it was both, and it's that Coinbase ad. There's just something about as you're going through and watching the commercials and seeing, all the great comedy and talent, and then to have this sort of throwback where it's just the QR code, some music bouncing around the screen. It really stops and it makes you take notice. And then in terms of being effective, as mentioned, crashed the app. There were so many people that snapped the picture and then went to it. And so I think that's something that a lot of people are going to remember for a long time. And then ultimately the offer was $15 in Bitcoin, and that's nothing to sneeze at.
Who knows what that $15 could be worth 10 years from now? You never can tell. Aaron, thanks so much for being here. Appreciate it. And by the way, those Coinbase shares are higher after falling earlier. Aaron Goldman, CMO of Mediaocean. Coming up next, we're going to get another check on stocks and tell you what is moving right now. We actually have seen more of a dip for the Dow, even as the NASDAQ has recovered. We'll be right back.
Welcome back to Yahoo Finance Live. And Julia, keep an eye on shares of Peloton here. Looking at a story in the FT where the new CEO, Barry McCarthy, really shooting down any notion that a sale of Peloton is imminent. And I can't say that I'm surprised seeing Peloton shares down there about 4%. I can't say that I'm surprised to hear this. They're not going to bring in, that is Peloton, an executive of McCarthy's stature to sell the company overnight. So I see where he's coming from. And then secondarily, McCarthy's entering, in many respects, a large ship with a lot of holes in it. So it's his job to plug those holes and potentially, maybe, then Peloton gets sold.
Right. This is a longer term play, at least according to him. I mean, you know, I think it's also fair to say that it would be an unlikely scenario if he came in and said, I'm preparing this company for sale, right? Like, he can't really say that, even if it were the case.
FT, we're for sale. Here we go.
Right. Yeah, no. So, of course, he's going to say that he's focusing on the long term. It would be highly unusual for an executive to come in and say otherwise, unless perhaps it was, for example, private equity buying a company and then saying they were preparing. It just doesn't happen very often. I was wondering earlier why Peloton wasn't higher, because we also learned that Soros management had taken a $13.3 million stake in it. And this FT story sort of explains why, since there were a lot of hopes baked in that Peloton would be on the block sometime soon. And who knows, maybe it still will. But according to McCarthy, he's in it for the long term strategically here.
And he also brought up a very good point before I get to another stock we're watching here. He brought up that ultimately it is the vote of the board. And as we discussed really at length here, Julie, this is a board that remains very much in control by the company's founder and now former CEO John Foley here, just because he has those super voting shares. So again, no sell of Peloton appears likely tonight, tomorrow, or next week. But we're also watching AMD. Very interesting interview and commentary from Dr. Lisa Su, the CEO of AMD here just on our network. She's over at Xilinx headquarters about to talk to those 5,000 Xilinx employees. And my takeaway, Julie, was that this company is about to raise guidance in a couple weeks. They were looking for sales up 31% for this year. But now that you have Xilinx in the mix here, you could very well see AMD come out here very soon and raise their guidance for this year and perhaps set some pretty ambitious long-term guidance.
Yeah, we'll see. I mean, obviously, it's a much bigger company now with the closure of this deal. That does it for us on this Monday. Happy Valentine's Day, Saz. Happy Valentine's Day to all of our viewers out there. Akiko and Brian up next. Oh, my goodness. Of course they did. Why am I surprised? All right.
Okay.
Keep it here, folks.
Welcome to Yahoo Finance Live and happy Monday. I'm Akiko Fujita along with Brian Chung. We are 90 minutes into the trading day today and geopolitical tensions are driving the market action. Take a look at where the Dow is right now, down 350 points. The Nasdaq, the only one in the green, and the S&P 500 off about 30 points there. Investors also keeping an eye on the Fed, with St. Louis Fed President Jim Bullard saying the central bank needs to front load rate hikes. Diplomacy possibly back on the table between the U.S. and Russia. At least that's the message from Russia's foreign minister for now. We'll have all of the developments as investors consider the possibility of war. And fear of energy disruption pushing oil prices to a near 7.5-year high there. Take a look at both WTI and Brent crude there, pushing higher, well above that $90 a barrel mark. A lot of analysts calling for potentially $100 a barrel. Plus, the big business of the big game. We have the best, worst, and most effective ads that aired during the Super Bowl. And the big bet that cost one CEO nearly $10 million. We are beginning this hour, though, with the market action. As we said, investors assessing the latest news coming out of Russia as its foreign minister, Sergei Lavrov, sort of suggesting that diplomacy is still on the table, even as the U.S. warns of an invasion any day now. I want to bring in Jared Blickery, who's tracking the market action. And Jared, in the Friday session, we saw oil prices just spike on that news coming from National Security Advisor Jake Sullivan. It feels like we're sort of pushing higher, but investors are kind of starting to pull back and say, well, what are we looking at here?
Well, we know the supply and demand picture for oil has been bullish overall, and we're just not seeing a lot more traction given this particular catalyst. Not surprisingly, because if we go to the Wi-Fi Interactive, first, I want to start with the equities markets, and we'll get to oil in a little bit, but just want to show you where we are with the S&P 500. That's today's price action. I want to zoom out and take a year-to-date look on these candlesticks. And here we broke through the 2-week range on Friday into the close, and it looks like we're heading lower right now, probably going to probe these lows here. And as I've been saying, I don't have a lot of confidence that those are going to hold right now, but we just have to wait and see. Now, a lot of this has to do with, as you've been talking about, Akiko, their developments in Russia. I do need to say that a lot of times these conflagrations, while they might move the markets on a short-term basis, typically in the long term, they really don't have that great an effect. And it's a very serious geopolitical matter, but usually we don't see this spill over into the markets for a prolonged period of time. Crude oil is probably where you're going to see it hit the most. Now, here's the Russia index. This is the MOEX, and it looks kind of similar to our S&P 500 chart, but just want to show you over the last year, really fell off sharply from these highs. You can see this on a 3-month basis, down 15% there. And then you take a look at the US dollar versus the ruble. Let me change this picture. There we go. You can see the US dollar is getting stronger here. The ruble is getting weaker when these lines go up. And you can see over the last 2 years, pretty much going sideways, still in the upper end of that range right there. And then just want to show you WTI crude. Now, we did hit nearly $95 on the March contract in WTI overnight. You can see up 80% over 2 years. And as we've been saying and remarking, this is from the lower left to the upper right. We have Bob Iacchino coming in a few minutes. I'm sure we'll get his take on the markets and especially the oil markets. But check out these futures. I'm going to put this on a year-to-date view. You can see in the upper left, palladium and natural gas. Both of those are markets that are affected by Russia. Each of those up more than 5% there. And on a year-to-date basis, we're seeing a lot of action in the commodities. Palladium, which we were just taking a look at, the leader today is also the leader on the year. That's up 28%. And crude oil up 23%. A lot of energy names at the top there, each up over 20%. So be remiss if we didn't check out some of the stock action here. And let's take a look at what the NASDAQ 100 is doing. We see Apple. That's year to date. We're going to go back just to an intraday view. That looks a little bit better. Amazon up 2%, Tesla up 3%, NVIDIA up nearly 3%, guys.
All right, Jared, thanks so much for walking us through the moves. Let's bring in our first guest for the hour. We've got Bob Iacchino, Path Trading Partners co-founder and chief market strategist. He's also the stock think tank co-portfolio manager. Bob, let's put this all in context because we're talking about Russia and oil. Obviously, Russia, the third largest producer globally. It accounts for roughly 12% of global crude production. What do you see as the biggest risk right now as Diplomacy tries to take its course, but increasingly feels like it's running out of time.
Well, good morning. I think that the main weapon sort of against the West, other than cyber attacks, which I don't know anything about, so I wouldn't really speak to those, would be the pullback of production that, quite frankly, financially Russia needs. But I think Vladimir Putin, as a leader, has shown that he's got some tolerance for allowing his populace to suffer in order to achieve his ends. Now, from that perspective, he could cut back on crude oil production at a time when the US and other countries are struggling with inflation. The UK is struggling with record high inflation. I would argue the EU as well, although Christine Lagarde thinks it's transitory. She's one of the last central bankers to use that type of phraseology in terms of inflation. And if you were to bump up crude oil prices to the levels that Goldman Sachs, JP Morgan, I believe JP Morgan's in that crew, that have said we could have an average for 2022 of around $100 to $105 a barrel, depending on who's predicting it. It can go much higher than that if Russia were to do that. Now, I understand that diplomacy is still on the table, and that's a good thing. Crude oil now is pulling back from those highs. Also, U.S. rig counts are above 500 for the first time really since about March or May, between March or May of 2020. But if you look at the amount of time it takes for the U.S. shale producers to produce shale versus the amount of times that prices could collapse, the last time we were at these price levels was about September 17th of 2014. It only took 75 trading sessions for crude oil to get back below $50, which U.S. shale does not want to see. So we have to sustain these price levels before any U.S. production is going to help out with this situation.
Yeah, I mean, let me pick up on that point, because you're right. You know, so much of this discussion has been what Russia can do in terms of sort of weaponizing, as you put it, their grip on oil. I wonder what the risk to the downside is, though. I mean, not that we're anticipating this could all play out in a matter of days, but if in fact there is a resolution, some kind of agreement reached that says, like, any kind of military activity is off the table, what would that mean for oil prices, given how quickly they've risen on the anticipation that there is an invasion that's imminent?
Well, oil markets have a characteristic, and that characteristic basically consists of adjusting to potential supply and demand dynamics. Those are the trends that we see, whether up or down, and then moving sideways within pretty wide ranges, while the supply and demand equation is not settled, but settled within a range. So I think if the temperature were to tone down between Russia and the Ukraine, you're only probably talking about $8 to $10 lower. So that would only put us at about, say, $83 to $85. And then that would likely be the middle to the low end of the range that we would probably stick in as the supply and demand dynamics worked out. You know, we talk of OPEC Plus increasing their production targets. They haven't been able to reach those targets for quite some time. Some analysts estimate that they were 800,000 short of their targets in 2021 for the entire year, 800,000 barrels a day short for the entire year on average. So even though they agreed to increase production, demand is rising, and that demand rise is not expected to slow, especially because we're right around the corner from the summer driving season. So all of this is going to go into that equation. I think if the Russia-Ukraine situation toned back, $80 to $85 a barrel would be the low end of the range we'd be trading in.
Bob, it's Brian Chung here. I want to ask about, amid the uncertainty, what types of political headlines you're watching, because it seems like one obvious one would be Nord Stream 2. We've heard President Biden say that they would suspend Nord Stream 2. It's unclear exactly how he would do that, but obviously Olaf Scholz of Germany heading over to Kiev and then over to Moscow in a last-ditch effort here. I mean, is there anything that could come out of those discussions that would also give you some sort of guide on where oil prices could go based off of those political considerations?
Well, good morning, Brian. There's two things that I want to answer that question with. Number one is the immediate question that came out of Germany when the U.S. started talking about crippling sanctions was, can we get an exemption for energy prices? So I think that would be the first headline I would look at in terms of Russia's ability to bank in U.S. dollars, because as we all know, at least for the time being, energy is priced in U.S. dollars. So I would look for that. I would look for Scholz to come out with a more aggressive request for those exceptions and exemptions to the sanctions. I don't know if he would get it. The second thing I'm actually looking for is headlines with an Iranian nuclear deal. because that could put more Iranian oil on the market and ease these pressures much more. I shouldn't say much more, but within that same range of price easing that Russia-Ukraine tensions dying down good. So you could potentially get $10 on Russia-Ukraine tensions dying down, and then maybe another $5 to $6 lower on Iranian oil coming back to market in a legal way. It's already been on the market for the most part, and their exports have actually increased, and they're looking for their exports to increase even more. But them to be able to produce in a more internationally legal framework would be a good thing for prices. I'm saying it's a good thing for prices, maybe not other situations politically, but that's not what I look at.
And Bob, finally, what does this all mean for shale producers here in the U.S.? Obviously the threat here, or at least the concern, is that if Russia does cut off any outflows on oil, that could disrupt the global supply, even though if it's just 12%. What does it mean for the producers here, and how quickly would they be able to ramp up?
Well, in a strange way, during the height of the shale boom, we talked about them turning on the spigots and turning off the spigots. And it's just not so simple for shale producers as it is for a traditional driller like Saudi Arabia. You don't just turn these on. You have to ramp up, and then you have to ramp back down. And I think that's why we saw this abundance of caution, even though we've seen crude oil go from negative prices all the way up to where they are now. We've seen rig counts in the US just crawl higher, not really rocket higher. That's because, again, there has to be a ramp up. And I think you might start to see that ramp up. Shale producers got burned in, again, how quickly oil prices can drop. I mentioned it was 75 sessions the last time we were here, down to below $50 a barrel. I think they'd like to see a prolonged range above $50 and well above $50 so that the ramp up can at least be paid for, and hopefully they could profit from it as well.
Well, Bob, always good to get your insight here. Bob Iacchino, Path Trading Partners co-founder and chief market strategist. Well, let's take a look at how these geopolitical tensions are affecting the broader markets. We've got Mira Pandit, JP Morgan Asset Management global market strategist. And Mira, I know you've been listening to Bob in terms of how he views oil moves, which direction oil could move in depending on what plays out. How big of a risk ultimately is this from a market perspective, if we're talking about the tensions between Russia and Ukraine?
Look, markets do not like uncertainty, and this is causing a lot of uncertainty in the overall context of somewhat of a fragile market when it comes to sentiment. I think to Bob's point that one of the biggest transmission mechanisms here is within the energy market, seeing higher oil prices. In some ways that could be more of a challenge to Europe and the European consumer than perhaps in the US, just given the Europe's reliance on Russia for energy. But equally, this could be a bit of a headwind when we think about more broadly global growth and the global consumer. So something that we're watching carefully, especially in the throes of experiencing much higher inflation on a global basis. But I think the good news is that what we do tend to see with a lot of these geopolitical conflicts is that while the consequences from a political and human life perspective are enormous, the markets tend to react during the height of uncertainty the most, and then focus back on the fundamentals. So it could be somewhat of a shorter-lived pressure on markets than perhaps the more broader consequences of the situation.
Hey, Mira, Brian Chung here. Let's shift over to the other big story for markets. Obviously, the Federal Reserve, hearing remarks from Jim Bullard from the St. Louis Fed on CNBC this morning, kind of doubling down on his view that the Fed should be more aggressive with perhaps a double interest rate increase in the next meeting in mid-March. What do you see as the uncertainty around the Fed? Because I've been watching these Fed fund futures contracts, which have been teetering over just the last 7 days or so. There was one point in time where it was like a 97% chance of that 50 basis point move. Things moving back now to about 60%. But look, markets have no idea where Fed policy is going to go this year.
That's right. It's been really a keeping up with the Joneses exercise this year in terms of predicting the number of Fed rate hikes. When we say 4, somebody else says 5, 6, 7, 50 basis points. And the Fed is preserving maximum optionality here in terms of the increments and the pace on rate hikes. We might be a little bit more in a conservative camp of closer to 4 rate hikes, just given some of the timing challenges that the Fed is up against this year, given the fact that we should see growth, inflation, and consumer demand moderate in the back half of the year. So the Fed does not want to jeopardize the health of the economy at that point. What they might do is be a little bit more aggressive up front to give them a bit of runway to slow down towards the end of the year. But ultimately, again, the Fed wants optionality here The markets want clarity, and that's likely to lead to pockets of volatility both within the equity market and within the rates market for the rest of the year.
Mira, really quickly here, I'm wondering what all this means in terms of your portfolio or what you're advising clients. You've talked about this barbell approach. We've heard from so many guests who said, value and growth, you kind of want to balance these out. What about international allocations? I mean, is the U.S. still the best place to be, or are you starting to see some opportunities abroad?
We're somewhat more balanced in the context of the U.S. versus international. Last year was very much the year of strong U.S. growth, and that was reflected in the equity markets. This year, we're on a path to normalization, and we're facing more headwinds in light of the monetary and fiscal accommodation being removed. Whereas if we take a look globally, what we're seeing is that the durability of those recoveries didn't really stand last year, whereas we expect that to come into play more over the course of this upcoming year. And if that is the case, we could see some pretty strong earnings there. Earnings estimates abroad look a little bit more conservative than we think could actually play out. And ultimately, the share of cyclical sectors abroad, particularly in areas like Europe and Japan, but more broadly within the emerging markets as well, is higher than what we see in the United States. Therefore, some of those areas are really levered to the economic recovery. So we could actually see quite decent performance out of international this year. And indeed, what we're seeing already so far year to date is that international stocks are outperforming the US, holding up a little bit better. And in areas like China and the emerging markets, actually eking out positive returns year to date.
All right, well, certainly worth watching that space. Mira Pandit, JP Morgan Asset Management Global Market Strategist. Thanks for stopping by this morning. We want to take a look at one trending ticker on this Monday morning. Take a look at shares of Peloton, down over 3%. The Financial Times reporting earlier today that the new CEO, that's Barry McCarthy, keep in mind they just had a change in leadership last week. The new CEO saying that he wouldn't move across the country if he was going to sell the company. He's going to be moving to New York for this new job. He said, quote, "There are lots of other things I could be doing with my time that are quite lucrative than hanging out with a business that's about to be sold." So the new head there, perhaps throwing some cold water onto the optimism among some circles that maybe Apple or Amazon or a Nike would be interested in buying them. And Kiko, still important to note that John Foley, the CEO of the past, still has a huge say. He's going to be executive chair.
Well, and Barry McCarthy in that interview with the Financial Times makes it pretty clear he's going to continue to turn to him, too, as they try to get this company back on the right track. Those comments coming from him, not entirely a surprise, I would say, last week when he was tapped for the top position. I think a lot of analysts sort of looked at that and said, okay, maybe a sale in the future, but that's not going to happen immediately if they're bringing a big name executive on board. So that seems to jive with the comments that he's putting out there. Having said that, don't expect him to necessarily disclose a sale to the FT in an interview. I think I would argue it's probably still in the works. Peloton has said, in their most recent earnings call that they are looking at all options because they realize they've got to definitely improve in terms of cost cutting, but also make the platform a little stickier so they keep those users on board. So there's a lot in the works here, and I'm not sure a sale is in the immediate future, but interesting to see the stock reaction tonight.
Yeah, really poignant observation there. I mean, if you're a new CEO and your first interview to a media outlet, you're saying things like, well, oh, yeah, of course we're going to sell. I mean, you would never do that, even if you were having those discussions. So I think that when it comes to just the optics here, we have to keep in mind that even though he's saying we're not going to explore a sale, I mean, of course, there's always a chance of anything. That's how Wall Street goes. So an ongoing story for sure. Keep in mind, shares of Peloton still down 70% over the last 6 months. So still a lot of turnover story there, regardless of merger or new turn in leadership. A lot to do over there at that company. But let's shift gears and tease what we've got coming up on the other side of this break. Billionaire investor George Soros making a move into the electric vehicle market. But so far, it's been a losing bet. We'll have the details after the jump. take a look at shares of electric truck maker Rivian, which are getting a jolt today, up about, let's say, 12%. After an SEC filing disclosed that George Soros, the big billionaire fund manager, bought about 20 million shares at some point during the last quarter of the year. That stake was worth about $2 billion at the time. That represents about 2% of the company's outstanding shares. But of course, that may have gotten George Soros a little bit of a loss because shares have been down 40% since their IPO, which was only in November of last year. So Akiko, even though this is a pretty substantial stake that obviously George Soros took in the middle of that quarter, may not have paid out, at least so far.
Yeah, he's probably cheering on the disclosure today, seeing the reaction in this stock. By the way, that is a steep loss, as you pointed out, Brian, about half of what it was worth when he purchased it. The same SEC filing showed that he had $13.3 million stake in Peloton. So he's taken a bunch of losses over the last month more. What I thought was kind of interesting, though, beyond Rivian specifically, that he's pulled back on some of his tech holdings, particularly in Amazon and Alphabet. And Brian, I guess we can analyze what George Soros's investment strategy means ultimately, but it does, I think it's worth noting that some of the bigger investors are maybe perhaps giving tech a second look, sort of in line with what we've seen play out at least in the month of January.
Yeah, and I think the important thing here is that, regardless of how you want to kind of piece together the narrative on whatever his asset allocation might be, maybe he's getting out of, these big FANG stocks. He also got out of QQQ, the NASDAQ 100. Maybe he's trying to get a little bit riskier. I think we just have to acknowledge that it's really not fair to say, okay, well, after one quarter of investment, oh, look, he already lost money. I mean, if you invested in Rivian during the end of last year, you are making a long-term play, surely by virtue of the fact that this is a company that has not existed on the public markets for longer than a quarter. And I want to remind our viewers that the disclosure of this holding covers the period of the last quarter of last year, which means that he had to have made that purchase sometime before December 31st of last year. But also it could not have obviously been before November because that's when they went for an IPO. At the time, shares of Rivian were they were down after the IPO around $100 or so, let's say, at the end of the year, at the end of the calendar. But now it's down to $66 even after the pop that we saw this morning. But I don't think George Soros is paying attention to all of that stuff. This is a longer term play. Interesting to see, though, that one fund manager is getting riskier ahead of a 2022 that everyone had said would be much of a risk off environment, especially because of the Fed.
Yeah, going from tech to EVs, not necessarily a risk off move there. But, to your point, Brian, I mean, with EVs, you're right. This is not those who are getting in on these stocks. This is not a quarterly story. They're looking 5 years, 10 years, even longer down the road. So interesting to see that move, but Rivian getting a bump on the back of that. Coming up, we are talking about my Los Angeles Rams, now Super Bowl champs. Up next, we are looking at the winners when it comes to betting and one big loser. We'll explain on the other side. Well, the Super Bowl pretty much gave us everything on Sunday. A great game, although, Brian, maybe not for the Bengals. An exciting halftime show and some colossal numbers when it comes to sports betting. An estimated 31 million Americans placed bets yesterday, totaling more than $7.6 billion. Even rapper Drake got in on the action here, betting in crypto, by the way. We're talking about $1.25 million in Bitcoin. Let's bring in Yahoo Finance's Josh Schaefer, who's crunching all the numbers for us from Sunday. Josh.
Yeah, Kiko, I mean, to really confirm some of those gambling numbers, we're still waiting on. I talked to some of the sports books this morning. They know a couple of their big winners. DraftKings had a winner in the millions of dollars, and a couple of the other sports books had some big winners as well. But we don't know exactly what the total handles were and the total bets placed just yet, kind of like ratings and a lot of the other things with the Super Bowl. There's so many people placing these wagers, and they do still think it was a record Sunday, that it's taking them a little extra long to actually crunch the numbers. But one thing I did want to point out that was an overall win for these sports books was with that high concentration of volume, we didn't see any tech support issues or major tech support issues like we saw at last year's Super Bowl and have seen in other big events in the past. You might remember Caesars last month had a few hours where they were off the network when sports gambling opened up in New York. We didn't see that for this Super Bowl. That wasn't the big narrative around sports gambling. Instead, we're talking about the numbers. So I think that's an overall win for a lot of these companies. So I wanted to get to some of these numbers and some of the fun prop bets and big money bets that we saw. The biggest prop bet for Cooper Kupp to win the Super Bowl MVP I saw from Caesars was someone wagered $6,000 to win $42,000. Pretty fun, but I figured you guys might want to go bigger. So we got some bigger ones. Let's hit on Drake. The famous pop star Drake placed some bets in Bitcoin. Of course, we saw someone betting in Bitcoin with all the crypto commercials we had, right? And Drake bet on Rams' Odell Beckham Jr., the receiver, who actually took his salary in Bitcoin, I should add. So it was a double crypto event there. He bet on Odell Beckham Jr. to score the first touchdown, which hit. He bet on the Rams to cover, which hit. But he also had the sad fate that a lot of bettors had last night when he bet on Odell Beckham Jr. to catch for over 62 yards. Beckham Jr. got hurt in the first half and never came back in the game. So Drake didn't hit on that bet. Overall, he bet over $1 million worth of Bitcoin and made about $300,000 US from those bets. So even with losing one of the Beckham bets, he still made out. Now, the other bettor we wanted to talk about that did not make out is our friend Mattress Mac down in Texas. So Mattress Mac bet a total of $9.5 million yesterday, including a $4.53 million bet on the Bengals. This was kind of calculated for Mattress Mac because he's a furniture salesman in Texas. And part of their deal was if you paid more than $3,000 for furniture and the Bengals won, you got your furniture for free. So Mattress Mac said, well, I'm going to have to give out all this free furniture if the Bengals win. I should probably bet on the Bengals. So if they do win, I can win some millions of dollars and maybe have it equal out. Now the Bengals didn't win, so he doesn't have to give out the furniture for free, but he lost $9.5 million. So I don't really know if he won or lost there. We'll have to reach out and talk to him, and maybe we can find out how he feels about it. But
I don't know, Josh. That sounds like one big loss to me. $9.5 million. That is painful to see, even on paper.
Yeah, absolutely.
A lot of people, I guess, counting their losses today as well. Let's bring in our guest here, Jed Kelly. He's senior analyst, Oppenheimer and Co. Jed, let's talk about what played out yesterday. I mean, certainly this has been, if you're talking about the NFL season, really a record for online sports betting. How big was yesterday in getting these companies ultimately on this road to profitability?
Well, I think, on the road to profitability, that's a whole different discussion, right? I think if you look at yesterday, I think the top takeaway from my perspective was there was no tech issues, right? If you're covering the stock, these companies had their infrastructure in place during the Super Bowl, during the live betting. So that's really important. I think New York State, right? They just went live 3-4 weeks ago. Typically takes 2 to 3 months before all the promotions settle down. And if you look to New Jersey, right, we're 5 years into it. I think DraftKings, the most the most visible publicly traded company. They're going to give their contribution profit in that market probably on their March 3rd analyst day. That'll probably give investors a better roadmap on where we are profitability wise. I tell people this all the time. If you look at our street numbers, we're on the lower end of EBITDA for the next 2 to 3 years. And if you look, if California goes live next year, it's the 7th largest economy in the world. There is going to be massive spending. And I think if you look at DraftKings' angle, they're trying to create a platform around fan interactivity. So they are making a lot of investments where they can develop a company that brings in multiple revenue channels from the sports fans' wallet, media, sports betting, apparel, ticketing, NFTs, etc. So, but we were happy with the way it came out. I mean, we were looking for tech issues and there were none.
Jed, Brian Chung here. I want to ask about the promos because it seems like there was a massive sprint, especially with the New York market going live among all of these platforms to offer the most lucrative deals to onboard people. Whether or not these companies can retain those new kind of signups is one question. But I guess from your perspective, have these companies given too much or too little promotions to try to get these customers? Because a lot of people are looking at, look, $500, $600 in free bets and wondering how is it possible that these companies have this type of a marketing spend?
Well, if you look at DraftKings, right, they're well capitalized. I mean, BetMGM has 2 profitable entities funding them, and then FanDuel has Flutter. So there's enough capital for aggressive marketing spend, and then Caesars as well. You know, what we've seen for new state launches, right, is you see an aggressive first couple of months, and then we've seen a consistent flow where the top 2 or 3 providers take the most share. So if you look at Michigan, right, last year during the Super Bowl, Michigan was by far the most competitive launch. You had 10 companies go in. Top 3 now are FanDuel, DraftKings, BetMGM. My guess is once New York settles down, you'll probably see those 3. You'll probably see DraftKings and FanDuel, maybe Caesars, because Caesars has been pretty aggressive there, have top 3 share. I think what we're hearing is people like the user interface for DraftKings and FanDuel, but Caesars took advantage because what DraftKings and FanDuel did, they did not give users of their daily fantasy product that $350 free bet, which Caesars did. That allowed them to get a lot of handle. I think come March Madness, you'll probably see you'll have a better roadmap on where the competitive breakdown is breaking out, but we expect FanDuel and DraftKings to be the top 2 in the next 3 to 4 months.
Yeah, I forgot about March Madness coming up. I want to ask you just about one other kind of facet of differentiation. You mentioned that it's the product itself and the ease by which you could place these bets. That's a big pull for a lot of users. But, you know, the conversation even at my Super Bowl party yesterday was I can't find the platform where I can bet on the Gatorade color. I can't find the platform where I can make that, you know, degenerate bet on this weird player prop or that weird national anthem length, for example. How important is just the book itself, the available bets that you can make with these apps trying to differentiate themselves?
Oh, it's extremely important. Well, some of those like Gatorade and the national anthem length, that might be restricted from our regulations. But if you look at product, right, FanDuel by far has done the best job so far, right? Their same game parlay has been a home run. DraftKings, BetMGM, they're all playing catch up. The 2 things you're going to want to have is you're going to want to have fun same game parlays. And number 2, you're going to have good live betting, right? Who can keep you engaged? Who can keep the most markets up? Live betting over the next 3 to 4 years is going to be extremely important. And as you get more live betting and you can have more markets, that'll keep fans more engaged. So if you're kind of looking at like who's number 1 right now, you look at FanDuel because they have the highest GGR in New Jersey. If you were to look at the overall handle, it's probably much closer between DraftKings and FanDuel, but the same game parlay is really working well for FanDuel, and that's because the Betfair bet engine over in the UK is powering that, and they've been doing live betting and same game parlays for over a decade, and the UK is 10, 12 years ahead of the US in terms of the overall betting market.
Well, it's incredible to see the growth so far. Jed Kelly, senior analyst, Oppenheimer and Co. It's good to talk to you today. Well, coming up, the Canadian trucking blockade finally comes to an end as police move in on remaining protesters. That and much more in our worldview on the other side. We'll be right back. In our worldview today, Ukraine has called for a meeting with the Kremlin as the U.S. warns about a Russian invasion any day now. Foreign Minister Dmytro Kuleba said he requested the meeting within the next 48 hours after Russia failed to respond to requests for more transparency on their buildup. Meanwhile, Russian Foreign Minister Sergei Lavrov has called on President Putin to allow for more time for diplomacy to take its course. Russia has amassed troops all along its border with Ukraine while carrying out joint military drills with Belarusian forces up north. Fears of an imminent invasion have accelerated moves on the diplomatic front, with German Chancellor Olaf Scholz, whose country relies heavily on Russia for natural gas, is set to meet with Russian President Vladimir Putin following his meeting with Ukrainian President Volodymyr Zelensky today. Well, the border bridge connecting the U.S. and Canada has fully reopened after demonstrators shut down the pathway for nearly a week. Police moved in on remaining protesters on the Ambassador Bridge Sunday, arresting more than 30 people. Truckers with the so-called Freedom Convoy have been camped out for days to protest COVID-19 vaccine mandates for drivers crossing the border. That's led to significant supply chain disruptions, with the bridge seeing 25% of all trade between the two countries. Toyota, Ford, and General Motors all halted some production last week, citing supply shortages. And a Russian figure skater accused of doping at the Beijing Olympics has been cleared to compete in the women's event starting tomorrow. 15-year-old Kamila Valieva tested positive for a banned heart drug in December, but the result wasn't revealed until after the games began, prompting an investigation last week. Now, a panel of arbitrators met in Beijing for nearly 6 hours yesterday, ruling that banning Valieva from the games would cause, in their words, irreparable harm. The IOC responded by saying Valieva would not be honored in a medal ceremony if she wins. Valieva is just the latest Russian athlete to be accused of cheating at the Olympics. The IOC banned Russia from competing following revelations of systematic doping in the country. Athletes have still managed to take part in the Olympics, though, under the banner of the Russian Olympic Committee. Coming up next, we are breaking down the ads from Super Bowl Sunday and some of the top trends from crypto to electric vehicles. That's coming up after the break.
figure you could use a little pick-me-up.
All electric?
All electric.
The BMW iX. Electricity in its ultimate form.
Electric Avenue. And we take it higher.
BMW, the ultimate electric driving machine.
Well, those who watched the Super Bowl yesterday may have caught that ad for BMW, Salma Hayek and Arnold Schwarzenegger as Hera and Zeus, respectively, plugging, no pun intended, the BMW iX. Of course, a lot of attention on electric vehicles and also crypto. I mean, who could forget that Coinbase ad with that floating QR code during the game yesterday? A lot going on, so let's bring in marketing and advertising expert Donnie Deutsch, also host of On Brand with Donnie Deutsch, joining us now to talk about the big marketing spend yesterday. Donnie, again, a lot of people kind of astounded by just the amount of electric vehicle ads, Polestar, Nissan also getting involved. Was there any one of these companies that you think did a standout job in getting their message for their new vehicles out to those watching the Super Bowl yesterday?
You know, what's interesting about the Super Bowl, I think back to the early 2000s when all of a sudden you had .coms popping out of nowhere. It was kind of signifying the Super Bowl, signifying basically kind of a new world. And I think we saw that this year with electric vehicles and with crypto. As far as the electric vehicles, I thought that they all stood out. I thought they were strong. I thought that spot you just showed. I thought the best car spot, though, and the best spot in the Super Bowl was the Sopranos, the Silverado. I don't think it was an electric vehicle, but it was an old take on the Sopranos, where Meadow Soprano is driving, duplicating the scene that her father, James Gandolfino, in the show used to play. I thought it was a wonderful, wonderful ad. But electric vehicles were certainly news of the day.
Yeah, I think I counted 7 EV ads, but that doesn't even count all of the car makers that had spots during the Super Bowl. I want to ask you about crypto, specifically this Coinbase ad that was just a QR code that was kind of bouncing around. I mean, I found that to be really effective. It forced me to I brought out my phone and tried to see where that would lead me. What did you think about the ad, just given the simplicity of it?
I think just the last word you use sums it up. I think the simplicity makes it stand out. You know, people go so over the top on Super Bowls with production values and celebrities and gimmicks. And so this was, on the one hand, so simple, you couldn't not, look at it. And as you said, if you picked up your phone, it sends you to Coinbase. You talk about direct marketing. I mean, I thought it was brilliant. I thought executionally, you can't help but look at it. And I'm sure it delivered a lot of people to their site.
Donnie, is there anything just thematically about the nostalgia factor here? Because that reference for Coinbase is kind of, going back to those DVD preview menus that's kind of bouncing around. But I felt like that also fit what we saw in the halftime show is, 50 Cent and Mary J. Blige performing. I mean, this is kind of the, let's just say geriatric millennial kind of demo. It's no longer the Who that's performing at the halftime show. I mean, are advertisers zoning in on that too?
Yeah, I think you hit up, Brian, a really interesting point. There were a lot of what I'll call like 90s, early 2000 ads, that used, you had Dr. Evil in an ad for GM, which was also an EV car. You had, Jim Carrey from The Cable Guy, which was from that era. You had The Sopranos, as I already mentioned. And I think that nostalgia works at a time when you're in turbulent times and people want to go back. So you're hitting that key demo still in terms of age, but you're kind of hitting on a theme of our kind of maybe little escapism for where we now want to go back to when you were younger and things felt a little bit better in the late 90s, early 2000s. So I wasn't surprised to see that as thematic, both in terms of the halftime Super Bowl show and the and some of the ads. It's really where generations come together also, because an old geezer like me can remember it, and you've got the millennials who are, it's right in their sweet spot.
So we talked about the ones that really stood out. Any that stood out for the wrong reasons? What did you think was the worst ad that we saw yesterday?
The worst ad. I hate to dump on any ads. I think that the ads that we don't remember are the worst ads, And I think also what I think a lot of mistakes advertisers make, they do so much in a production value and they spend so much on celebrities. And do you remember what the ad was for? I mean, the big question is, do you remember what that I called it the Jim Carrey ad. I mean, it happened to be Verizon. Will you remember, what the ad that with Paul Rudd and Seth Rogen was for? So I think the ads that don't make it are the ones that don't, even if they're creative in and of themselves, that really don't connect back to the product. The best ads are the ones that really have that synergy, that the celebrity is not a celebrity for celebrity's sake. I thought one that had an interest, the one I mentioned with Dr. Evil, is like he's there to destroy the world, but first he has to save the world with electric cars. So there was a editorial relevance to having him on there.
Yeah, I think you bring up a good point. It's like if we can't remember what the worst one was, that's just it, right? It wasn't memorable enough to stand out among all the ads we saw yesterday. Donnie, it's good to talk to you today. Donnie Deutsch, who's marketing and advertising expert and host of On Brand with Donnie Deutsch. Coming up, Walmart makes a major change to its mask policy for nearly 2 million employees. We've got the details ahead. Welcome back to Yahoo Finance Live. We are seeing the Dow coming off of its lows now in the session, although it's still down about 192 points. And the NASDAQ, the only one in the green. The energy sector getting pretty hit hard today, with that sector down about just over 2.5%. Let's bring in Yahoo Finance's Inez Ferre, who's tracking the rest of the market action. Inez, what do you have your eye on?
Well, Akiko, we're taking a look at ADRs of Sea Limited. This is the e-commerce and gaming giant that's based out of Singapore. We don't talk a lot about this stock, but it is down almost 15%. Earlier, it was down 18%, its biggest decline on record. And this is after India banned 54 apps of Chinese origin, including its marquee game, Free Fire, citing security concerns. You also have some analysts which have lowered their price target on the stock, including Morgan Stanley lowering their price target on Sea Limited. Taking a look also at some of the other Chinese name, a little bit of a mixed picture for those. After that, also looking at the semis, we are seeing some green on this screen. We're watching Micron up more than 1% after Wedbush Securities upgraded the stock. NVIDIA is up more than 3%, and we've also been watching AMD up more than 3% after the company completed its acquisition of Xilinx. AMD CEO Dr. Lisa Su spoke with Brian Sozzi today. Take a listen to what she had to say about what the acquisition means for AMD.
What do you need for the next 5+ years? we've had tremendous success across these large customers with our CPU portfolio and our GPU portfolio. I think adding Xilinx adds some strategic assets, things like networking technology, which is very important for the data center business, adaptive SoCs, AI. We're really excited about enhancing our AI capabilities as a joint company. Those are some of the things that we talk to customers about. And I think, really the sky's the limit in what we can do together.
And also, there's some monthly data that came out about semiconductor sales, and Wall Street has been weighing in on that data, with Morgan Stanley saying that the data for December shows that there's still some supply constraint, but still Wall Street seems to be very positive about semis in 2022. Brian?
And that's certainly a busy day. I want to also highlight Walmart, which maybe not so much of a stock mover headline here, but some changes to their mask mandate policy, no?
Yeah, that's right. Walmart dropping its mask mandate for all of its employees, those that are fully vaccinated. And by fully vaccinated, they mean 2 shots of the vaccine. So those employees are not required to wear masks in any of the Walmart stores or at Sam's Club. And this will affect nearly 2 million employees. This follows other companies that are also doing the same thing. You also have the Wall Street banks that have also announced a similar measure, with Goldman Sachs, JP Morgan, Morgan Stanley, even the New York Stock Exchange. Also, for those who are fully vaccinated, they don't have to wear their masks indoors. And of course, New York also has that as well. They dropped their mask mandate as well. And if you just take a look at the healthcare stocks, we do want to note that we are seeing a bit of a sell-off in the healthcare stocks, particularly the vaccine makers. So we're watching on our Wi-Fi Interactive board, we've been watching Pfizer, that's down 3%, Moderna down 12%, BioNTech also lower today. Brian, Akiko?
Yeah, so important to remember. They have Walmart employs over 2 million people, really important there. Yahoo Finance's Inez Ferre, thanks so much. Well, on the other side of this break, investors remain on edge as they brace for rising interest rates. And of course, that mixed with the threat of a possible Russian invasion into Ukraine really weighing on markets, as you can see. We'll have Senator Jon Tester, Democrat from Montana, joining us next with his thoughts. Stick with us. Welcome to Yahoo Finance Live. It is noon here on the East Coast on this Monday, February 14th. I'm Brian Chung alongside my co-host, Akiko Fujita. We'll be hanging out with you for the next hour here. A lot to walk you through on this afternoon. And in the theme of Happy Valentine's Day, we're seeing a little bit of red on the Dow and the S&P. S&P 500 just barely below where it closed the day on Friday, but the Dow down about 0.3%. The NASDAQ, however, getting a little bit of a rip higher, up about 0.8%, let's call it. Also keep an eye on the 10-year bond, which is ripped up above the 200 basis point level, up about 7 basis points on the morning. Coming up on the show, though, Senator Jon Tester of Montana will stop by to chat about all of the happenings in D.C. We'll talk about foreign policy amid the Ukraine and Russia tensions, and we'll also talk about issues facing the Senate Banking Committee, where economic policies and some Fed nominees remain hot topics. And then, how should financial advisors approach crypto? We'll explore the delicate balance of financial security without FOMO, or the fear of missing out, in the era of digital assets, and we'll have that conversation with financial planning guru Rick Edelman. But as mentioned, we want to start off this hour with a focus on Washington, and Senator Jon Tester, a Democrat from Montana, joins us live from the nation's capital. Senator Tester, it's great to have you on the program this afternoon. A lot to focus on. We want to talk about some legislation that you've got, in addition to some things happening in the Senate Banking Committee, but obviously want to start off with the big story of the day, which is, of course, those headlines around Ukraine and Russia. The big tool that's been talked about so far has been sanctions. What do you think is the proper approach here?
Well, I think sanctions are absolutely the proper approach. I think that what Senator Menendez has worked on is can be effective. Although sometimes I wonder if Putin hasn't already made up his mind, but the bottom line is I do think that sanctions are very, very important, and then supporting the Ukrainians to be able to keep their freedom, I think, is also very, very important. And I think this administration is certainly doing that. And then I think Congress, at some point in time here, hopefully before we get out this week, will work on the sanction piece.
Yeah, Senator Tester, it's good to talk to you today. You know, the question is how far those sanctions should extend, and the administration has been a little resistant to try and include oil and gas trade from sanctions. Do you think it should include that, given just how significantly Russia would be hurt if that was the case?
So, look, I think we need to do whatever we can do to hurt Russia as much as we can to make them sting, to make the sanctions sting. I also think, though, that we need to take into account the impact any sanctions would have on our European allies. And we've got to find the sweet spot here. I think that if we're doing sanctions that ultimately hurt our friends as much as they hurt Russia, that's not the direction to go in. So look, I think I'm for all the above on the sanction list, but I do think we need to make sure that we're not unduly hurting Europe's economy with the sanctions we're putting on Russia, even though it will probably have some effect. But we don't want it to be have more effect on our allies than it does on Russia itself.
That seems to suggest that you don't think it should extend to oil and gas, given this direct line that we see from Russia to Europe. I mean, my question to you is how effective can sanctions be if you don't go right at the heart of what is considered one of the big engines for the economy in Russia?
Well, let me say this. It's not that I don't believe it should include oil and gas. I think we need to take into account any sanctions impact on Europe. And as I said earlier, if those sanctions have a bigger impact on Europe than they do on Russia, we need to take another look at it, because the sanctions need to be focused. They need to be focused on Putin and Russia to make them change behavior, because the behavior they've exhibited, especially over the last 3 or 4 months, is just simply not acceptable. So I would not say take oil and gas off the table. What I am saying is let's make sure that the sanctions aren't harder on our allies than they are on Russia. If they are, then we need to reconsider them.
Senator Tester, I want to ask about the Senate Banking Committee issue of the day, which is, of course, the nominees that we have for the Federal Reserve from the Biden administration. 5 people at once that you'll be considering in your committee vote. I believe it is tomorrow morning. Any thoughts on your expectations for those 5 nominees to get confirmed, especially in a time that's so important with the Fed being tasked with the issue of these high inflationary numbers?
It is a very important time, Brian, and I pushed hard to get Powell out of committee, and that has happened. Now we've got Raskin and others. Raskin seems to be the one where there's the most controversy around. I intend on supporting them all. And I think that the issues that have been brought up around Raskin with reserve trust, I don't think there's a lot of there. I think it's the way business is usually done or always done in regard to the Fed and private businesses and boards. So look, I intend to support them all. I think they're more than qualified to be on the Federal Reserve, and I think they'll do a good job once they get on. And you're right, it is a very, very critical time for the Fed to be able to work together to help move the economy forward.
Senator, I want to drill down on that because I knew that you were looking into that matter with Sarah Bloom Raskin, who, for our viewers who aren't familiar, would be the vice chair of supervision role. I know over the weekend you had said that you wanted to look into kind of her matters at Reserve Trust, which was a fintech company that got a master account from the Kansas City Fed. There was some chatter about whether or not she had used her connections inside the Fed to get that master account. So if you support her now, do you expect all the other Democrats to also go along with it? It's a 50-50 split. Is your expectation that she will ultimately get confirmed by the full Senate?
It is my expectation that she will get confirmed by the full Senate. I can tell you I've had a number of phone calls over the weekend with different members that have expressed concern. Whether that concern ends up in a no vote or a yes no vote, I can't say right now. I can tell you that the members on the Democratic side of the aisle have been very thoughtful on this and really dug in deep to find out what the truth is and if Sarah Bloom Raskin is fit to be on the Fed. I think ultimately they'll come to the same conclusion I did, that she is fit to be on the Fed and will do a good job, and that's why I'm going to support her. Hopefully they will too.
Senator, we've seen a lot of momentum in not just the Senate, but the House as well to ban stock trading for lawmakers. The debate being whether it should just be for lawmakers, whether it should extend to family members, whether all three branches of government should be bound by the same rules. There's a lot of options on the table here. How far do you think legislation should go in banning stock trade? Should it just be for lawmakers? Do you think it should extend to family members?
Well, I think it should extend absolutely to the wife and anybody that you declare on your 1040 as far as that goes. I think that stock trading, by the way, done improperly right now is illegal. But the truth is there's been so much crazy stuff going on the last few years that just ban it. It really is something that I think would just clear the deck as far as any sort of impropriety that folks might be accused of. So do the same thing they basically do in the executive branch, and that is just require folks to sell their stock and be done with it. By the way, I don't believe it should be on a tax deferred basis either. I think we should be required to sell our stock, pay taxes on it, and be done with it.
And Senator Tester, lastly here, I want to zone in on your proposed legislation on the right to repair farm equipment. Obviously, farmers are a very important part of your constituency. A lot of concerns about anti-competitive behavior for manufacturers that make it difficult for farmers to repair if their tools are broken. How does this bill kind of address that? And do you think that there are other things that need to be done in the theme of President Biden's competitive pro-competition agenda to fix these issues?
So first of all, Brian, I approach this as a farmer because that's what I do in my real life. And I can tell you that because of technology, there's a lot of repairs, particularly small repairs, that can't be made because we don't have the software to determine what sensor went out. And these are repairs typically could take 15 minutes once you have the part. So all I'm doing is asking the manufacturers to give the farmer that software so that they can make those easy repairs. And by the way, those easy repairs sometimes will shut the tractor down or the combine or the baler, whatever you're using. And while storms are on the horizon, you're sitting there with a piece of equipment that doesn't work. So that's the first thing. I think it's fair. I think it'll help with farmers and ranchers, bottom line, those of us that are in production agriculture. And I think it's important for food security we do it. The second thing I think that we need to do is take a look at the packers. There's 4 packers that control 84% of this country's meat supply. That isn't capitalism. That's not competition. That's collusion. And so we need to insert more competition into that marketplace. I've got a number of bills that will do that. I think it'll be good for the consumer. I would think it will help drive down prices at the meat counter. And I think it will help make prices for the cow-calf operators and those feedlot operators make it so they can make a living and continue in business. So those are just a couple things that I personally am working on right now that I think will make a big difference for food security. It'll make a big difference for rural America. And I think it'll make a big difference for the consumer.
Well, Senator Tester, we hope to have you back on the show again soon with any updates on that front. Senator John Tester, a Democrat from Montana, good to talk to you today.
Thank you very much.
Well, coming up, another busy week on tap. We have retail sales and a slew of big earnings reports, including Walmart and Airbnb. We're going to break that all down on the other side of the break. We'll be right back. Well, retail will be in focus this week with Walmart reporting earnings on Thursday and retail sales data on tap. Nvidia and Airbnb also reporting their quarterly results on what is sure to be a very busy week ahead. Let's bring in Yahoo Finance's Emily McCormick with a breakdown of the week ahead. Emily.
Well, Akiko, as you mentioned, another jam-packed week is kicking off today. I'll start off with a look at some of the economic data that we can be looking ahead to. We have the producer price index out tomorrow, which is expected to show yet another hot inflation print for wholesalers this time. And we also have some housing data out between existing home sales and housing starts at the end of this week. But it's the retail sales report out from the Commerce Department on Wednesday that's really going to be one of the key focal points for investors, showing the strength of the consumer in January as Omicron cases surged to a record in the U.S. Now, retail sales are expected to rebound in January after declining by 1.9% in December month on month. Consensus economists are looking for a 2% monthly increase in January's retail sales report. Now, two big factors likely contributed to this, so something to watch, or two things rather, to watch out for in this report Wednesday. The first is the fact that Omicron cases likely drove a shift from services to goods spending, so potentially lifting that headline retail sales number, since this does tend to tilt more heavily towards tracking the amount of goods that consumers have been purchasing. And then the second factor is on inflation. Prices, as we know, have been climbing for the consumer. And so those price increases probably pushed up the month-over-month increase in sales, since retail sales are reported in nominal terms. But also related to retail sales, also want to shift gears and talk a little bit about Walmart's earnings report, because that is coming out before the bell on Thursday. Now, that report and earnings call will serve as another indicator of how consumers have been spending, and also whether labor costs and supply chain challenges have shown any signs of letting up for that company or for major corporations more broadly. Now, Walmart is expected to see overall sales come in flat on a year-over-year basis at around $152 billion as the company laps last year's pandemic-boosted revenue figures. And then finally, we'll also be getting a number of other major corporate earnings results throughout the week as well, in addition to Walmart's. Now, a slew of accommodations and lodging companies, including Airbnb, Wynn Resorts, and Marriott, are reporting tomorrow, and Palantir and DraftKings are reporting results Thursday and Friday, respectively. And then, as a quick check of where things stand on the earnings front so far, about 72% of S&P 500 companies have reported results to date for this latest quarterly earnings season, and the expected earnings growth rate for S&P 500 companies in aggregate is tracking towards 30.3%. Now, if this holds, it'll be a fourth straight quarter of earnings growth in excess of 30%, according to FactSet data. And we have seen the expected growth rate for earnings continue to creep higher as we continue throughout this earnings season. So even last week was about 29%, and now we're just over 30%. But we'll see how things shape up this week as another busy one for investors, guys.
Okay, Emily, thanks so much for that. Let's bring in Cliff Corso, Advisors Asset Management President and CIO. And Cliff, let's start on that point that Emily just made here. I mean, earnings growth of more than 30% for S&P 500 companies is not bad. And yet it does feel like the uncertainty around the Fed policy and now geopolitics has created this overhang.
Well, thanks for having me, first off. But yeah, that's exactly right. I mean, if you look at the condition of our economy and you look at the position that corporations are in, it's still a very positive scenario. We need to get used to the coming off the peak of these earnings numbers, but it doesn't mean we're going to zero, right? And so I think the numbers that we're talking about here are still very, very solid. I think, though, as you point out, the earnings are solid, the economy is solid, certainly in the U.S., but there are a wall of worries that we're climbing, and we're going to have to climb this year, geopolitics and inflation and the Fed in particular.
Hey, Cliff, Brian Chung here. So I guess I want to ask about the uncertainty around the Fed policy this year, though, because we were talking about this with, Amir Pandit over at JP Morgan Asset Management. But when you hear Fed officials on one hand going, I'm calling for a 50 basis point hike in March, but then you have other Fed officials like Mary Daly saying, yeah, I don't know if I'm quite ready to make that call yet. As an investor, it's really hard to position for that, right? You see the fluctuations in Fed funds futures contracts. I mean, is it better to just sideline yourself right now and kind of ride the wave out, or are there places you can go right now?
Sure. I would not argue that one should sideline themselves. I think we have a saying, it's not timing in the market, it is time in the market. And if you can stretch back with any kind of patient lens, what you'll see even in tightening scenarios, 12, 24 months forward, markets can do quite well. Certainly the equity markets historically over the last 30 years through tightening cycles had solid positive total returns. But I think it's really more about where you're allocating your capital within those risk sectors of the market. And with rates rising, a clear argument, and we're seeing it play out quickly actually, that areas such as value versus growth, where earnings are low or zero in many cases, those are long rated assets, meaning they're very sensitive to rising rates. So it's really going to be about repositioning for this regime shift and being smart about where the asset allocation is, and underweighting bonds, but not avoiding bonds. Just being smart again about the portfolio construction.
So let's talk a bit more about what that portfolio looks like. I mean, where are you allocating your capital? Are there any particular sectors that you're especially bullish on?
Sure. And again, our overall thesis, just to frame it out for the viewers, is that we do think the economy is going to be very, very solid this year, somewhere perhaps north of 4% in GDP, very, very solid year. Earnings will be strong, as we just touched upon. But we have to look at that in the context of rising rates and inflation that we think is going to be persistently sticky because there's structural things going on now. not transitory, structural things going on in wages and structural things going on in shelter costs that we think that genie's out of the bottle. So we think that's going to be a challenge for the Fed. The Fed will remain behind the curve for the year. That said, where we're allocating capital is we're overweighting equity, underweighting fixed income. Again, not zero. We want a balanced portfolio. Within fixed income, the things we do like are very short durated, yield-oriented sectors of the market, like short duration, high yield. We also really like bank loans. And the particular reason there is we think default rates will be very, very low. And very importantly, bank loans have a floating rate structure. That means as the Fed raises rates, maybe upwards of 6 odd times this year or more, the coupon will reset higher and higher. So it's a very defensive way to play the fixed income markets. Within equities.
No, go ahead. Finish it.
Okay, sure. Within equities, we do like, as I said, value versus growth. You know, value's had a really tough time over a decade, and it's been all about growth. And of course, we have seen rates come down, and one of the benefits to the growth sector of the market. But that's clearly shifting. I think the year-to-date numbers for value versus growth show that both are down, but value in the S&P 500 is down about 2%, a little less. Growth is about 10% plus down. We think that continues to play out. Within value, we do like banking. Banking, we think, is a good place to be. Our assumption, again, being the economy doesn't roll over. We do like dividend-paying stocks. Dividends have been a very small part of total return in the last decade, 17%. Historical average is 40, almost 50%. We think dividends will be a much more important component of total return for 2022.
Need to get the full picture on the equity side of things. Thanks so much. Cliff Corso, Advisors Asset Management President and CIO. Thanks so much for stopping by. On the other side of this break, red hot inflation costing American families. We'll reveal just how much the average U.S. household is spending next. we've been talking a lot about inflation on the financial news networks, and the latest reading that we got from the Consumer Price Index last week showed prices in the United States rising by 7.5% on a year-over-year basis. And you don't need to look farther than this chart to know prices are increasing. But that 7.5% figure is a little bit of a nebulous number. What does that mean for the average household? Well, our next guest has actually crunched the numbers and says that inflation at the levels now are costing the average American household $276 per month. Ryan Sweet is that analyst from Moody's Analytics, Senior Director of Economic Research. Ryan, great to have you on the show this afternoon. Tell us a little bit more about how you arrived at this number. Where are the categories where American households are seeing the sharpest price increases?
What we did is we looked at the consumer expenditure survey. It has a lot of granular detail on household spending patterns. When we look at the average basket that consumers were purchasing in 2020, and then we look at what's the difference between their expenditure patterns based on inflation at 7.5% versus 2.1%, which was the average in 2018 and 2019. And that difference adds up to about $276 per month, which is a big burden on households. But again, this is average. Everyone's consumption basket is different. So for example, if you look at my household, we're feeling the pain of higher diaper prices a lot more than many others. But those at the lower income part of the distribution, they're feeling a lot more of a cost because of their spending patterns on gasoline and energy, other energy related goods. Whereas higher income households, their costs, there's still a noticeable cost around $200 per month. But it's less of a burden than on the lower end of the income distribution.
Yeah, no question. Energy, gas specifically, a big pain point for a lot of Americans. I wonder where rent falls into that category. How big of a jump have you seen if you're looking on average?
We haven't seen a lot yet. And that's partly because of measurement issues. So rents that we're seeing now, if you look at alternative data, the real-time data on rents that Americans are paying, they're going up very, very quickly. That won't show up in the Consumer Price Index, which is that the measure from the BLO, the Bureau of Labor Statistics, at 7.5% that we referenced earlier. For another few months, rents measured by the CPI will probably peak this summer at 6% year over year, which is a pretty sizable increase. That's going to offset some of the disinflation that we're going to see from the goods segment of the economy. Because when you break down that 7.5% year over year gain in the Consumer Price Index, a good chunk of that is in energy, probably 2 percentage points. Another 2.5 percentage points are coming from supply chain constraint components. So think audio, video, new and used cars. And that's really driving a lot of the inflationary pressures that we're experiencing today. So if you strip those two parts out, supply chain issues and energy, we have inflation overall running around 3%, which is elevated relative to the Fed's target, but it's not a glaring disconnect as what we're seeing today.
Ryan, when people think about inflation, they of course think about the price tags that they see at the store when they buy goods. But how about for services? Because there's an argument that as the economy reopens, people feel comfortable going out again. Maybe some of that shift will go over to services, and that could be disinflationary if prices are lower. But just anecdotally speaking, the price of my haircut went up. So are services also seeing these types of trends?
We'll start to see more service inflation this year. So we're going to see the pandemic really roiled spending patterns. So for the most part, pre-pandemic, consumer spending was pretty much the bulk of it was in consumer services. So haircuts, sporting events, movie theaters. With the pandemic, people hunkered down, and that led to a shift in consumption away from services to goods. So stuff. We're buying a lot of things, cars, bedding, furniture. And that drove a lot of those prices. So goods prices really jumped. And that's been where the bulk of the inflationary pressures have been coming from recently. That's going to flip. So we'll see services inflation accelerate, but at the same time, we should see goods inflation really begin to moderate. So it's going to be slowing, which is disinflation. So on net, I think by the end of the year, we should see growth in the Consumer Price Index go from 7.5% where it was in January down to closer to 3.5% by the end of the year.
Moody's Analytics Senior Economist Ryan Sweet, it's good to talk to you today. Appreciate you stopping by. Coming up, Super Bowl or crypto bull. The big game showing yet another reason why investors can't ignore crypto. Our next guest says digital assets are too pervasive for financial advisors to dismiss. Financial planning guru Rick Edelman is going to be joining us with his hot take on the other side. Welcome back to Yahoo Finance Live. We are seeing all three major indices really crawling back here. The Dow still down about 87 points, but well off of the session lows. The S&P 500 now just dipping into green territory, trading pretty flat right now, while the Nasdaq continues to lead the gains in the session. Well, roughly 20% of Americans say they've invested in, traded, or used cryptocurrency. At least that's according to Pew Research. But our next guest says a third of all adults in the U.S. will own crypto by the end of the year, and it's time for financial advisors to catch up. Let's bring in Rick Edelman, the Digital Assets Council Financial Professionals founder. We've also got Yahoo Finance's David Hollerith joining in on the conversation. Rick, I feel like the last time we talked, you were talking about the fact that financial advisors, whether it was a 1% exposure or 2% exposure, needed to start including crypto in some form in the broader portfolio. How do you view that mix right now?
Yeah, my attitude remains unchanged. There's no question that this is a new asset class, the first new asset class since the discovery of oil about 150 years ago. So we need to recognize that this new asset class is additive to a portfolio. It assists in diversification. It improves returns and lowers risk. And so there's no reason not to include this. But because it's still so new and developing and emerging with a lot of uncertainty around the world in terms of government reaction, et cetera, let's not get carried away. So a 1% allocation, 2% or so, that's plenty. You don't need to do 10, 20, 50% of your portfolio. Have some exposure, get off zero. That's the main message.
And Rick, David here.
I've spoken to a number of financial advisors, and they've sort of expressed, a desire to wait until the approval of a spot ETF type product. But you've also pointed out that it's a lot easier than it used to be for people who are financial advisors who are interested in allocating to cryptocurrency. Now, why is that? Why has that changed?
It's really very foolish to wait for the Bitcoin ETF. Most advisors are in agreement that there will be a Bitcoin ETF and that the price will rise when that happens. But why wait? If you think there's going to be an ETF and that the price will rise with it, that means you should be investing now before that happens. And the good news is, as you noted, today there are so many different ways you can invest in crypto that didn't exist even as recently as 2 or 3 years ago. You can invest, as you note here, the ProShares Bitcoin Strategy ETF, which is a Bitcoin futures ETF. There's 5 of those products now available. You can invest in publicly traded stocks like Riot Blockchain and Marathon Digital, which is our publicly traded Bitcoin miners. You can invest in Coinbase, which is a publicly traded Bitcoin and crypto exchange. There are proxy stocks like MicroStrategy, which owns $7 billion worth of Bitcoin, and its stock price tracks the price of Bitcoin. There are OTC securities from Grayscale, Osprey, and Bitwise that allow you to invest in funds that trade over the counter that invest directly in Bitcoin or Ethereum or certain other securities. There are a wide variety of ETFs, dozens of them now, that invest in what we call the picks and shovels approach. In other words, not buying crypto, it's investing in the companies that are supporting and developing the crypto technology. Think back to the California gold rush and Levi Strauss. He didn't try to mine gold, he just sold blue jeans to the gold miners. So that's what these picks and shovels ETFs do. There are so many different ways that you can invest today that there's absolutely no reason for an advisor to say, sorry, I can't help you, or gee, I need to wait for an ETF. That is simply outdated, incorrect thinking.
Rick, Brian Chung here. How about the regulatory angle to all of this? Because yes, even though there might not be a bad reason to invest off of that thesis, I mean, there is some uncertainty over how the SEC might approach cryptocurrency regulation down the line as they continue to work on that. And then there's also just the rules that we have right now around registered investment advisors and the fiduciary rule regarding making sure that you're perfectly aligned with the risk tolerance of your clients. So how do you balance those things in an uncertain regulatory environment?
Yeah, I share that concern, Brian, and that's why just 1 or 2%. The point is, we don't need to be pristine and saying this is absolutely going to fail, therefore do 0. 1% allocation can give you the exposure needed. If this does do well, you'll participate. But if it does blow up for whatever reasons may yet occur, you're not going to hurt yourself. You're not going to prevent your financial security from occurring because you had 1% of your portfolio in digital assets. More importantly, we have to recognize what is going on in the regulatory landscape. The SEC, the IRS, FINRA, CFTC, FinCEN, Treasury, Congress, everybody everywhere in the regulatory and legislative environments are all saying, we're embracing this. It's not a question of will we allow it or will we ban it? It's now a question of how. It's kind of like cigarettes and alcohol and airplanes. We're going to allow them. We're just going to make sure that it's operating safely so that we're not putting consumers in a position of being hurt through scams and all the other kind of problems that we've seen in any emerging environment in its early days. So those who are saying it's too early, their thinking is frozen in 2013. That is not the case today. When you've got members of Congress who are buying crypto, when you've got hearings on Capitol Hill, which is trying to figure out how to move forward, when you have mayors at major cities in the country taking their paycheck in Bitcoin, this isn't going to be regulated away. This is going to see setting up guardrails to protect us. That's all.
As a follow, I guess there is kind of the question about who should be initiating that conversation, right? Because again, there are guardrails around when an investment advisor can recommend something versus a client saying, I would like to get involved into something that's risky. So how much initiative does the financial planner actually have in a situation to say, hey, I took a look at this asset, it's crypto, but you might like it, versus you can't do that because of the fiduciary rule and maybe not being aligned with your client's interests?
It's actually being shifted now, Brian, which is fascinating. 5 years ago, the question was, why are you recommending crypto? Now the question is, why aren't you recommending it? In fact, some compliance attorneys that I've been talking to have been acknowledging a very different change of attitude at the SEC and with other regulators, saying, why are you not doing this for your client? You've got to give us a legitimate reason, not just, oh, it's a beanie baby or a tulip bulb, or who's some kind of scam or fraud. That argument worked 5 years ago, 10 years ago. It's not really legitimate today. If you're going to serve your fiduciary obligation, serving your client's best interests, you need to have a legitimate reason for not recommending this asset class. Merely because, oh, I don't believe it, I don't trust it, it's premature, or I don't understand it. That isn't fulfillment of your fiduciary obligation. The challenge for advisors today is to get the knowledge they need so they can make an informed decision on benefiting their clients. That's why we created our certificate in blockchain and digital assets here at DAC FP, to teach advisors what they need to know so that they can serve their clients' best interests, whether that means buy or not buy. One final thing to keep in mind, Brian, in a recent survey by Bitwise, 2/3 of financial advisors said, my client is buying crypto, but they're not doing it through the advisor. And what that means, they are running into problems. They could be getting scammed because they don't have the advice, the counsel, the hand-holding of their advisor. They could be buying too much or buying it from the wrong places too expensively. Getting engaged as an advisor with the client, that is how you fulfill your fiduciary obligation.
And Rick, in that same Bitwise survey, it looked like financial advisors were maybe 15% of them were actually allocating client portfolios to crypto now. What do you expect that number to be, maybe say in a year from now?
It'll double. According to that same survey, roughly, as you said, about 14% are owning crypto, recommending it, but there are another 15, 16% plan to do so this year. But there was a more troubling number in that data. About half of the financial advisors surveyed said they personally are investing in Bitcoin and other digital assets, half of them, but only 14% are recommending it to clients. To me, that is a major fiduciary violation. I think it's a good enough investment for me to own it personally, but I'm not going to talk to you about it or recommend it for you. How does an advisor justify that behavior? And how are they going to defend themselves to a client who asks them, do you own this? When did you buy it? And why didn't you talk to me about it? Those are significant fiduciary questions that advisors are going to have to answer.
Yeah, certainly. Very important questions indeed. Rick Ellerman, for a fantastic conversation from the Digital Assets Council of Financial Professionals founder, and also Yahoo Finance's David Holler. Thanks so much, guys. On the other side of this break, we'll take a look at stocks on this Valentine's Day. Not as much red as we saw at the top of the hour, actually coming back a bit slightly. Jared Blickery will join us to break down all of the market action after this. Welcome back to Yahoo Finance Live. Let's take a look at markets right now, which are mixed. Actually, paring back some of the losses that we had seen at the beginning of the hour. And some U.S. stocks that are tied to the travel industry are actually moving a lot. This is after the Russian foreign minister said that talks would continue with the United States and allies, which suggests maybe a little bit of an easing of the tension between Ukraine and Russia. Yahoo Finance's Jared Blickery is here with more of the market action. So a lot of travel stocks on the move right now, right, Jared?
Yes, as you can see by the Wi-Fi Interactive behind me here. We got Avis Budget Group, that's a leader, that's up 7%, reporting earnings this week. Hilton, that's up 2.5%. A lot of these hotels, by the way, have been hitting highs, record highs very recently. Let's check out Hilton worldwide. That's actually its record high from the 1st of January, but really encroaching on it right now. Airbnb's up 2.5%, but someplace where we're not seeing quite as much green is in the pharmaceutical sector. In fact, it's mainly about the mega caps today. We're seeing them surge, but not a lot of these. And if you take a look at the winners and losers, most of the losers, the biggest ones, the laggards, are the vax stocks. So we're seeing Moderna off 12%, Novavax off 9%, and BioNTech off over 8%. But I want to get back to the mega caps, and we can find that in the NASDAQ 100. And we see Amazon up 3%, Tesla's up over 3.5%, Nvidia 3.5% as well, Alphabet 1%. So the big guys doing pretty well today. And a lot of that has to do with what's going on in the semiconductor sector. This industry group here, we're seeing, we covered Nvidia, AMD up 4%, Qorvo up 3.5%. A lot of these names will be reporting over the next few weeks, so we'll be keeping an eye on that. Looking at the software space, it's a little bit more mixed. You do see some red on the screen. IBM down 2%, VMware down 1%, but Zoom Video up 3.5%. Haven't talked about them in a little while. I want to go back to our sectors and see what's going on inside them today, and we can see really the mega cap. So consumer discretionary, that's XLY, that is in the forefront. That's up over 1.5%, followed by tech and communication services. All those are the mega cap sectors. To the downside, we're seeing energy take a little pause here. It's down over 2.5%, followed by utilities and healthcare. Now, taking a look at the bond market, this is pretty interesting. We do see the 10-year T-note yield up 6 basis points. We're also seeing some of the other tenors up as well. The 5 years up 7, and the let's check out the 30-year as well. That's up 6 basis points. Generally, when we see the yield curve marching higher, we see value stocks outperform. Not the case today. It's growth. So a little bit of a confusing sector leadership there. Just want to close by looking at the VIX. Still a bit elevated. It was knocking on 30 last week. We'll have to see if we get another spike this week, but it all really comes down to the S&P 500. 4,400 is one of those critical levels. You can see we dipped just below that earlier today, and on a 2-month basis, there we go. You can see we broke the trading range last week, and we're just kind of hovering underneath that support zone. So if we pop back above 44.50, probably in the clear, but I don't like the price action down here. Probably want to revisit these lows that we had from a couple weeks ago. Guys?
Okay, Jared Blickery with the market action. Thanks so much for that. Coming up, real world or the virtual world? Super Bowl ads pit two big tech giants against each other as they offer very different takes on the metaverse. We'll explain on the other side.
While the others look to the metaverse and Mars, let's stay here and restore ours. Yeah, it's time to blaze our trail. Because the new frontier, it ain't rocket science. It's right here.
Matthew McConaughey in that ad, Super Bowl ad for Salesforce. Of course, we've been talking a lot about cryptos and EVs getting mentions. The metaverse also got a few mentions here, but probably safer to say there are very different takes coming from that Salesforce ad you just saw, and then, of course, Meta, Facebook. Let's bring in Yahoo Finance's Dan Halley for a look at those ads. Dan, I wouldn't necessarily say that the Salesforce ad was a take as much as it was a dig at Mark Zuckerberg.
Yeah, I would probably say the same thing, Akiko. Basically, the Salesforce ad kind of making light of the metaverse in general, and kind of pushing that as the new kind of technology that everybody should be focused on, rather than as the Salesforce ad kind of pointed to, I guess focusing on CRM technology or the Earth, or just Matthew McConaughey being, as Val just pointed out, our producer, a Jeff Bezos / Elon Musk stand-in. But yeah, this was kind of the coming out party almost for the metaverse. And it really didn't go that well. We had Meta having that ad based on, I guess the Chuck E. Cheese animatronic band, and kind of going into the future where now they meet up rather than going to junkyards in the metaverse and get to party there. We also had a look at the Foo Fighters concert after the Super Bowl, which was in Meta. That's the Horizon Worlds kind of meetup place in their metaverse. When you use the Oculus Rift or Oculus Quest 2 rather, and that was kind of not all that interesting. I mean, I jumped in. I got to watch the Foo Fighters play on what was essentially a screen in front of you in the metaverse, and you can talk to people next to you, but it really wasn't anything all that interesting. It's never going to replace a real concert, but I really kind of wanted a little bit more out of it. And then Miller got in on the act too. They had kind of a Miller Lite tavern that was set up before the game, where you would go in and you would get a look at the ad beforehand. You could wander around and I guess tap game console machines, the old arcade setups. You could press them and they just made weird noises. So it wasn't really anything very interesting, but they did buy space in Decentraland to do this. So it kind of was a coming out party, but I don't really think it was exactly what a company like Meta really wanted out of this.
I have some thoughts about the Salesforce thing, because it certainly was a dig at Facebook, but I just thought it was funny for a CRM company to be doing that. Like, it's not like Salesforce is that much of a real verse experience. It's not like people on the street are like, oh, Salesforce is something I use on a daily basis. Like, I thought that was kind of funny. It'd be better.
I'm going to jump in here, Brian, because I think it's not just about their services. If you think about Mark Benioff, who's obviously, led Salesforce, I mean, he's very, very much focused on a lot of social causes. He's very big on climate issues. I mean, I think this is an ad that goes beyond just here's what Salesforce has to offer. It's more about the values of a company, right? That we are focused on these things while Elon Musk tries to explore Mars and Mark Zuckerberg's trying to go into the virtual world.
Yeah, but I mean, I think that the average viewer is not that dense to know the background. Like, people don't even know who Mark Benioff is. I mean, I just don't it's a good ad. It's interesting. It's provocative, but I just don't know if people have the background to have seen that ad and go oh, wow, Salesforce Facebook beef, right? They're not, I don't think they're dialed into that. I don't know. Maybe that's just me.
I kind of took the same thing away where, it was basically cool. I thought it was an ad for Interstellar at first, because Matthew McConaughey was, an astronaut. And then when he started talking about the Earth and how we shouldn't focus on the metaverse, I was like, oh, okay, cool. Matthew McConaughey, he's a climate kind of change person.
Yeah.
He wants to make sure that the Earth is treated better and things like that. So,
And Dan, the one takeaway is going to be Matthew McConaughey wasn't an ad. Are people going to remember Salesforce? Are they going to even remember that there was a dig at Facebook? That's the conclusion. You put Matthew McConaughey and people remember the ad. We're going to end on that note, guys. We're out of time here. We've got much more to come here on Yahoo Finance Live on the other side. Keep it right here.
Russia-Ukraine tensions remain high amid a possible strike, even as more talks are on the table, according to President Putin. What does it mean for markets and the Fed's response as the St. Louis Fed's James Bullard reaffirms his case for front-loading accommodation removal? A days-long standoff at one of North America's busiest cross-border trade arteries is over. The Ambassador Bridge linking Windsor, Ontario, and Detroit has reopened, but divisions remain and left the already challenged auto industry reeling. We'll look at how car makers pick up the pieces. And Super Bowl 56 was a nail-biter coming down to the wire before the LA Rams pulled out the win. But this year, the odds are also getting a lot of buzz as old stalwarts and newcomers showed up to the party with a ton of star power and special effects. We'll speak to a company that worked on about a third of those spots. Good afternoon, everyone. I am Karina Mitchell, along with my co-anchor, Alexis Christoforous. Happy Valentine's Day to you and day after the Super Bowl. And Alexis, let's just say the Dow is behaving right now like the Bengals and the NASDAQ are the LA Rams.
I guess you could say that. Absolutely. We've got ourselves a mixed picture right now. As you said, Karina, investors continuing to monitor the Russia-Ukraine situation, as well as more commentary from St. Louis Fed President James Bullard, who reiterated that he would like to see the central bank front load those rate hikes in response to inflation. But he added that should not be a threat to the economy or the stock market. Not so sure investors would agree. We've got the Dow off 62 points. The broader market, though, has found its footing. The S&P hanging near the flat line, but the NASDAQ composite up 83 points. Want to get a check at the bond market because we are continuing to see the yield on the 10-year hovering around that 2% level, now at 2.02%, with the 30-year at 2.32% as investors in the bond market anticipate those interest rate hikes this year from the Fed. Let's take a look at the S&P 500 sectors because we've got 4 out of the 11 sectors in the green today. On the plus side, communication services, consumer discretionary. Also on the plus side, we've got technology. On the downside, though, energy, we know a recent winner, is pulling back today along with healthcare and utilities. Let's toss it over to Jared Blickery, who is standing by with the charts for the very latest. What are you watching today, Jared?
It's really about the mega caps today, and you were just going over the sector leaders. All 3 of these are representing those mega caps. Consumer discretionary, XLY, that is the biggest leader today, up almost 1.5%, and that contains Amazon. Amazon up about 3% there, and we can see pretty close to its session highs. Also taking a look at Alphabet, that's up over 1%, Tesla up over 2%, Nvidia up over 2%, and AMD up over 3%. So we are seeing some outperformance by a lot of the growth names and also by some of the names that have been beaten down this year. So the bond market is looking pretty interesting. You were going over some of the moves in the 10-year. We are seeing a lot of these tenors move to the upside. Here's a 5-year up 7 basis points, and here's the 10-year up 6 basis points. But as we've been talking about, when we have the yield curve going higher, usually it's the value and cyclical stocks that do well. Not the case today. So we're going to go back to our heat maps and chart the day's movements. Let's take a look at the Dow here. We're seeing kind of a mixed picture. We took care of Apple and Microsoft. Those are those tech names. Nike up nearly 2%. So is Disney. That's up 2%. American Express up 1%. So the reopening trade actually doing pretty well today. And to see that, we're going to take a look at our travel heat map. And we're seeing some really outperformance here by American Airlines, United. They're up more than 1%, almost 1.5%. Hilton up over 2%, and Airbnb up 2% as well. The star here, though, is Avis Budget Group. That stock is up about 6.5% ahead of its earnings. That's going to be released this week. You can see over the trailing year, up 331%. So this former meme stock, also one of the transports, we'll have to see what comes of it this earnings season. Also taking a look at Bitcoin here, we're going to go back to this heat map, and I believe, there we do. We can see Bitcoin up about 0.75%, still in a minor short-term uptrend. This is a 1-year look, but I'm going to dial this back to a year-to-date look, and you can see the price action recently. We have a series of higher highs and potentially higher lows, but we have to see how this resolves itself. Just looking incrementally bullish here after touching 32,000, you could consider that a test of that high, or excuse me, of that low that it hit way back here, 28,000, 30,000. So have to see how this develops, but having the beginning, the very beginning of some bullish price action in Bitcoin.
Okay, Jared Lickrian, looking very snazzy in that
Thank
jacket.
you.
We'll see you back in just a little bit. We're going to stay on the markets and bring in our next guest, Eric Kuby, North Star Investment Management Corp. CIO. Eric, thanks so much for being here today. So listen, you take your pick. Hot inflation. Crude looks like it's set to climb well over $100 a barrel, a potential war brewing. It is a complete mess. In all of that, the NASDAQ climbs higher. What do you make of it all?
Yeah, well, I mean, I think that all those negatives that you discussed have been out there, part of the narrative for a little while. And I think that the market is digesting those risks. And on the flip side, you are seeing, terrific corporate earnings. You are seeing the pandemic, kind of beginning to wane pretty rapidly. So there's some positives to go along with those negatives. The market climbs the wall of worry. So there's a lot of worry and a lot of climbing to be done.
Yeah, so the St. Louis Fed President James Bullard says we need to act more aggressively, right? And interest rate hikes need to go up by 100 basis points by this summer, by July. How worried are you that the Fed is behind the curve? Because we've heard nothing about QT yet, and we're still buying bonds.
Well, the Fed is, I think, pretty clearly behind the curve. It has been for quite a while. And I do think that rates are going to continue to rise. And I think the market expects that. The flip side of that is if the economy starts presenting data that shows softening, significant softening, I think we've learned over the last few years, that the Fed will pull back on that hawkishness. So inflation's been hot, but why is inflation hot? It's really hot because of supply disruptions, just a lot of problems related to the pandemic. So I actually believe that the positive bullish case is that a lot of these issues that have really caused these inflationary pressures are going to abate as the year goes on, and that's going to allow for that lower inflation data will allow for less aggressive Fed policy once rates get way off of zero, maybe close to 2% on the short end.
So then do you think we've seen peak inflation now? When do you see it moderating? And then I'm wondering how big a concern is wage inflation?
Well, yeah, I mean, the thing about wage inflation, unlike the other areas of inflation, are that, once you raise wages, it's hard to go back. We talk to a lot of smaller companies. We focus on small cap companies and talk to management. And that's one kind of consistent message that they say is that, that the wage pressures that they're having, they don't think that those will likely go away. There will be more people re-entering the workforce. That will make that a little bit easier. And we've seen a little bit of that last month with the labor force participation rate. So there's some positives there. But I think that from our talks with companies, I think we're close to the end of the cost pressures rising. So I think that you'll start seeing inflation getting less problematic, over the next couple of months, although not immediately.
Eric, a lot of people are starting to feel a little bit jittery. So I'm wondering, there is a consensus out there that says cash is king and perhaps it's time to sit out. Do you agree with that or do you disagree? And if so, where do you think looks good to invest? I know you mentioned small caps, any particular areas in small caps and any other sectors as well?
Yeah, I mean, so exactly. So I think that when people get fearful, that's the time to shop for bargains. And we think that this would be the wrong time to increase your cash percentages. Hopefully people had, reasonable allocations, going into this downturn. The Russell 2000 did decline 20% from its high in November. And we think that this has created a lot of bargains in the small cap area. We tend to think that it's company specific. There's winners and losers. There's lots of different types of companies in there. But, we think there's a lot of really good companies with great balance sheets in the small cap world that are a lot of consumer stocks, a lot of industrial stocks, that we think have gotten unreasonably inexpensive, great bargains after this big sell-off. So we would encourage people to look at small cap, particularly small cap value, which has been a really tough area, but I think getting better this year. And I think that I think the future is bright for, again, small cap, the financials, the consumers, the industrials. I think there's some really great bargains in there.
Eric, I'm really interested to know how you feel about commodities, how you're looking at them right now, particularly metals like aluminum and nickel and gold as well.
Yeah. So, we think that the commodity markets, supply and demand is obviously the big factor in commodity markets. There's been a real constrained supply on a lot of these commodities, and so you are seeing prices rising. We typically have not been very constructive about commodities in general, but over the last year and a half, we turned positive and have tried to add gold to most of our portfolios. We do think that the gold market could continue to rise. We've looked back in the past interest rate increase periods, and contrary to the common misperception, gold has actually done quite well. So we like gold in particular in the commodity area. Continue to be underweight traditional energy. We think that that's showing a lot of fear over Russia, and again, also these what I think are short-term supply issues. So we are, not positive on, crude oil per se. Dabbling a little bit into clean energy because we do think that the higher price of oil, makes clean energy areas interesting again. They've suffered really dramatically, so we think there's some bargains there as well.
Okay, still a lot more to ask you, but unfortunately we're out of time. We will have to leave it there. Eric Kuby, North Star Investment Management Corp CIO, thanks so much for your perspective today. And we want to help you step up your own investment strategy with a free 14-day trial for Yahoo Finance Plus. You can get expert research reports, actionable investment ideas, advanced portfolio tools, and much more in a sleek ad-light experience. Just check it out today at yahoofinance.com/plus. And we've got much more. I'll throw it over to my colleague, Alexis.
All right, thanks a lot, Karina. Coming up, are we moving from pandemic to endemic in the fight against COVID-19? A medical expert weighs in next. New COVID cases are plunging, and the U.S. appears to be on its way out of this wave of the pandemic. And even the country's chief doctor, Anthony Fauci, says the country is headed out of the, quote, full-blown pandemic phase of COVID-19. Joining me now is Dr. Jeremy Faust, Brigham and Women's Hospital emergency medicine physician and editor-in-chief of MedPage Today. Dr. Faust, good to see you. Last week, we heard from the World Health Organization warning that another variant, perhaps more deadly and easily transmissible, could emerge. So I ask, are we moving from pandemic to endemic, and are we prematurely lifting some of these COVID-related restrictions?
Thanks for having me. I think that anytime a new variant comes onto the scene, it's just a lot of question marks. It could be a milder variant. It could be that the immunity that we have from vaccination and previous infections is going to protect us well enough. It's just always a wild card. And the question as to whether or not we are in some sort of endemic phase is really a matter of definitions. I think that my colleague here in Boston, Bill Hanage, said it quite well when he said that we seem to think that endemic is synonymous with the level of death we are willing to just accept. And in fact, endemic really has a different meaning. It means that it's not, the disease is not causing an outsized effect on the population. That's not happening. We are not endemic yet. We're still having far more deaths, not just from COVID, but all-cause mortality is higher than ever right now, as opposed to pre-pandemic. So I don't think we are in a safe place right now. We certainly are a lot better than we were a month ago. But when you look at the numbers, thousands of people dying per day, and it's not just rearranging death certificate, deck chairs. It's more deaths than usual. COVID is still driving that.
Well, having said that, doctor, and hearing that Walmart, one of the largest employers in the country, now telling its fully vaccinated workers that they do not need to wear a mask. They can still wear that mask at work if they choose to, but they're not mandating it anymore. You'd have to think other retailers and other stores in general, companies in general, may follow Walmart's lead. What do you think about what Walmart did over the weekend?
I think that our fatigue is setting in, and sometimes we think with that part of our brains and not necessarily the brains of public health. That's understandable. I'm really focused in my work at looking at whether what we do threatens hospital capacity, because I think that is something that even the most tired of us are willing to think about. I personally, and many of us, are willing to still make changes in our daily behavior if that keeps our local hospitals safe. And I think that's really important. There are still 100 counties or so in this country out of about 2,400 that we can track that have hospital capacity either threatened or already over capacity in terms of what is considered safe. In places like that, I would not recommend anyone take off their masks, because not only are you at risk, but you are spreading a virus more likely that can put local hospitals at risk for all care. And hospitals are critical infrastructure, and that's something that's part of security in a sense. So in those places, I think it's very premature. And in other places, there's a sense of, what's normal. And I'm not sure we have that figured out yet, and I won't opine, but because my big concern is that even in places where hospital capacity is still threatened, we're still not really doing it correctly.
I remember earlier on in the pandemic, there was talk of needing to reach herd immunity, and then we sort of would have rounded the corner with the pandemic. With so many people having gotten Omicron over the Christmas holiday and the New Year holiday, do we have herd immunity? And what does that even mean now for our overall fight against this?
I think herd immunity is another concept that's been batted around without a lot of specificity of definition. In my view, what I'm looking for is herd protection. I want to know that if you get exposed and infected to a variant of coronavirus, that you will not have any bad outcomes. You won't have any long-term consequences, that it really has been reduced to a flu or a cold, which it certainly isn't unless you have been vaccinated. Plus, some degree of exposure on top of that can be useful. And I would recommend people go in that order. Because, again, we may see reinfections over time, and some viruses just are like that. We can't just be completely immune to them. Coronavirus is certainly like that. But we can be protected from the worst consequences. So I think that we'll see whether the Omicron wave did have this one upside. It's been terrible. The all-cause mortality has just been astronomical. But we'll see whether or not all these infections lead somewhere better in terms of having that protection against severe disease and long-term consequences. I don't think we know yet, and I think that there's been some pessimism on that because of the antibodies, the antibody responses that it seems to evade, but I don't think we know yet. So I think it's an open question.
last week we got some news about booster immunity, and now they're saying that protection may wane after 4 months. So how likely is it that we're going to need a fourth shot? And how often do you think we're going to have to get a booster shot? Because talk about mask fatigue. I think people just have, vaccination fatigue.
Absolutely. And I think that the way that the booster rollout happened was a little bit unfortunate in terms of how we've looked at the data. By the time we started vaccinating and doing boosting, by the time we started boosting here in the United States, it was already very clear from the Israeli data, if you looked carefully, that the booster was waning with respect to its effect on infections. And I've argued, as many have argued, that we shouldn't really be using boosters that way primarily. Certainly there's a role for that in some situations, immune compromise or high risk populations. But for the most part, I think we should be thinking about boosters in terms of protection against severe disease and long-term consequences. In that manner, boosters don't wane nearly as much, just as the 2-dose series doesn't wane that much unless you are an older person. So 50 plus, 65 plus, the third dose is absolutely necessary to protect against that long-term and severe disease. For younger people, the booster certainly decrease infections, but as you said, very temporarily. And this is something that we've known since September or October, if you just looked. But I think that because people were so set on getting everyone boosted, that was sort of downplayed. But again, I think that boosting people over 50 is really, really essential for outcomes. And for people under 50, it can help in terms of stopping spread and for people with severe risks.
And Doctor, we saw these truck protesters in Canada protesting the vaccine mandates there. Today, several thousand New York City workers will be told whether or not they have a job, because some of them, I think it's about 1%, have not yet been vaccinated. What would your message be to those people who are saying, look, this is my right to choose to not get the vaccine?
Well, I think that, as I said before, vaccination is about a lot of things, but one of the things it's about, if you want to think about public policy and health policy, which is something that I do think a lot about, is about protecting the community, our public health infrastructure. If the unvaccinated are clearly driving the hospitalization waves that we've seen all over the country. So we know that so-called natural infection or previous infection isn't enough to keep you out of the hospital. It's either vaccination or the combination of prior infection and vaccination, which provides the strongest protection. Look, if we're trying to keep our hospitals safe so that we can treat heart attacks and a kid breaking his leg and going to the operating room and COVID, we need to keep the hospitals at a safe place. And the unvaccinated are the single greatest threat to that critical national security infrastructure, as far as I'm concerned, and as far as the Department of Homeland Security is concerned, quite frankly. And so I think that vaccine mandates are not just about protecting yourself, not just about decreasing spread, but also about keeping our resources safe for everybody.
All right, we're all in it together. Dr. Jeremy Faust, thanks so much for your insights today. Appreciate it. Karina?
Okay, and coming up, we speak with AMD about a new acquisition and the value add for the company. Stay with us. Welcome back to Yahoo Finance. Well, AMD just closed on its $35 billion deal for Xilinx. The acquisition boosts the company's efforts in computer processors used in data centers and wireless networks. AMD CEO Lisa Su joined Yahoo Finance Live earlier today to discuss the deal. Take a listen.
AMD has always been about high performance computing. And our vision of the world is that you need all types of computing to really serve customers and really think about what's next in the industry. So adding Xilinx is an incredible company. They've done extraordinarily well as a standalone company. Actually, both companies have done extremely well. But putting our two companies together is really a complementary set of markets, customers, and products. And so we're extremely excited about doing it. And as you said, it's been about 16 months, but we've been planning and we're absolutely ready to have a fast start on day one.
Lisa, what's going to be your message to those 5,000 Xilinx employees?
Well, I think our message is, again, two wonderful teams, two of the best teams in the industry coming together. 1 + 1 is going to be much greater than 3. And it really is, across, we're all about products, as you know, Brian. So building great products, ensuring that we continue to deepen our customer relationships across the board, and really, continue to build upon the great growth franchise that we have already built with AMD and Xilinx separately.
And to your point, you've had a lot of time, a lot of opportunity to plan out this integration. So now that the day is here, what are your first 3 top priorities here?
Well, there's a lot of excitement across our customer set as well as across the industry. And when we think about, the benefits of bringing the two companies together, again, for customers, it's about a much broader product portfolio, right? We now have, CPUs, GPUs, FPGAs, adaptive SoCs, ASIC capability that can go across the most important markets in the world. So, the data center market, the strategic assets that we have for the data center market, the communications market, where Xilinx is extremely strong, and AMD has assets that can work in those areas. Industrial, automotive, all of these markets need this collection of capabilities that we have, and we're going to be able to offer that entire portfolio to our customers, as well as build some really amazing and innovative products.
When you have been able to talk to customers over the past 6 months and just going through this integration process, not the integration process, just the planning process, what are you hearing from your customers? And do you sense a big pickup in business now that you've closed this deal?
We do sense, Brian, a lot of excitement for what we can do as a combined company. And when you think about, some of our largest customers, the cloud customers, what they're looking at is, really, what do you need for the next 5+ years? We've had tremendous success across, these large customers with our, CPU portfolio and our GPU portfolio. I think adding Xilinx adds some strategic assets, things like networking technology, which is very important for the data center business, adaptive SoCs, AI. We're really excited about enhancing our AI capabilities as a joint company. Those are some of the things that we talk to customers about. And I think, really the sky's the limit in what we can do together. When you have such talented team. I mean, we'll have over 15,000 of the best engineers, in the semiconductor industry. So it's just an incredible team that we're bringing together.
I think maybe it was 24 months ago, Lisa, where you outlined, perhaps it was an investor day, outlined 20% compound annual growth rate for AMD. Now that was before Xilinx. How fast is your company growing now that the deal's done?
Well, we're looking forward to updating our financial model, Brian, in the coming month. But what I'll tell you is, this acquisition is accretive in the first year for gross margins, for earnings per share, for free cash flow. So it's a very good deal overall. And when we look at growth rates, what we said at the time of acquisition is that we felt we could grow significantly ahead of the industry, 20% plus CAGR for the next few years. And we still believe that that's the case. And we are going to update our financial model shortly. But overall, both from a financial standpoint, a technology standpoint, and a customer standpoint, we think there are a lot of positives for us as we come together.
What is the state of the market right now? And you play in so many different industries. Let's start on the PC market. The PC market had a tremendous period last year during the pandemic. What is your outlook for it this year?
Well, I think the PC market, as you said, had a tremendous year. I mean, last year in 2021, as an industry, we shipped approximately 350 million units, which was amazing. We still see very strong demand coming in here in 2022, especially when you look at commercial and high-end consumer. We do expect that some of the lower end or education type products may be a little bit softer, just given the strength in 2021. But overall, we see it as a strong year for PCs, and within that, we believe that AMD will perform very, very well, just given the strength of our product portfolio.
Okay, well, that was AMD CEO Lisa Su talking about the acquisition of Xilinx. And Alexis, over to you.
Thanks a lot. Coming up next, the impact those trucker protests continue to have on the auto industry. The largest border crossing between the U.S. and Canada is finally reopened after a 6-day blockade by truckers protesting vaccine mandates and other COVID-related restrictions. But the shutdown is still being felt by the auto industry. Here with more is Bernard Zwicky, Research Director at the Michigan think tank Center for Automotive Research. Bernard, it's good to see you again. Look, the auto industry was already dealing with so many other crises, right? The semiconductor shortage, the pandemic, labor shortages. How much do these protests really negatively impact the industry?
So yes, it is absolutely another cumulative crisis that you're adding onto the stack that you already mentioned of the various shortages and impacts that we have had. But, for me, I think the bigger issue is not so much how much did this particular border crisis sort of add on to those. For me, it's kind of the flip side of the coin that's more interesting, because normally when you have a supply chain disruption like this was, essentially you can get a lot of it back by building vehicles on overtime, picking up some of those production volumes and recouping what you lost. However, that's much harder to do when you're also dealing with the semiconductor shortage and all those other issues. So for me, it kind of gets you twice. One, it's additive to the crises, but two, the other crises prevent you from having as strong a recovery as would normally be the case when you have this kind of disruption.
When you look inside the auto industry, who was impacted more by those protests at the bridge? Was it the automakers? Was it the suppliers? Were they both evenly impacted?
I would expect the impact to be much larger on the suppliers, simply because they're already in a more vulnerable state. As a result of the pandemic and the semiconductor shortages, automakers have focused on producing expensive vehicles, high transaction values. And so, some of them have had record financial results over the last couple of years. And that hasn't been true for suppliers because their business is dependent on volume. So, the fact that the industry is making more expensive vehicles hasn't really benefited them the way that it has the automakers. And so they're already in a more vulnerable position when a crisis like this hits in this current industry. Now, when you look at the sort of the stratification of suppliers, this really affects them all, because even if you're a supplier that's sort of on the American side and you're supplying an American plant, you yourself have no disruption. You can ship all the parts you want tomorrow. However, just the fact that that plant isn't producing is going to cost a whole lot of economic activity at all those supplying plants and related businesses throughout each of these communities.
I know that Ford and GM had some plants that were temporarily closed because of the situation at the bridge. Do you have any idea the status of those plants now?
Yes, and Ford as well as GM, but also we'd heard announcements from Toyota and Honda, and so and Stellantis as well. And so what I think is going to happen is initially it's like throwing a pebble into a pond. The closures of these plants kind of started near the border area because that's where that supply was on the tightest timeline. There's no buffer really like there is in the outlying areas, and so the closures started near the border and they kind of spread out the longer that this situation went. And I expect that the reopenings of these plants are going to follow a very similar pattern, where the plants that are closest to the border can be resupplied the soonest when the border is open, but it'll take a longer time for the transportation system to deliver the components to the more outlying plants. And I've seen reports of plants going down as far away as Kentucky, and by the end of it, it could have been even farther away.
Wow, there really is like this cascading effect. So look, we know it's been a familiar story. These tight inventories have and strong demand for cars, both used cars and new cars, continuing to send car prices to record highs. What can consumers expect? Springtime's a big time to buy cars. That's right around the corner. What would your advice be to somebody who may be thinking about buying a new car, but doesn't have to buy a new car right now?
Well, the business that I'm in, it kind of pains me to say it, but my advice would be, if at all possible, wait. We do have record high transaction values, well over $45,000 per unit. Now, we've never been in this kind of territory. And yes, I think what gets lost in the conversation quite a bit is we talk a lot about the supply disruptions and, you don't produce as many vehicles, and so there are fewer available to buy, just as there have been for years, well, for 2 years now, as a result of the pandemic and semiconductor shortage. So availability is limited already. It will be more limited if, this sort of a thing should come back. Hopefully the 6 days that we had didn't impact those levels too much. But the other side of that, the one that I don't think gets enough attention, is just the cost. Because in a simple supply and demand scenario, scarcity drives up cost. And so consumers are already facing this record market. And anything like this that should happen only makes those vehicles more expensive to buy. And, we've seen consumers turn to a variety of solutions. They're hanging on to their vehicles longer. They are financing vehicles now as long as 7 to 8 years, just to get those payments to be more manageable. But frankly, this situation is not going to be tenable forever. Eventually, we're going to have to come to grips with the fact that we are pricing a good deal of the American people out of the automotive market.
All right, it's a fluid situation for sure. Bernard Swicky, Research Director at the Center for Automotive Research. Thanks so much for being here today. Karina, I'll toss it back over to you.
We are going to switch gears, and coming up after the break, last night's big game wasn't the only source of entertainment. Many of the Super Bowl ads also packed a punch. Ahead, we speak to one company that had a lot of skin in the ad game. Welcome back to Yahoo Finance. Well, the LA Rams and the Cincinnati Bengals went toe-to-toe during the Super Bowl. The competition was fierce off the field as well, however, as advertisers looked to score. Here to help us discuss is Josh Mandel, Technicolor Creative Studios President of Advertising. Josh, thanks so much for being here. So you had a big night yesterday. You had 29 ads that actually aired during the game, and then you had some advertising, surrounding the game as well. A lot of the ads are getting some really positive buzz today, like the Rocket Mortgage ad with Anna Kendrick and the Amazon ad as well. I'm just wondering, the day after, how do you feel about all of the positive reaction after all of the work that you put into putting these things together?
Yeah, well, we're breathing a big sigh of relief after all of the work, obviously, going into the game. It's always nice to see your babies come to life in a big platform like this. And certainly when some of the ads are getting the buzz that they're getting, it's been a lot of fun.
And then, Josh, the rates for them are going up and up. $6.5 million was the average price this year. Some companies paying even more than that, paying $7 million. So the pressure is really on to get it just right. So talk us through your process. At what point do you guys come into the picture? I know you do all the visual effects and things like that for the ads, post-production work. Talk about the process, about when you come in and how do you take it over the finish line. And then talk about some of the ads that presented, some sort of creative challenges this year, extra challenges, or that required a bigger time commitment. I know, for example, the Pepsi halftime teaser was intense. There must have been a lot of work that went into that.
Yeah. Traditionally, we come in at the tail end of the process. So an advertising agency will pitch a big idea to a brand. The brand will buy off on it. They'll find a production company to go off and do the shoot. We will participate in the shoot in order to make sure that we're getting the right shots to be able to do the VFX work that we do. So, we're coming in at the tail end to kind of bring the magic and bring the ideas to life. You've got the Pepsi spot showing right there. That was a 3-minute teaser for the halftime show with an awful lot you can see in this rap battle right here with Eminem with his younger self. We're doing all of that work with the words and the imagery, a lot of the color that shows up in the spot as you go on. So that was an awful lot of work, an awful lot of hours, especially because that one had to hit before the Super Bowl in order to tease the halftime show. But the projects will last anywhere from a couple of weeks to a month to 6 weeks, depending upon the ambition of the brand, how they want to show up in the game. There's a difference between doing an ad on the Super Bowl versus doing a Super Bowl ad. And I think we see the difference in those brands that have really invested in wanting to own the moment.
And then, Josh, just tell me, did you work on more ads this year compared to previous years? And then are companies spending as much on those ads? Because we've heard from social media companies like Meta saying that advertisers could be pulling back because they're dealing with their own inflationary pressures as well. Is that something you're seeing? And then have your own costs gone up at all?
Yeah, well, I mean, you covered the media costs there at 6.5 million. So I think brands who are showing up at the Super Bowl are making the investment because they know it's one of the last, we call them a cultural campfire moment. It's one of the last times, I think, in terms of our media landscape, where people are showing up across demographics, across race, across gender. So brands really want to take advantage of that moment, and they're investing in the work. More generally speaking, marketing in general, I think they're being savvier about how they spend their money and where their ads show up. The digital landscape creates a lot of opportunities for brands. TV isn't the only place where they can show up anymore. There's a lot of different places they can. But at the end of the day, as we see at the Super Bowl, creativity really is the force multiplier for these companies. The creativity is the thing that breaks through. So I think we've seen, if you look at the top five, Rocket Mortgage, Amazon, the brands that invested in the Super Bowl see the rewards for that.
And then I'm wondering, you've worked on so many different types of ads. Are you surprised by the variety of companies that are now advertising and the diversity that you see, in each of those ads? I was so happy to see South Asian representation, which doesn't happen very often. So that was something that I liked. And then what are some of the other trends that you saw? There were a lot of celebrities in the ads this year, a lot of cars as well.
Yeah, I think even going to the actual game itself, the overt effort towards inclusion, I think was really, it's a long time in coming, frankly. And I think you're starting to see that brands are finally getting the message that diversity works. So that was a really good positive thing in terms of an overall trend. I think the other thing that we saw is just the ubiquity of technology in our lives. We saw everything from home technology like Alexa, all the way down to 5G internet service, to actually software as a service platforms were advertised on the Super Bowl. So I think that's a huge trend. And yes, you're right. I mean, the Super Bowl used to be dominated by beer and automotive, and I think we saw a lot more brands across a lot of different industries showing up this year.
It was definitely a creative mix, and congratulations to all of your hard work. It all paid off. All right, we'll leave it there. Thank you so much for your time today. Josh Mandel, Technicolor Creative Studios, President of Advertising. Alexis, over to you.
All right, coming up, we're going to stick with the big game because new figures are just coming out on just how much Americans wagered on the Super Bowl. We have got the eye-popping numbers for you next.
Welcome back. Well, the LA Rams weren't the only big winners at last night's game. Some gamblers won big too. Our Josh Schaefer is here with some stats on those big winners from yesterday night. Josh, the odds on favorite were for the Rams, however, right?
The odds on favor was for the Rams, Karina, and I think some of the sports books seem to be pretty happy that the Rams did end up winning and that the game didn't go to overtime. It's always interesting talking to these sports books the day after the game and to kind of see who the house is rooting for based on where the money was. So some of the big numbers we've heard thus far, DraftKings confirmed to Yahoo Finance that they paid out more than $175 million in bets yesterday on yesterday's game. And so that's about half of what DraftKings had for a total handle in New York over a 3-week period. So we can see how big that Super Bowl was. And that number doesn't even include the bets that lost that DraftKings kept. A lot of these sports gaming companies have earnings coming up, so they're not necessarily willing to share all of their information and aren't supposed to share all of their information just yet. So information has kind of slowly been trickling out, and I suspect we're going to get more and more as the week comes on. Some other numbers we learned, FanDuel paid out $55 million total off just 2 bets. So FanDuel had a promotional bet that was giving bettors 56-1 odds, which if you're familiar with gambling is pretty favorable. And so they paid out over $30 million for that bet. And then combine that with the Bengals covering the spread, and FanDuel paid out, as I said, $55 million for just those 2 bets alone. I also spoke with BetMGM. BetMGM said that they had a struggling start to the game. Odell Beckham scored the first touchdown. A lot of bettors bet on Odell Beckham to score that touchdown. One bettor even bet $10,000 on Odell Beckham to score that touchdown. That bettor ended up netting $100,000 from that. So a lot of big money being handed out yesterday. And then some other bets that we were following here. You had famous pop star Drake place some bets in Bitcoin. So not the crypto wasn't just in the ads last night. It was also in the gambling. And so he bet in Bitcoin on Odell Beckham Jr., who takes his salary in Bitcoin. So a lot of crypto connections there. And Drake ended up netting about $300,000 in total from his 3 bets. One thing to note on Drake that a lot of people were kind of complaining about online yesterday, Odell Beckham got hurt. Drake actually probably would have made more money had Odell Beckham not got hurt and kept catching the ball. A lot of people played how many yards he was going to catch. And since he's hurt, he couldn't do that anymore. So Drake ended up losing one of those bets, but he made out okay. One other big bettor I wanted to hit on, unfortunately, Mattress Mac was a big loser last night. He's going to be on our show on the 4 p.m. hour. We're going to ask him about it. But Mattress Mac down in Texas lost what we believe to be the biggest mobile sports bet ever. He had about $9.5 million total on the Bengals winning last night. This was part of his hedging because he gives out free mattress gear of over $3,000 if the Bengals won. So he ran one of those promotions where fans could win, and he ended up betting the other way. He lost $9.5 million. Pretty big bet there.
I give him credit for willing to come on the show in the 4 o'clock hour. I got to tune in for that one. I'm sure Odell going out, though, injured, definitely poured some cold water on a lot of people's bets yesterday. But look, we heard about the great expectations. More than 31 million Americans were supposed to have bet on the big game. What are the final numbers?
Yeah, so we're waiting on the exact number of who bet, how many people themselves actually bet. But the biggest winner for me, Alexis, out of this, and I think the gambling companies would say the same, is their technology worked. When we're expecting 31.4 million people to bet on a game and a lot of them to get on these apps, you need the technology to be able to hold up with that. Last year during the Super Bowl, that sort of fell out, and that became the story for the gambling companies after, was how do you build a tech to fit all these customers? That didn't happen yesterday. All these apps worked pretty well. They were able to pay out their bets. So we're starting to see the maturation of the sports gambling market in terms of being able to handle the volume. And I think that's a huge step forward for these companies and the industry as a whole.
For sure. All right, Josh Schaefer, thanks so much for the lowdown. Gambling there on the Super Bowl. Coming up in the next hour, the new president of the New York Stock Exchange shares her thoughts on the fate of the trading floor. And later, we look at the best and worst Super Bowl ads. We're back right after this. Welcome back, everybody. We start the top of the hour with a news alert that is moving the markets. U.S. officials say satellite images show Russian troops leaving their assembly points and moving to attack positions. That's according to CBS News. We want to get right to Jared Blickery now for a look at how all this is playing out in the equity markets. Jared?
Yeah, I was just looking at the Wi-Fi Interactive at the price action for the day, and we definitely took another leg lower here. You can see we'd almost gotten back to break even, but on this latest news that the Russians are amassing troops, and that's according to satellite images, as reported by CBS, as you said, Alexis, we are seeing just heading down a little bit. Now, we're only off about 1% right now. You can see the Dow's off of about 1% similarly, off about 350 points, and the NASDAQ a little bit less here. NASDAQ had been the leader, and you can see it's down 0.6% right now. Let's take a look and see inside the bond market, see if the 10-year is moving at all. You can see it had been up about 6-7 basis points, only about 5 right now. Not seeing too much action in the bond markets. You can see the 5-year up about 5 basis points as well. But when we go inside the NASDAQ 100, I was pointing out before that the mega caps were a bastion of strength today, but we can see Apple now turning into the red. It had been green earlier when I was doing my last report, exactly 1 hour ago, now in the red, and we're seeing some of the shine come off Amazon. That stock had been up about 3% as well. Let's take a look at the sector action and see where the selling is occurring right now. Now, consumer discretionary had been the leader all day long. That houses Amazon, which had been up. As I said, Amazon giving back its gains, and so is consumer discretionary. As you can see, everything in the red right now. Now, communication services, that's down about 0.6%. Then we have staples, industrials, tech, all of those outperforming. You can see discretionary just went green ever so briefly. Energy still the biggest laggard to the downside. That's down 2%. And then financials down 1.5%. Healthcare had been red most of the day. That's off a similar amount here. So the value and cyclical trade not doing well. Healthcare as a defense sector not doing that well. Utilities, same thing. So not the best price action here that we're tracking. I do want to get an update on the pharmaceutical sector, and let's take a look at that. We're seeing some weakness in the VAX stocks today, and that's after Fauci went on TV in an interview and said that the outlook for booster shots, people may only need them once every few years, kind of lowers the total addressable market for the stock. So you can see Moderna off 13% there right now. Also want to check in on the reopening trade, specifically in the travel sector, because we did see some weakness there, weakness since that report. We had seen most of these stocks in the green today. United was sitting on gains of over 1%. You can see it has turned negative right now. So put things in perspective, this news with respect to Russia, it's very important, especially with respect to the oil markets, because they are a swing producer on the global stage. But these conflicts tend not to disrupt equities for long periods of time. We're seeing it affect the intraday price action. But even if we were to see some selling here, history suggests that it's only going to be temporary. Again, we have to wait and see.
Jared, just a little more color on the energy sector. And I know you say that these hits are sometimes temporary, but where was oil just before all of this happened? Because they were around 7-year highs, but off lows, if I'm not mistaken.
Yes, overnight, I think we hit a high of $95 in WTI, and we'll check that out in a second. I just wanted to take a quick look at the heat maps for the energy sector, and we're definitely seeing the weakness persist right here. Some of the ones that are getting more hit, Continental Resources, they're down 3%. They're going to be reporting earnings this week, and Marathon, that's down 3.5% as well. Do want to check out the price of WTI. Now, we can see it had a high of $95.31 here, low of $92, and let's chart that price action here. Now let's try this on a line basis, and there we can see that the price has been trending higher all day, and looks like we might have gotten a little spike up on this news. $95.07 if we settled here, and we're going to be settling in about 25 minutes. That would be the highest, Karina, since October, I believe, of 2014. So definitely getting back up into that price range.
All right, Jared, I'll take it. Thanks for the roundup there on the markets. I want to bring in Omar Aguilar now, Schwab Asset Management CEO and CIO, for more on the market action and this news alert we've got. Omar, thanks so much for being with us. As you see the market reacting in real time to what's happening in Russia, if Russia does go ahead and indeed invade Ukraine, what are your expectations for how the stock market in particular will react here?
Well, market doesn't like uncertainty. Uncertainty is always a big source of volatility, and we will see these short-term boosts of volatility continue to be until we have a little bit of a resolution. History tells us that in general, when you have this kind of geopolitical conflicts, you see a significant amount of selling pressure in the equity markets in certain parts of the market, particularly the most aggressive part of the market, was everybody's trying to move towards more defensive mechanisms, like going through cash, going through more defensive sectors, and that usually triggers a little bit of more movements in the short run. However, if we go back to previous geopolitical crises, that usually tends to prove temporary. Especially if the conflict doesn't escalate too far. Again, it's too early to tell. The market seems to be, even with the news that you just reported, seems to be just pricing still a very, I would say, easy path out of the conflict. It is a more diplomatic conflict, that diplomatic solution that the market seems to be pricing it at the moment. Even with these news, the movements that we saw in the volatility doesn't necessarily compare to previous sources of conflicts.
Omar, nobody wants to see war in Europe. If it were to happen, though, what do you do with the portfolio? Do you start holding on to a little more cash? Do you wait things out? Do you see opportunity in the energy sector, which we know is a sector that was, chalking up some big losses today, but here crude oil now nearing $95 a barrel?
Well, as I said, it's difficult to understand the size of the potential conflict or what would the escalation might be. But what we always try to encourage investors to do is to continue to look at the long-term trends of what those positions might look like. What volatility does, and especially in this particular case where, yes, energy prices, given the size of the production that Russia brings into the oil market, will clearly continue to put even more pressure on inflation. And I would probably say that long-term trend of the pressure on supply chains, inflation that we already have as an economy, regardless of the conflict, is probably more worrisome than a short-term conflict. And again, the size and the length of the conflict is too early to speculate on anybody. Certainly the market and investors seem to be still thinking that there will be a diplomatic solution into this, as the market movement's still pretty, in line to just uncertainty in general, but not necessarily thinking that there will be a big conflict that will last for a long time. That being said, what we try to encourage investors is take a look at your risk profile. We're in a completely different volatility regime that we were even just at the end of last year, where volatility will stay with us as a result of geopolitical risk, as a result of higher interest rates, as a result of higher inflation, and therefore, understanding the overall long-term goals that fit with the risk profile is what we encourage, clients to do. And yes, rebalance strategies are encouraged. This is a good opportunity for being tax efficient with your portfolio. This is a great opportunity to figure out if you can actually reduce risk to the extent that fits your risk profile, and then rebalance your portfolio in areas that have been experiencing weakness in the short run because of this volatility.
And Omar, of course, we've got the threat of a Russian invasion of Ukraine, and that's preoccupying investors right now. But they're also thinking about those interest rate hikes, which we know the Fed has said they are coming. And once again, we saw St. Louis Fed President James Bullard reiterate that he wants to see the Fed front load those rate hikes as it tries to combat higher inflation. But he added to that today, saying he doesn't think that if that were to happen, it would negatively impact the economy or the stock market. Would you agree with that?
Well, certainly the front loading of significant higher interest rates will have an effect on equity markets, and it will have an effect on risky assets. The idea of front loading and being aggressive at the beginning for raising interest rates, the ultimate purpose is to reduce the impact of inflation, will naturally reduce economic growth. I think this time it is very different the way that the Fed has been, asked to start this tightening cycle, because the inflation numbers that we have observed and the prints on inflation are very high relative to the last 40 years. So the Fed is in a situation where they are trying to figure out ways to tame that inflation, in a way that is fast enough that gives them the opportunity to eventually change course. So it's not surprising that they will probably try to be aggressive at the beginning with the, fact that the economy has been growing at a very good pace and it's in pretty healthy conditions, so they have that particular thing on their end. Now, that being said, there's clearly going to be volatility. There's clearly going to be winners and losers, and as the inflation picture continues to evolve, as the economy transitions from good to services, I think that benefit or that change between interest rates and the stock market performance will continue to play a role. That there will be volatility, there will be a significant impact, because we haven't seen that level of raising in rates in a long time.
That is for sure. And Omar, finally, with all this geopolitical uncertainty, how are you viewing emerging markets right now, not only in Europe, but also what are your thoughts on China?
Well, interesting enough, the economy in China has actually been the only economy or the major economy that has actually gone the opposite side. The People Bank of China is in more, providing a stimulus and providing liquidity, mostly as a result of significant slowdown or their economy. If you recall, back of the 2020 COVID crisis, China was sort of the economy that drove a significant amount of growth very quickly, and they have slowed down, as a result of two things. One is, the government doing, a lot of things to try to reduce the impact of the real estate market and some of the issues they had there, and also the fact that they have the zero COVID policy that has reduced the impact of consumer and also has reduced the amount of services that is provided by the economy. So the People Bank of China is in a way providing a significant amount of stimulus that in a way will prove deflationary for the rest of the world. So in a way, if there's a good sign of the economy in China slowing down, is that potentially, especially for Europe, as it's a big trading partner for Europe, it will provide or will take away a little bit of the pressure on inflation out of Europe, which allows Europe to potentially, do better than other parts of the world. So, while the situation continues to escalate and we don't know what the geopolitical crisis may look in the next couple of weeks, provided that is still, where it is now, clearly emerging markets will have an extra amount of liquidity that they haven't had, in a while. It's still too early because there's still, dollar being very expensive. And at the same time, with a lot of, conditions in different parts of emerging markets, we're still not ready to just move into emerging markets because there's a lot of uncertainty, but there is certainly hope. And then in particular with China, some of that extra tools that they have to stimulate their economy may prove to work, maybe not in the short term, but in the medium term.
All right, great insights there. Omar Aguilar, Schwab Asset Management CEO and CIO. Thanks so much. Karina?
Okay, and coming up, we will pivot after a break. We break down a new report on employee health trends as COVID begins to wane across the country. Stay with us. And welcome back. Well, COVID cases may slowly be coming down in the country, but the residual effects on society, particular employers, do remain. Here with further insight on this, let's bring in Yahoo finance editor Adriana Belmonte, along with Springbuck population health practice leader Jennifer Jones. Adriana?
Yeah, hi, Jennifer. Taking a look at this report, I think it's pretty crazy that those who are hospitalized for COVID end up incurring 10 times more healthcare costs than those who didn't need hospitalization. So talk to us a little bit about these findings here in your report.
Yeah, thanks. Thanks for having me today. And we put these trends reports together really to help employers identify what those key trends are as they begin their planning for their benefits for their employees. And this is definitely one of the ways that they can use this data to really help maximize the management of their health investments. So this report, as far as for this year, is really based on more than 4,000 employers aggregate data that we have in our system. But as you mentioned, it's really staggering as far as we began to look into the data as far as the impact of COVID and really being able to try to explore what that impact is beyond just the initial acute phase of the infection. When we began to see it really separate out as far as those that were hospitalized versus non, it's pretty miraculous as far as a 70% increase from the same or similar time frame from 2019 of those that were hospitalized. What was significant about that is we didn't necessarily see them really leveling off as far as with their trends, as far as their costs until about month 4 or month 5 after the initial acute infection. Now, with the non-hospitalized, they still saw about a 25% increase per individual as well. But we definitely saw a leveling off of their cost well into month 2 as far as with after that initial acute diagnosis.
So talk about some of the long-term implications for this. I guess to start off with employers, what does it mean for them, especially as they're the ones providing healthcare to their employees?
Yeah, it's definitely key as far as now that we have some of this quantitative measure, they can begin to really understand what the risk is as far as within their own population. It's really important for employers to know what that underlying risk is. With those hospitalized individuals for COVID, we know that they had a lot of commonalities as far as with other conditions, as far as asthma, diabetes, hypertension, and other health issues. So you need to know what that exists as far as within your population. How many diabetics do you have? How many people with hypertension do you have? And be able to associate some cost as far as with risk and understanding what can you do today to really help members to address those specific chronic conditions. So if they do become infected with COVID in the future, ideally they wouldn't have to be hospitalized and be able to avoid the significant cost increases that we saw.
And does this trickle down to employees, even employees who maybe haven't been hospitalized for COVID yet, or maybe, won't be at all, but does this affect them in terms of how much they're going to pay for their premiums down the line?
That wasn't necessarily the scope as far as how we wanted to look at this, but when you think about healthcare in general, there's definitely, if there is an increase in ongoing cost to the employer, there's certainly always the opportunity for them to potentially pass on some of those increases in costs to the employee as far as with premiums. But I think, the big takeaway here again is knowing what that risk is, intervening and being able to manage those chronic conditions to help individuals make sure that they're not put in a position as far as where they're hospitalized with COVID. Now, we still have the continuance as far as what we call long COVID that we need to make sure that we're addressing and dealing with, but ideally, making sure we're following through with practices we know can help spread COVID and what we can do as far as to ensure, again, that we're not ending up in the hospital as far as with those more severe cases to really help mitigate that cost going forward for both the employees and then also the employers.
Okay, well, thank you so much for taking the time to speak with us today, Jennifer. Back to you, Alexis.
All right, thanks so much, Adriana. We appreciate it. Straight ahead, we sit down with the new president of the New York Stock Exchange, Lynn Martin. So don't go away. Welcome back to Yahoo Finance Live, everyone. Want to get a quick check of the markets because looks like all three major indexes took another big leg down on as investors continue to eye this Russia-Ukraine tensions. We've got the Dow off more than 370. It was down more than 400 points just a short time ago. The S&P 500 now giving back 43 points. And technology, which was higher for a good part of the day, now mostly lower, and that's helping to drag the NASDAQ down about 82 points. All right, on January 3rd, Lynn Martin became the 68th president of the New York Stock Exchange. And Yahoo Finance's Brian Sazzi sat down with Martin recently. He joins us now. So, Brian, I know that was a treat. You actually got to go to the New York Stock Exchange to speak with her. I know you guys spoke about a lot of things, including I was very curious to hear what she had to say about the fate of the trading floor.
And good to see you, Alexis. And that's a floor you know as well, too. Many years reporting down there as well. And it is still a special place, but of course, not the same as it was in its heydays, really when the markets weren't as computerized. But I asked Martin about her outlook for the trading floor. And of course, what is her outlook for big IPO deals this year? Take a listen.
No, the trading floor is not going away. Yeah. The trading floor is not going. The last business I ran, I love to use this parallel. The last business I ran, we evaluated 2.8 million securities, fixed income securities globally throughout the day. We did that with a lot of machinery, a lot of smart computers, a lot of smart algorithms. But importantly, I did that with 200 individuals around the globe. And the reason why our product was the market leading product is because the humans were able to throw out the garbage, out inputs, and modify the models, particularly in fast-moving markets. In fast-moving markets, the role of the human is incredibly important. We saw that just 2 weeks ago when we saw those spikes in volatility right before the Fed meeting. Stocks listed on the New York Stock Exchange opened with 2 times less volatility and closed with 3 times less volatility than other peer group that we have. So the role of the human is incredibly important and something that's near and dear to my heart. And I look forward to further evolving the way the floor is used.
All right, so we'll score one for humans. Now, speaking of humans, over the past year and a half, we've seen a tremendous rise of new investors into the stock market.
Yeah.
What do you make of the rise of the retail investor?
Yeah, and it's funny because I think when we all went home for COVID, because we all shifted to a remote environment really efficiently, really quickly due to the use of technology, we saw this new investor base emerge, the retail investor, and they were able to exercise their voting power in a variety of names. A lot of folks, I think, thought that it was a fleeting moment in history, but it's clear that the retail investor is here to stay. And with tools, with low-cost tools, with the ability to access securities on a democratized fashion, the technology that they now have at their fingertips, they are very much here to stay, and something that I think is a great evolution for the markets.
What do you say when folks, they bring up this view that the little guy's getting shut out of the market? It's tough for them to make money. They're not getting the best information.
I think that's a myth, quite honestly. And I think technology has really democratized the playing field. I think more than ever, you have more information available to a human to use at their fingertips. And I really mean at their fingertips through their smartphones, through their laptops, through their iPads, whatever device they're using throughout the course of the day. They can do technical analysis. They can consume market data on as quick as any human can consume it, and they can also have the tools to build their own models to perform sophisticated analysis.
Deal volumes, how will they end up this year?
You know, I think the IPO market this year is very similar to what we've seen in past years. What we've seen in 2019 when we had a government shutdown, what we saw in 2020, the beginning of 2020, where we saw all that volatility in the market, people not wanting to come to market. The amount of deals has not slowed down. Their timing coming to market has slowed down a bit. So I think Q1 is going to be a pretty quiet Q1, particularly relative to last Q1. But I think we're going to end the year strong. The pipeline is tremendous of deals coming to market.
Within these companies coming public, I know you're very focused on ESG. How might the disclosures look differently amongst this new crop of IPOs?
Yeah, it seems as though most of the IPOs have done a lot of preliminary thought about how they disclose ESG metrics. A lot of them are coming to market with a much more sustainable focus. Many of us who have been public for a while, such as ICE, our parent company. We published our first sustainability report, I think, in 2016. And if I look at our sustainability report now versus 6 years ago, it has come so far. The companies coming to market now have already seen the path they need to take when you look at the other well-governed companies and the disclosures they put out to market. So they're coming to market from a very mature standpoint on environmental, social, and governance disclosures already.
A couple phone ones before we let you go. I know you're pretty busy. When someone comes up to you and asks you, what do you think about the market? Do you ever get tired of hearing that? They have to ask you.
I get asked that all the time, and I would say what I think of the market is the U.S. markets are the most transparent, offer the most democratized access in the world. They're volatile at times, but they're incredibly efficient. And the cost for a retail investor is the lowest it's ever been.
So Alexis and Karina, score one for the humans. For now, the trading floor will continue to be occupied with people with 2 arms and 2 legs, and I'm not talking about Elon Musk robots, so that's a good thing.
I loved her answer about the market. She must say that in her sleep. Okay, Brian, what did she tell you about when she first got picked for the job?
She generally sounded surprised, Karina. She was called into the office by her boss, Jeff Sprecher. He is the CEO, longtime CEO of Intercontinental Exchange. That's the parent company of the New York Stock Exchange. And she told me she thought she was going in there to talk about the business she had been running. That is the data side of the business and the outlook for that business moving forward. But lo and behold, she got appointed to the top job.
Interesting. So maybe she didn't know she was even being considered for the job. It's a little interesting.
That was my sense, Alexis. But hey, good thing about that floor, though. You know, it's something about the trading floor of the New York Stock Exchange. Of course, it's not as busy and crazy as it was, but still, it's still an exciting place to be.
I remember I used to have to elbow my way in there in between all the traders. Now you can kind of ballroom dance on the floor. But Brian Stassi, thanks for bringing us that interview. We appreciate it. Karina?
Yeah, when I used to go there, it was 3 o'clock in the morning. There wasn't too much elbowing I needed to do. Okay, thank you so much. Great interview. Coming up, a check of the energy sector and how oil settled amid all of the heightened geopolitical tensions. Stay with us. Welcome back to Yahoo Finance. Well, oil markets hitting new highs fueled by more tensions after reacting to a report from CBS saying that satellite images indicate that Russian troops are moving into attack positions on Ukraine. With more on how that's impacting the energy sector and oil prices, let's bring in our Yahoo Finance's Jared Blickery. Jared, Russia's still denying that they have any plan to invade.
Yes, and we're seeing the commodities market surging on the news. We can already see now palladium, that's up 8%. Russia is a big producer of palladium. Natural gas, we know they're a big producer of natural gas as well. That's up 6%. And crude oil back up to another highest highest settlement since 2014. I believe it was $95 and change here. So we'll get the exact price in a couple minutes. But nevertheless, this is the overnight price action. Really 2.5% or 2.25%, not the biggest move if you expected World War III to break out, but definitely seeing some price action here that is bullish on the supply side, and that is potentially with less supply coming into the market. Also, we have Iran talks in tow, so it's possible that if there was some kind of deal with respect to sanctions, lifting sanctions from Iran, that would be an additional source of crude oil that could be brought to the market. But for the time being, we're less than $5 away from $100 per barrel, something we were talking about only last week. And before we go here, I want to get a quick check of our energy market heat map, and we can see the losses here. Let's see, Exxon down about 1.5%. Let's take a look at the intraday price action. Still seeing some negative movement here, really not getting much of a lift off on that news, but energy stocks and the underlying, which is crude oil, don't always trade in tandem. So we are seeing energy as one of the worst sectors today, guys.
Okay, Jared Blickery, thank you so much. And we are going to stay on the tensions between Ukraine, Russia, and the West and what it means for energy. Let's bring in our next guest, Scott Bauer, Prosper Trading Academy CEO. Scott, thanks so much for being here. So a lot of conflicting messages. We started the day hearing that possibly there was some diplomacy happening and talks were going to go through between Russia, Ukraine, and the West. All of a sudden, now we get this report from CBS saying that satellite images show that troops are moving into position from the Russian side into the Ukraine. And so, as I say, a lot of mixed messages. How concerned are you that there is an invasion? And if there is one, what happens to oil prices and gas prices in this country?
So I think we should all be concerned for more reasons than just the price of oil if there's an invasion, from the humanitarian side. But I'll be honest with you, I think that there is maybe 5% or so already priced in to the price of looking at if there's going to be an invasion here. And if you look at what's happened between the spread between West Texas and Brent, that's down to $1, and it may have just ticked, in the last few minutes or so under $1. And that is because of what is going on, the supply constraints of what may happen here. But I really think that if there is an invasion, which we all hope to God there is not, that I don't know that we're going to see the spike that some people think. Again, I think there's a good 5% of the price of oil already priced in.
Yeah, we all hope there isn't a war. And I think it is important to mention that Putin, says that he is not planning to invade. And there are talks scheduled with Germany's Scholz and Putin tomorrow. So let's see how those develop. But I want to ask you more about the long-term picture as far as supply and demand. What does that look like to you? Do you actually see Russia pulling natural gas and energy off the table for Europe? And do you see Europe, halting all sort of imports because they rely on Russia so much for their energy needs?
They sure do. I mean, they supply about 35% across the board of natural gas and of energy and of other commodities. So, I'm not in the political sphere, if you will, but I think it would certainly be really not in their best interest if Russia pulled back on supplying to the rest of Europe many of these commodities. I think that would be a really tough situation for the Russian people, for the Russian economy. Obviously, if it does happen, we would see prices spike, which I think, again, maybe some of these commodity prices are getting ahead of themselves a little bit. And the volatility we're seeing, is there because of the situation that's going on. Natural gas, what's up, 6% today? If they do invade, I could see a quick spike and then pull back from that. I think some of the grains, the commodities, wheat, et cetera, I think you could see the same kind of situation there. In terms of overall supply and demand in the oil space, what's going on right now geopolitically is coming at a time where demand continues to recover from the pandemic. In fact, the IEA, the International Energy Agency, just raised its demand forecast for 2022 by almost 1 million barrels a day. So that is a huge, huge number. But right now, it's supply that has the upper hand. We all know the demand is there, but it's the concern about what supply we have that is really helping to drive prices.
So then that brings me to my next question. And, Iran nuclear talks seem to be going better at this particular time. And Russia is actually helping to mediate those talks. What is the probability that we bring Iranian crude oil back onto the market? And how does that change the dynamics up?
So in a perfect world, if things go well and they do start producing again and they start, supplying to the world, you're talking about 1 million barrels a day. That's what was taken off. Now, that's nothing to sneeze at, but it's really in the overall grand scheme of things, it's not a huge amount. However, in this particular environment right now where there is such a supply crunch, that can greatly affect the price of crude. In the long run, though, in a more normal environment, let's say, I don't think that them coming back online really affects the price of crude too much.
Okay. And then I want to ask you about OPEC and its allies worried that it can't deliver on the targeted output that it says that it's supposed to do 400,000 of barrels of oil per day. Do you see that actually being a risk, or do they follow through on what their targeted output is?
I think at this point, I think they follow through. Typically I have a very, let's say, gray, skeptical outlook on what OPEC and OPEC Plus says they're going to do. But I think during these times with the geopolitical climate that we're in right now, I do think they can deliver. I'm quite frankly more concerned longer run about U.S. companies and shale drillers and when they might decide, to get back into the ground, because we all know what happened a couple of years ago with demand destruction. They pulled out. We've seen, that supply just almost halt. And now they're so concerned about their shareholders, they're being really timid about, getting back to production. So to me, down the road, that is the biggest, maybe difference maker in what can happen for supply.
Yeah, you and President Biden both worried about the same thing. I'm sure that is something top of his mind as energy prices rise, gas prices rise, and midterms around the corner. We'll have to leave it there. Scott Bauer, Prosper Trading Academy CEO. Thanks for your perspective today. Alexis, over to you.
Which Super Bowl ads scored a touchdown and which ads were incomplete passes? Well, football fans weighed in. We've got the results. See if they match your favorites next. Welcome back. At about $7 million for 30 seconds, this year's Super Bowl ads featured lots of celebrities, lots of crypto, and plenty of electric vehicles. But which ad scored the highest with fans? Here's a hint. It featured old school Barbie dolls. Take a look.
Barbie really wants this dream house. It's got stunning views and a slide. Barbie's ready for fun. So cool. And Barbie found out about this dream house with an alert from Rocket Homes. She did? Well, it's a super competitive market. Everyone wants to buy the dream house.
Better offer Betty.
I'll go 10 over asking.
Cash offer Carl.
Straight cash.
House flipper skipper.
Let's tear it to the studs. You vultures, you're gonna start a bidding war.
All right. Well, according to USA Today's ad meter, that commercial from Rocket Mortgage, of course, featuring Anna Kendrick, scored the highest with viewers. Here with more now is USA Today NFL reporter Lorenzo Reyes. Lorenzo, good to see you. When I saw that ad yesterday, I immediately connected with it. Why did this resonate, do you think, so much with viewers?
It's for that exact reason. It was a play to nostalgia, but also that marriage of the iconic Barbie brand with the star power of Anna Kendrick. And how can you not laugh when you hear characters like Better Offer Betty? It's a very, taking this almost child perspective take that's tongue in cheek at a very adult problem that a lot of people are facing now with a very competitive real estate market. So it kind of was that perfect marriage where people who are going through this and buying homes, they're experiencing this, but this also played into their past when they were potentially playing with those Barbie dolls. So it just hit all the right notes and it did really well. And it was just also funny.
It really was. No, I thought it hit just the right tone. One of our producers said if Barbie's having trouble getting a house, there is no hope for her. No, keep the faith, Sarah. So I want to talk about some of the other winners because I know Amazon probably spent a pretty penny to get Scarlett Johansson and Colin Jost to be spokespeople. This one was called Mind Reader. Tell us why you think this one was a winner.
So this one was actually my favorite out of all 64 that were eligible for USA Today Ad Meter. The humor was just so approachable and relatable. It was universal. Anybody who's been in a relationship could relate to that. And so often we see celebrities as these kind of like unapproachable figures, almost at a distance. And this was also just a peek into this relationship. And we got to see, really, I think, their personalities shine through. In fact, Colin Jost, he brought some of his writers. They collaborated with the Amazon writers to come up with the script and the jokes. That's why they felt authentic. To me, it almost sounded like it was an SNL skit. This one, I think, was a home run. Yeah, and this for Amazon as well. Now, this is their fourth top three position in the USA Today Ad Meter since 2018. So they're on a hot streak.
They really are. Yeah. And it's interesting. I had wondered whether or not Colin Jost maybe had written some of that because I know he's a writer for SNL and writes those news segments. Doritos, always we always find Dorito ads year after year in the Super Bowl. They did it again. Their ad faring very well. And this one used a song. I just feel like they keep using that Push It song like everywhere. I'm kind of wondering if it's a little outplayed at this point. What do you think?
It's interesting. I think it's just so recognizable that people, they hear it and they know exactly what it is as soon as they hear those first, few beats. The interesting thing with this one, this is the first time Frito-Lay devoted a Super Bowl spot to the Flamin' Hot flavor. So that was interesting in itself. And also the fact that there was star power behind this, but they weren't visible. And I think one of the big trends that we saw in the month leading up to the game was just how many companies were dropping teasers to build that interest. And I think Doritos and Cheetos, they knew that because Megan Thee Stallion and Charlie Puth weren't going to be on, you weren't going to be able to see them, they needed to drop those teasers so the USA Today Ad Meter panelists could see that there was some star power behind it. And to go back to the song, actually, Megan Thee Stallion, this shows how all in they went on this. She actually has a full track remix of Salt and Peppa's Push It. And it's available for streaming up until February 18th. And the title is Flamin' Hottie.
Of course it is. Of course it is. Yes, capitalizing on it. We don't have a lot of time left. I just want to round out the top 5 quickly. Kia's Robo Dog, that was that all-electric Kia. And also Toyota pulling at the heartstrings with the brothers story from the Paralympics. Just real quickly, why did these do so well?
I think there was a little bit of a departure. We saw a lot of humor, and these kind of differentiated themselves in that way, where it was more emotional. You know, the Robo-Dog, you saw that sort of, there was a struggle and then the path to redemption there. And then the brothers, it was just so well done. And I actually loved how Toyota, the cars were actually almost timestamps showing how the passage of time happened there. So the product stayed in there. But yeah, I think they just hit the right notes as far as inspiration. And after the year that we have, year and a half we've had, I think people wanted to be uplifted, so they resonated.
And 30 seconds I've got on this one. Coinbase did not fare very well with your survey, but it looks like the app crashed because of this ad. It was that bouncing, colorful QR code for 60 seconds on the screen. Why didn't people seem to like this all that much?
This is a fascinating case study. I think we'll be looking at this one for years to come just because it was so unconventional. And I think this might actually be one of the ads that gets the most engagement long term. But for so many people who weren't familiar with cryptocurrency or even QR codes, there are probably millions of Americans who still had no idea what that was. With that said, though, the company says they had more than 20 million hits within less than a minute. So if their goal was to get brand exposure in that sense, then they hit a home run. But as far as resonating with an ad, they probably fell flat.
Yeah, I agree. I mean, it was clever. I got it. I don't know if it was worth $7 million, but we'll see. NFL reporter Lorenzo Reyes, thanks so much. Karina?
Okay, my favorite ad were the ones that pulled at the heartstrings as well. All right, coming up after the break, switching gears, supply chain issues continue to weigh on small businesses with more on how they're coping. Stay with us ahead.
Welcome back. Delays, low inventory, higher costs. The supply chain chaos is being felt by everyone, hitting businesses large and small. For more, we're joined by Yahoo Finance's Danny Romero with a look at how local business owners are still taking it all in. Danny?
Yeah, Alexis, it's been a challenge to say the least for small business owners to really survive the pandemic. And some of these business owners continue to be impacted by the supply chain mess. Demand for consumer goods remains high. Supplies and products are trickling in for the most part. 2/3 of small business owners say that they've had to adapt in some way due to the supply chain bottlenecks. And that's according to a software company survey, Sky Nova. And And it's not, like you said, it's not just small business owners. The large ones are also facing this headache as well. For example, Starbucks reported that they are facing a shortage on disposable cups, and that's according to the Wall Street Journal. I spoke with a cafe owner in Los Angeles that says that they're having a hard time finding gloves as well as those coffee cup sleeves, and that they've tried to find a local source, but that supplier imports in, so that's not able to really work out for them. So they've had to really modify their branding. Also, like I said, another business owner, a furniture store, say that they're dealing not only with shortages, but the inconsistency of their inventory. Take a listen.
So it's not something that we can rely on. And that's sort of a bigger struggle, because you want to promise a shorter lead time on a sofa, for instance. You just can't right now. Because anytime you hint that it might be faster, that's the order that's missing parts that have to be flown in from China, those sorts of things. For us, one of the bigger impacts is the amount of work we're doing to keep up with price increases.
And like you heard right there, another concern, rising costs. Inflation is another crippling obstacle for these small business owners. More than half of small business owners say that they've had to push those costs to their customers, which charging customers more due to inflation. And that's according to the National Federation of Independent Business report. And some of these business owners also can't keep up with those rising costs, which again is impacting their sales margin. Alexis, Karina?
Hey, Danny, I want to ask you real quick, what do we know about the backlog at the twin ports? Because we had experts on last week saying that things are starting to ease there.
You're right. There are some signs of a let up at the Los Angeles County ports. So let's break it down, because the total container ship backup sits at 76. That was on Friday, which is down from the 109 ships that were backed up in January. And that's according to the Marine Exchange of Southern California. But again, it's unclear whether this is a trend or a temporary thing due to the slowdowns in Asia because of the New Year holiday that started earlier this month. Still, congestion still remains high to historical standards. Container ships on average are waiting 18 days to unload at the ports of Los Angeles. At the port of Los Angeles. And prior to the pandemic, it was rare for ships to really wait for a berth. And on the bright side, port officials say they are continuing to increase capacity. But again, like I said, it's still unclear whether this is a trend or a temporary thing. And with tensions growing about a Russian-Ukraine invasion, there is potential for another disruption across all global supply chains. Karina?
There certainly is. All right. Thanks a lot, Danny Romero. Appreciate it. Taking a look at the markets, it looks like stocks coming well off their lows of the day. On clarification here from the Ukraine president's office, a senior Ukrainian official is now denying that President Zelensky was being literal when he said in an address to the nation that he'd been told a Russian attack would begin on February 16th. That presidential advisor now saying Zelensky was being ironic. I'm not sure if now is really the time for irony, but here you have the market sort of ebbing and flowing today with the news we're getting on this geopolitical situation. The Dow was off more than 400 points, now down 277. The S&P off 30. The Nasdaq was down nearly 100. It's now come back quite a bit and is now down just about 20 points. All right, that's going to do it for Karina Mitchell and myself, Alexis Christoforous. Thanks for spending the past 2 hours with us. Stay with us, though. Our colleagues will take you through the closing bell coming up next.
Intensifying international crisis as the world weighs the impact of a Russian invasion of Ukraine. U.S. President Biden and Russian President Vladimir Putin spoke over the weekend, the White House releasing a statement saying that on the call, President Biden reiterated that if Russia undertakes a further invasion of Ukraine, the United States, its allies, and partners will respond decisively and impose swift and severe costs on Russia. Oil markets closely reacting to defensive diplomatic developments. We'll have the latest prices by the barrel for you in a moment. Plus, as markets juggle international uncertainty, hawkish monetary policy ahead of the next FOMC meeting is also in focus. St. Louis Fed President James Bullard continues to publicly signal in broadcast interviews his intention to make the case to his Federal Reserve colleagues for more aggressive interest rate hikes, sending yet another jolt to the Dow and the S&P 500. And the nation's largest brick and mortar retailer and private employer, Walmart, is working on the rollback of its COVID response mask policy for employees who have received 2 doses of the Pfizer or Moderna vaccine or 1 dose of the Johnson & Johnson vaccine. As cases continue to decline, the company is signaling its return to normalcy by decreasing health screenings in all but 3 states. We'll speak with Dr. Calvin Sun, founder and CEO of the Monsoon Diaries, for his professional analysis of the state-by-state reduction in precautionary COVID policies. You're watching Yahoo Finance Live. Today is February 14th, 2022. Happy Valentine's Day. We've got 59 minutes until the closing bell, and I'm Brad Smith here with Emily McCormick and Rochelle Akufo. Emily, I'll toss it on over to you as we kick off another critical week for the markets.
Great to be with you, Brad and Rochelle. Let's get a check of where markets are trading this afternoon, and it's another red day on Wall Street. Stocks are off session lows. The Dow had been off as many as 400 points at the worst points of today's session. Now off just over 275 points, now 267 points, we'll call it, or about 0.8 percentage points. The S&P 500 also down about 0.6 percentage points, and the NASDAQ Composite down just slightly during today's session. Now, taking a look at the sector action, we do have the energy, financials, and healthcare sectors, the laggards in the S&P 500 during this final hour of trading, whereas consumer discretionary and communication services are holding on to narrow gains. So seeing a little bit of tech outperformance as we head into this closing bell. But for a deeper dive into today's trading, let's head right over to Yahoo Finance's Jared Blickery, standing by on the interactive board. Jared.
That's right. Let's take a look at the Dow first and kind of chart and get our bearings on the intraday price action. This downdraft here, which occurred just after 1 p.m., was on the latest escalation of tensions. Lots of reports coming out on both sides, but you can see it went to new session lows, and now we are off of those lows. The NASDAQ faring a little bit better today. Actually managed to turn green again just a few minutes ago. S&P 500 down about 0.2%. Looks pretty much like the Dow. I just want to show a 1-month chart on with some candlesticks here so we can see and get our bearings in this important index here. And we can see after coming up and selling off from 4,600, that was a key potential resistance level. We are heading down, and it looks like we want to probably test these lows down here. So I'm thinking the just below 43.25, something in there. But if we start going down, there's a very good chance that we could break those lows. So if we do, want to see it quickly reversed, and if not, we're probably going to head much lower and quickly. Let's take a look at the bond market real quick as well. The 10-year T-note yield now only up about 3 basis points. This is a 2-day look. Had been up about 5 or 6 basis points earlier, and we can see the 5-year cooling off a little bit. It's up only about 4 basis points right now. Let's take a look inside the market, and here we have the NASDAQ 100 looking a little bit better than that sell-off when we had that initially an hour ago. Amazon up 1.5%, had been up 3% earlier in the day. Tesla up 1.5%, and Nvidia up over 1%. You can see the mega caps looking kind of mixed now. Facebook is the worst off. It's down about 1.25%. Importantly, we got to check out the sectors because consumer discretionary, that's been the leader all day, had been in the red just briefly. Communication services and tech also outperformers along with industrials, but you can see those 3 sectors are in the red. And then XLE, the energy sector, down nearly 3%. But I got to show you the futures. We just closed oil at $95.46 per barrel, and that is the highest price since 2014. So a lot to unpack here, but definitely monitoring this situation going forward, guys.
Thanks to Yahoo Finance's own Jared Blickery there. All right, let's delve further into what's moving markets today, especially the impact of the latest with Ukraine-Russia developments. Joining us now is Michelle Connell, CFA, President and owner of Porsche Capital Management. Thank you for joining us. Now, investors we saw piled into traditional havens like treasuries and gold when we saw these warnings for an impending conflict escalating on Friday. Those worries have eased somewhat as Russia has indicated diplomatic channels haven't yet been exhausted. Still, at one point, we saw the Dow down more than 300 points today, still hovering in that range. How are you advising your clients to really deal with all this uncertainty?
Well, I expect, Rochelle, that there is going to be a continuation of volatility through this uncertainty with what's going on over in the Ukraine. But I think that's more of a short-term term of volatility. And what really we need to be concerning and incorporating into our strategy is what's going on with inflation. I think that's something that we're going to be dealing with for a longer period of time.
So then as we look at some of the underlying risks then, are equity markets at risk more from the fallout from inflation then? And what are some of the underlying things you're keeping an eye on?
I'm looking at how much pricing power the companies that I own have. And so I think that's something that consumers need to be aware of. And, you know, everybody has been pushing heavily into the value trade. And a lot of those stocks have done extremely well. You have Exxon over 25, 28%. A lot of the financials have done well. But underneath this, we're starting to see a bounce today because I think that the market's starting to realize that a lot of the technology companies that have positive cash flow, have the pricing power through periods of inflation, they have really come off their highs and they look very compelling here.
And so even at those prices where they do look compelling, from your perspective, is a market that relaxed positively off of support levels enough for investors to accept the current risk profile in equities?
I think it is. I mean, if you are looking at it, instead of looking at it as a trader, but you're looking at it as an investor, I think things look compelling here in certain pockets where you have had those pullbacks. Last week, I was talking to two value managers that I allocate funds to. One was domestic, one was international. They both typically don't do a lot in technology, and they're getting really interested here, especially with strong software names and the semiconductors that are down 18 or 20%. So when a value manager tells you that they're interested in technology, there must be something to that.
Another area that investors are growing interested in that we've seen, especially over these past 18 months, you know, coupled with Valentine's Day, is kind of malaise Monday after the Super Bowl Sunday, where many viewers, they witnessed record ad spends towards crypto services. So wondering what level of interest you're hearing from your clients and what you're advising to them around holding some level of crypto.
It's really hard for me as somebody who's, you know, focused on valuation and fundamentals to tell people when to get into cryptocurrencies rather. It's more of a matter of looking at the technicals on those. If somebody does have an interest, I think having, you know, 3 to a 5% position might be warranted. But again, I don't know how to value those. I'm more focused on the fintechs where I can actually look at the cash flows and understand those companies.
Michelle, geopolitical tensions have certainly been in focus today and over the past several sessions, but the Fed and inflation, as you mentioned, is still a key driver of these markets, with the S&P 500 down 8% for the year to date. Do you think the level of hawkishness from the Fed that markets are currently pricing in is overdone at this point?
I don't know. We have a few Fed presidents that are saying that we're looking at 50 basis points in March, and by June, maybe a full 100 basis points. I don't know that the market has fully digested that. That's why, again, I say that we probably have some volatility that we're going to be looking at in the next 6 months. But what I think we need to look at, yes, inflation is high. It seems to be stabilizing in some areas. But GDP is probably close to zero for the first quarter. And what I'm looking at is estimates going forward June and through the end of the year. You're going to have GDP coming back very strong, probably at about the 5% range. So I think the markets will, do well once we start realizing
yes, we're going to be dealing with higher interest rates, but at the same time, all that money that's been sitting on the sidelines with M2 and savings accounts and checking accounts, it just keeps climbing every month. That money has to go somewhere. And I think you're going to be seeing a lot stronger of an economy the second half of the year. And that gives me some solace too with, stepping in more and using more of my cash in buying stocks.
And with that in mind, thinking about the Fed's potential path forward here, where do you expect the Fed's terminal rate to land?
I don't know that I could answer that and sound smart in even 3 months. So I'm going to sidestep it. I think they have been behind the curveball. I know I'm not alone in thinking that. I think they were doing the best they could, and they did not understand the fact that inflation was not transitory, especially when you were looking at wages and housing. And I think now they're having to come to grips with that. Those two factors, wages and housing, the costs are not going to evaporate anytime soon. So I think they're going to have to raise rates faster than they thought at the end of the year. How fast that is going forward, I really can't say. I would not be surprised, as the St. Louis Federal Reserve president said, that we have a 100 basis point increase by June. I think that's possible.
All right, we'll leave it there for now, and we will see what the Fed does next. Michelle Connell is CFA, president and owner of Portia Capital Management, LLC, and we thank you so much for your time this afternoon. Coming up, we're tracking the latest on tensions between Russia and Ukraine as the U.S. closes its embassy in the capital of Ukraine. Stick with us. Welcome back to Yahoo Finance Live. Let's get a check of where markets are trading with about 46 minutes left of today's session. Still seeing a lot of red across the screen here, across the three major stock indexes. But one area I want to focus on is in the travel names. Now, we've seen these travel stocks getting whipsawed throughout the course of today's session, as we've seen a number of headlines emerge regarding the Russia-Ukraine conflict. Earlier today, we had seen most of these names in solidly positive territory, American Airlines and United Airlines, as well as TripAdvisors, as we can see, now dipping into negative territory. But earlier, that leg higher had come after Russia's Foreign Minister Sergei Lavrov said he was urging Russian President Vladimir Putin to continue diplomatic talks with the West. Now, as additional reports have emerged with the U.S. Evacuating and closing its embassy based in Ukraine's capital, these stocks have really taken a turn here. Even some of the names like Booking that had been in more positive territory earlier today, now pairing some of those gains. We will continue to monitor the travel names as well as some energy prices and oil names as we continue through today's session. Rochelle.
Thanks, Emily. Now, as multiple sectors either fall out from a potential Ukraine-Russia conflict, let's check in on where things stand with that standoff and where they could go. I'm joined now by Mark Cancian, retired colonel for the U.S. Marine Corps Reserves and the Center for Strategic and International Studies senior advisor. Thank you for joining me today. Now, we are seeing more openness for dialogue between Russia and the West. Does this mean there's still a role for diplomacy, and what could potentially make or break that progress?
There is a role for diplomacy. So far, the results have been quite discouraging, though. Putin and Biden have talked several times. U.S. officials have been in contact with their Russian counterparts. President Macron of France went over to Moscow to try to make a deal independently. None of that was able to move Putin off of his position that Ukraine should not join NATO and that NATO should end its support of Ukraine. On the other hand, in the last 24 hours or so, there's been a glimmer of optimism. A Ukrainian official suggested that maybe some guarantee that Ukraine would not join NATO for a period of time, maybe 10 years, might be the basis for an agreement. So there's a possibility of a diplomatic way forward, but right now it's just a glimmer of optimism.
So then give us a sense of the thinking here then. What would Russia's strategy be in Ukraine, and how would they go about executing it?
Well, the Russians, first of all, you want to prevent Ukraine from moving into the Western sphere, becoming part of NATO. They feel quite threatened. And, to give a little perspective, Ukraine was part of Russia for 500 years up until the 1990s. Now, Ukraine is an entirely sovereign, independent country and deserves all the status and responsibilities that go with that. But there's a lot of history here. Russia has a couple of options. One possibility is that Putin just demobilizes and feels that he's made his point, that everyone in the West understands that having Ukraine join NATO, for example, would be unacceptable and would entail a military response from Russia. One possibility is that he does, what I call the small option, maybe takes a bite out of eastern Ukraine in the Donbass area, maybe does some gray zone actions there, maybe has the separatists declare an independent country, something like that. And the third option is a major invasion, maybe an attack on Kiev, maybe something coming out of Crimea, moving towards the Donbass. There are a couple possibilities there.
So then in terms of capability then, how prepared are Russian forces militarily if this were to become an invasion, certainly considering what we did see with the annexation of Crimea?
It's important to realize that the Russian forces today are very different from where they were in the 1990s and where the Soviet forces were. Back during the Soviet Union, they had very large armed forces, but they were manned by conscripts who were not terribly well trained. A lot of talk about the Soviet-Russian hordes. In 2008, the Russians began a series of major reforms in their military. The military did quite poorly in a conflict with the country of Georgia. What you see now is a pretty high-quality force. It's much smaller. It's about 900,000, smaller than the U.S. Armed Forces, much smaller than what the Soviets had, but it's quite high quality. Most of them are volunteers who are in for a while and have high skills. The equipment's quite good. The training's quite good. Interestingly, also, they have a real sensitivity to casualties. So they look a lot like us. They're quite skilled. But it's important also to keep in mind that they're not very large. We're talking about maybe 130,000 Russian forces on the border. That sounds like a lot, but it's a long border. In the early 1943, when the Germans and Russians faced off along this essentially the same line, so it's over 1 million men. So the Russian ability to make several independent, deep attacks, I think, is quite limited. I think if they do something, they'll focus on one axis.
And what about the Ukrainians? How prepared are they? And could they expect any more, perhaps, military equipment or resources from the United States?
Well, the Ukrainians are quite prepared. Remember, they've been fighting since 2014, so they have a lot of combat experience. They're mobilizing some militias. So they're pretty good. On the other hand, their equipment is old. They don't have much of an air force or a navy, so the Russians have them overpowered in those areas. They'll probably get some equipment from the United States. We've been sending them ammunition and things like Stingers or Javelins. These are weapons that are easy to use. It only takes a couple of days to train people on them. We're not going to send them major weapon systems, like Patriot, things that would take several years to assimilate into their armed forces. And if there is a conflict, I think we'll probably send them some equipment. But under no circumstances will we send them troops.
I'm sure that's certainly very comforting for a lot of people. Now, we know that it's not just the West that's watching these developments between the Ukraine and Russia. The president of Taiwan said they empathize with Ukraine's situation, obviously given their relationship with a much larger and more dominant China. And Taiwan has actually ordered the creation of a study to see what happens with Ukraine and the reaction from allies. What are your thoughts on how those situations compare?
Well, there are some similarities and some differences also. Taiwan, of course, is very nervous about an invasion by the Chinese, just as the Russians are with Ukraine. The Chinese believe that Taiwan is part of their sovereign territory. So the Taiwanese are watching a conflict in Ukraine first to see what the Western response is, to see if they could, in fact, count on aid from the West and from the United States in particular. And I think if there is a conflict, they're going to look very carefully at the nature of the conflict and to try to learn some lessons about the nature of modern warfare. Remember, it's been really 70 years since major European powers have fought each other. So we really don't have a good sense about how these modern weapons interact and what really will be the most effective.
Certainly important to keep in mind. We do thank you for your time, Mark Kansian there, retired colonel in the U.S. Marine Corps Reserves and the Center for Strategic and International Studies Senior Advisor. Thank you so much. Brad, back to you.
All right, thanks so much, Rochelle. As COVID cases continue to decline, Walmart's signaling its return to normalcy by dropping mask policies for employees and decreasing health screenings in all but 3 states. We're going to speak with Dr. Calvin Sun, founder and CEO of the Monsoon Diaries, for his professional analysis of the broader state-by-state reduction in precautionary COVID policies. That's up next.
Welcome back. You're watching Yahoo Finance. And let's take a quick check on how COVID vaccine makers are faring today. Pfizer, Moderna, Novavax, and J&J falling today as the U.S. Food and Drug Administration delays a key meeting set for this week to discuss authorizing the Pfizer-BioNTech shot for children aged 6 months to 5 years. Pfizer's news dragging other vaccine makers down with it. Moderna taking the biggest hit, down more than 12% today so far.
All right. Thanks so much, Rochelle. We're going to continue to track and have this conversation with our next guest. As COVID cases decline, the nation's largest brick and mortar retailer and private employer, Walmart, is dropping its COVID response mask policy for employees who have received 2 doses of the Pfizer or Moderna vaccine or 1 dose of the Johnson & Johnson vaccine. To discuss the broader pullback of the pandemic precautions is Dr. Calvin Sun, the Monsoon Diaries founder and CEO, clinical assistant professor, and attending physician in emergency medicine, joining us now. And it's good to have you here with us today. With states, doctor, and private businesses such as Walmart rolling back pandemic-driven precautions, what do you believe should be the defining measure as to when and how to lift policies?
It depends on where you are and local infection rates, vaccination rates, and the culture. So if you're talking about New York City, you can literally mandate no more mandates on face coverings. And New Yorkers are going to keep their face coverings on. At the majority of places, they keep them on the streets still. You can hear people cuss people out for not wearing their face coverings, and people apologize. You know, in New York, they usually cuss back and fight back. But in this case, in New York, you can release all the mandates, and people still wear them, even indoors, outdoors, on the street, in the gyms, because that's the culture. And people feel comfortable doing that because New York is a small space. We're comfortable sharing a small space and looking out for one another because we're so used to, having to rise up from crises over and over and over again. So we're more like a team player. Most of us are fully vaccinated. The rates are going down. And yet people are still, majority-wise, are wearing face coverings in the city. Now, if you take it somewhere else in the country where the infection rates are higher and they haven't really gotten over Omicron, maybe it's not a good idea to lift those mandates yet because you're trying to meet people where they are and it's not safe for the community as a whole. So broad stuff may not be as safe as something that's a little more clinical and surgical.
So, Doctor, with all of what we've seen, and perhaps particularly from some of the healthcare experts citing the availability of vaccines and antiviral treatments, Dr. Fauci believes the timeline for fully scaled back policies is a couple months. What's your estimation for how soon we'll have a gauge of population immunity and the success or shortcomings on the other end of these rollbacks right now in policies?
I'm not one to make predictions. I'm not a betting man or a gambling person. And the best thing we know is a time machine, and someone from the future just tells us, because you never know when a new variant rolls around or we're not vaccinating as quick enough, and then a new variant from under-vaccinated population in the developing world then brings a new variant that's resistant, and then we have to start this all over again. But if things are trending the way they are, yeah, a couple of months, and I get it. People are tired, people are fatigued from this pandemic, so people are going to pull back and try to let go as quickly as possible because people want to get back to a world where we don't have to think about this and be stressed out over this, especially after the last 2 years. But it all really depends. The quicker you get everyone as vaccinated as soon as possible in the developing world, you're lowering the chances of the creation of a new variant that will then prolong this. And therefore, these predictions that Fauci or whoever makes it will then have to be scrapped because of the inflection points that we live on a daily basis in the last 2 years. The future depends on now.
On the other hand, President Biden suggesting ending the policies is premature. How critical is the messaging from the administration in correlation with healthcare experts, to give the public confidence in this strategy going forward?
I mean, we've seen it with the annoying and frustrating update that Pfizer is delaying and they requested a delay to authorize vaccination for kids under 5 because they need more data. Now, it's frustrating and annoying, but it's understandable because the reasoning behind that is nobody wants to be on the receiving end of "I told you so." They don't want to cut corners or be perceived to cut corners just in case something were to show in the future that it was not the right thing to do, and therefore giving other people the ammunition to undermine the confidence of a future vaccine that is necessary for a future pandemic that could be worse. I totally understand. I empathize with that, but it's also very frustrating. And therefore, the messaging of this back and forth and moving the goalposts is frustrating for many parents who do want to vaccinate their children. But at the same time, the understanding is they don't want to have parents or anyone that's against the vaccine to have any way to say, I told you so. It's kind of like a toxic relationship. You don't want the other person to say, yeah, I was right all along. You only give them that. And therefore, they're creating that message that's a step-by-step to be as responsible as possible to maintain the little to trust that I totally understand that we have in the messaging, especially in the last 2 years, of something that has happened for the first time in our generation.
Well, since you mentioned Pfizer retracting their vaccines for children under 5, or at least the approval process, seems that April is the earliest that we would see more data added for their submission. If approved for children under 5, do you believe it will be required, along with other shots that preschools or even daycares require in the future?
I mean, they require like I think 50 million shots when I was growing up, and I just got boosted for like half of them the last 4 or 5 years alone. So I think that it's probably going to be required for the safety of the community. That's the social contract we sign up for. You have to pay your taxes, even though you may not agree where your taxes are going to. Therefore, if you don't agree with the vaccine schedule of the children, you might as well not pay the taxes that create the vaccine schedule in the first place to protect the community as a whole. That's a social contract. So I think that I can't make a prediction. And you have to realize why they wanted to prolong that, because they wanted to wait until April. April is only 2 months from now for a disease that literally Omicron was when? A month ago. They don't even have enough data yet. All right. And then they want to make a decision based on 1 month of data from a virus that's still ongoing right now, or a variant that's going right now. I totally get it. Why they want 2 more months, so they can actually, when they authorize it, feel as confident as possible to back that up, rather than cut corners and then having the possibility of somebody else in the future to say, I told you so. And that's why we just have to wait 2 more months. Frustrating, annoying, but understandable.
You've worked throughout this pandemic, and you've traveled to different states, different countries, and prior to vaccines even being available. And so how has this informed your view of where healthcare needs to evolve, not just here in the US, but internationally, perhaps?
I think that people need to, it's the critical thinking that is required when you approach healthcare on such a broad spectrum. These general sweeping reforms and mandates are great in theory and intent, but really I think we need to think more critically on like the answer being, it depends. When you ask a question, it depends on your local rates, what the local needs are, the supply and demand of how you can treat different communities, and also communicating with different communities and their understanding of like why it's important to do something for the benefit of the whole, as well as the understanding of a social contract. You have to give up a little bit of your freedom for the security of the community, and that finding that right balance is so difficult and so nuanced that you can't really create a sweeping generalized decision for an international community. But it does require a general sweeping effort, which is not the same as a general policy, but really an effort together to figure out what's the right place, the right community. So what I'm finding is when I travel is that everyone is different. Nobody's really right or wrong, but it's really about the messaging and communicating, and also beating the demands at the time and actually adjusting for it as circumstances change, depending what the variant has hit you right now, or it will hit you later on. That all requires a lot of nuance and communication that our society, is struggling to keep up with, especially for something that happened for the first time in a generation.
Certainly. Dr. Calvin Sun, who is the Monsoon Diaries founder and CEO, clinical assistant professor, and attending physician in emergency medicine. Thanks so much for the time and insights here this afternoon. We appreciate it as always. With that, let me toss things on over to Emily.
You may have caught Coinbase's Super Bowl ad yesterday, but between the unexpected ad and the site crash on Coinbase last night, we'll break down just how much engagement that commercial spot drove for the crypto company as part of our triple play up next. Stick with us.
Welcome back to Yahoo Finance Live, everyone. It is time for our triple play of the day with 30 minutes left in today's trading session, roughly, well, actually inside of that now, just about 23 minutes left. Rochelle, Emily, and I have 3 stocks to put on your radar ahead of the close, and I suppose I'll lead us off here and begin with perhaps one of the most minimalist Super Bowl commercials that we have ever seen outside of that 1-second ad that was run a few years back, I believe 2016 or so. But Coinbase in focus here on the day, and they were up higher here. You've seen they've entered into a little bit of a hyper waffle here during the 2 p.m. hour and 3 p.m. hour, sustaining some small fractional gains of about 0.8%. And so it was just a QR code that basically just bounced around your screen similar to a screensaver. And there it is on your screen right now for those who missed it. And in one of the most significant and viral plays that we had seen in an ad yesterday, the stock was up on the day. The company had seen over 20 million plus hits on their landing page in 1 minute. Volume historic and unprecedented, as the company had said, and they saw engagement that was 6 times higher than some of their previous benchmarks. And if there's anything to take away from some of the ads that we saw yesterday, it was the overwhelming spends that came in the form of cryptocurrency services, platforms, and we'll see exactly where some of those numbers rack up as well, Emily and Rochelle, in terms of the new users that sign up for these services too.
Absolutely, Brad. And just taking a look at some of the other data that's come out now on the engagement for this Coinbase crypto ad. According to EDO data, Coinbase had the most engaging crypto ad in this year's Super Bowl and earned 8 times more engagement than the median Super Bowl ad this year. Now, of course, crypto really was in focus with a lot of the commercials. FTX had its ad with Larry David. Crypto.com had its ad with LeBron James. But according to at least EDO's roundup, Coinbase did come out on top when it came to the crypto advertisers during yesterday's game. But switching gears here, do also want to spotlight the price action that we're seeing in shares of Rivian. Now, this stock has found a major new investor in George Soros. Soros's investment fund has taken an over $1 billion stake in the electric truck company and bought nearly 20 million shares last quarter, according to some SEC filings. Now, Soros Fund Management had already seen some paper losses, at least through today's session, since the value of that stake was worth about $2 billion around the time of purchase. We've seen Rivian shares sliding for the year to date and really getting a haircut on its valuation, along with some other major growth and technology names, and especially some some loss-making rather companies in that tech and growth area. But guys, I think this news is really interesting because it came alongside disclosures of some other changes in the Soros Fund. It also reduced its holdings in Amazon and Alphabet in the fourth quarter ahead of this drawdown that we've been seeing across big tech names. And it also bought about $13.3 million worth of Peloton. So it is interesting to see where Soros and his fund perhaps saw opportunities where things were oversold. Of course, Peloton and Rivian both still coming under pressure so far for the year to date, but interesting to track some of these portfolio changes here, Rochelle.
And Emily, it's interesting. We did see that Rivian did have that rather bumpy start, sort of still having relatively low sales at the moment. And we do know that Soros was already listed as an interested investor in Rivian's November IPO. So I don't know if it's going to have the kind of boost that Rivian is hoping for, but we'll see, because we do know that Soros, he does like his EV stocks like Fisker, Proterra, and Wallbox. But as you mentioned, ditching some Amazon and Alphabet stocks, an interesting move there. So I'm going to shift gears from electric vehicles to bikes, where I'm taking a look at Peloton's president and CEO, Barry McCarthy, peddling away from some of those rumors that the company could be up for sale. So as we know, after its market value collapsed more than 80%, a lot of people were wondering, as people are coming back to work, some people are sort of giving up their Pelotons, these pandemic purchases that people made, and then sort of changed their minds about. But then we saw the stock rally again last week after reports that Nike, Amazon, and Apple and other companies were mulling some potential bids. Now, it's interesting because he was talking to the Financial Times and he said, this is Barry McCarthy saying, it's not up to him. It's not his final vote that's going to do it. It's really more about the shareholders. So giving himself some wiggle room there. But I don't think people are entirely convinced that Peloton is just going to sort of focus on long-term growth. We are seeing Peloton shares down about almost 5%, about 4.87% right now. So we'll see if everybody else is buying it as well. Guys?
And the thing is, he's couched it by saying other shareholders, and we know who the main shareholder is who has the majority of the voting power, and that's John Foley, this person, this one ex-CEO and now chair of the executive board, that person, the executive chair that you're seeing there on the screen, and John Foley having that type of voting power, of course, anything that comes across might be up for a discussion, but it's going to have to get through John Foley first. And then it's a matter of, from the board's position, how are they acting in the best interest, the fiduciary interest of the other investors, the other stakes that are out there for this name in PTON. And so with all of the changeover that's been made at the executive level, with all of the jobs as well that are going to be trimmed, it also comes at a time where this broader restructuring is going to be laser focused on by the rest of the shareholders that hold a stake in Peloton. And we'll see how quickly they're able to right the ship over there too.
Indeed, we'll have to watch this space. All right, coming up, oil prices have been climbing steadily along with the economic recovery. But with a possible Ukraine-Russia escalation, they're now near their highest level since 2014. We'll see where it's headed after the break, right here on Yahoo Finance.
Welcome back to Yahoo Finance Live, everyone. We're going to take a quick look at oil prices as we've been tracking this very closely amid the international conflict taking place between Russia and Ukraine. As we're taking a look at your screen, WTI crude oil, you're seeing that up on the day by about 1.9%. That hitting $95 a barrel. Additionally, Brent crude, that's still holding on to a $95 a barrel, $95.90 roughly. It's up right now by about 1.5%. Also want to take a look at ticker symbol RBOB, RBOB, as you are seeing that up on the day right now and holding on to gains of about 1%, up 4.3% over the past 5 days. We'll keep close tabs on this going into the close as well, everyone. For right now, let me toss things back on over to Emily.
Well, as Brad was mentioning, in energy markets, all eyes are on new developments around the conflict with Russia and Ukraine as crude oil prices hover at their highest level in 7 years. Our next guest joins us now for more. Ben Emmons is Medley Global Advisors Global Macro Strategy Managing Director. Ben, thank you so much for joining us this afternoon. We're starting to hear calls for Brent to jump even beyond $100 per barrel and potentially reaching $120. Is that your base case right now, given what's going on geopolitically?
Hi, Emily. There's certainly a geopolitical risk premium, as we say, attached to oil now, because in the event that this does lead to a real conflict, most participants in the energy markets anticipate that this will lead to major gas supply disruptions coming, particularly from Ukraine to Germany. And that is, supplying Germany with about 35% of its gas supplies. So they're going to have to get the energy from somewhere else. Now, though the US has supplied a lot of energy, a lot of gas to Germany and to Europe, it's probably not enough. And this is why that Brent contract that you're showing at the start of the segment continues to rise more. And it's pulling up also the other contract, WTI. So it's all in movement. But also highlight, though, that we're in an environment where energy demand is just significant. It's driven by this really cold air that we're having both here in the United States as some other parts of the globe, so the weather effect, but it's also that the reopening of the economies as Omicron fades is just boosting energy demand for all the travel and all the other reasons. And so it's that combination of geopolitical tension and economic factors that are driving these oil prices higher.
So in terms of the Russia-Ukraine conflict, what outcome do you think crude oil prices have priced in at these levels? Is there an invasion that's being priced in? What level of sanctions do you think markets are currently anticipating? And with that in mind, how much further upside could there potentially be if some of these outcomes aren't fully priced yet?
I find an interesting question how the crude market is exactly pricing it in, but I can definitely say that, in the financial markets, if you look at say ETFs that are tied to Russian banks and Russian energy companies, those are down 10-15%. So there's certainly an anticipation there that in the event that there will be escalation and the severe sanctions follow, that the Russian banking system will be crippled as a result. When it comes to the crude markets, yes, we could test towards this $100 a barrel. I think it's very much driven more by the demand for energy in general and just this geopolitical risk that we're dealing with. Nevertheless, the inversion that you showed, the backwardation of the gas futures in Europe, that is very severe. So it does show there's a crunch priced in that if there is any conflict that leads to naturally this disruption, also in addition that Nord Stream 2 will not go forward, right? There will be another disruption to gas supplies. And you can tell that there's a clear tension that markets anticipate that this is near, right? It could happen. So good thing was that this morning there were de-escalating headlines coming out, but we'll have to watch this. I think for now, there remains this tension in the market that we haven't seen the end of this yet. The meeting tomorrow with German Chancellor Scholz and Putin is a really key, critical meeting for what flows out of that. So everybody's watching it.
And based on the meeting, the phone call that took place between President Joe Biden and Russia's President Vladimir Putin on Saturday, Biden said that the U.S. and its allies would impose swift and severe cost on Russia in the event of a military attack in Ukraine. I'm wondering, what contours do you think any potential sanctions could potentially occur in the event of a military attack? And how would that affect not only Russia, but potentially Europe, U.S. allies, and potentially even trickle down to having an impact on the U.S. itself?
Well, the key, financial sanctions that have been out there that has really, I think, affected markets more significantly is that Russia will be turned off from the SWIFT system, right? That's the international payment system. That is unlikely to happen because that would not only affect Russia negatively, but also affect the US banking system negatively, as well as European banks. There is exposure, particularly in Europe, that have outstanding loans to Russian banks, something of the nature of about 35 billion euros or so. So I don't think that will happen, but what we can expect is export controls that's particularly towards energy related. It can also be that there's further restriction on trading Russian sovereign debt in the secondary markets. This, by the way, could then affect any broader emerging markets because they're all linked with one another. So anything that happens with Russian debt will impact, say, Brazilian debt, and as well as just general sanctions, I think, of like export and import controls for goods. That, of course, can affect the agricultural markets because Russia is a big exporter of wheat, for example, and wheat has been one of those commodities, too, has been very reacting to this conflict at this moment.
And one thing you also mentioned in your notes to us is pointing out that the energy sector in Europe has underperformed the energy sector in the US, which of course has in turn outperformed the broader S&P 500 here. Do you think this course corrects in Europe, that we see this underperformance, this relative underperformance in European energy markets really get resolved if a diplomatic resolution is found? Or are there still other structural challenges facing the European energy market that aren't present in the US?
I think the latter is definitely true, because take the gas situation that we had earlier in the fall that had nothing to do with Russia. That was really driven that there was not enough wind output in the UK, and therefore they couldn't generate enough renewable energy and had to rely on gas supplies that were no longer there. It is known that Germany shutting down its nuclear facilities also therefore drove up the demand for gas. And in the Netherlands, there is a big gas field that has also been shut down partly because of the seismic activity. So I think all of that has actually affected the energy sector in Europe more negatively, for that matter. They're more reliant now on foreign energy, either coming from the United States or coming from Russia in this case. So I think that is part of the reason why you have that gap between US and European energy equities in this case. It's the same on the credit markets. The spreads for European high yield bonds for energy are much wider than those for the US. So I think that too indicates that there is stresses here, because the demand for energy is so high as a result of just this reopening that we're continue to be in, against that geopolitical tension and conflict with Ukraine, that therefore the credit stress is building in the European energy market. So we have to carefully watch that. It could get worse.
All right, we'll leave it there for now. Something we're certainly closely watching in the near term. Ben Emmons is Medley Global Advisors Global Macro Strategy Managing Director, and we thank you so much for your time. Rochelle?
All right, thank you, Emily. Now, on the other side of the break, we'll get you up to speed on how the markets are reacting to all the day's developments, including Ukraine, as we edge ever closer to the closing bell.
Welcome back. It's our countdown to the closing bell this Monday, February 14th, and stocks are in the red for Valentine's Day. Let's head back over to Yahoo Finance's Jared Blickery for more. Jared?
How appropriate, but not fun to say this. I'll tell you what, though, NASDAQ just climbing into the green again seconds ago. You can see it dipped into the red for about an hour, hour and a half here, but back on track. The Dow also closing in on the unchanged line from Friday's settlement. And so let's take a look inside the market. And we can see here we go. Finally, some more green on the screen, reclaiming some of those losses. Apple down only 0.4% about. Alphabet up 1%. So is Tesla, Amazon, Nvidia. So clawing back some of those gains that were lost on that unfortunate announcement earlier today. Seeing consumer discretionary, that is still the leader, up 0.2% today, followed by communication services. Tech, staples, and industrials all outperforming, but still in the red here. Energy, the biggest laggard to the downside, down 2%. Financials, they are off 1%. So is healthcare. Right there with it, guys.
All right, Jared Blickery, we appreciate it. We're going to be checking back in after the close. Everyone, just minutes remaining in today's trading session, and we're seeing a little bit of a hyper oscillation on the NASDAQ. We'll keep a close eye on that. As Jared mentioned, the other two major averages in the red. We'll count you down to the closing bell on the other side of this short break.
All right, welcome back to Yahoo Finance. Edging ever closer, just seconds away from the closing bell. Right now, we're seeing the S&P and the Dow still in red territory. The Nasdaq still deciding if it wants to close in the red and join them for Valentine's Day. To break down what's been happening with the market panel, we have Nancy Daoud, Ameriprise Financial Private Wealth Advisor, and Ed Butowski, Chapwood Capital Investment Managing Partner. Thank you so much. So we're taking a look now. Still in the red for the two, but the Nasdaq still trying to hang on there.
And there you had a live look at the closing bell at the New York Stock Exchange. Major averages close and lower here on this Valentine's Day. You are seeing plenty of red, but perhaps not what the investors were looking for as a gift. Dow Jones Industrial Average right now, it closes down by about 0.5%, 172 points in the red there. The S&P 500, you're seeing some fractional declines. There is where we end the day, down by about 0.4%. We'll round that off to 17 points in the red. And the Nasdaq, it just barely ended the day in negative territory, flat just barely to the downside, not even a full point. We'll see what tomorrow's trading session brings for all three major averages, and we'll see if there is any type of buying that comes into play, especially considering the levels where we find ourselves at right now. For more on that, let's bring back in Nancy Daoud, who is the Ameriprise Financial Private Wealth Advisor, and Ed Butowski, who is the Chapwood Capital Investment Managing Partner, joining us here. And first, Nancy, I want to go to you because particularly here, as we continue to weigh the Fed and the impact right now that we're seeing play out in the markets and markets trying to price in what the Fed may do, has the Fed put itself in a position where it may have to be more aggressive earlier on in their tightening policy?
Yes, I think the market is surely reacting more so to the news of the 7.5% inflation in January, which was excessively high. But I think that was somewhat expected. I mean, it's not a button that's going to be pushed where everything is going to be smoothed out easily. It's a tough challenge for the Feds to get ahead of this inflation curve as they're trying to increase interest rates and taper. And it is very much just speculation now that Feds are going to have to become more aggressive and maybe raise interest rates a little bit higher than anticipated. Instead of 1/4 of a point, perhaps 1/2 a point, which would accelerate this whole process.
And so, Ed, with what we're tracking across equities right now, do you expect any type of inflows at the kind of price points that we're looking at across the board where, again, we've had this buy on the dip mentality before show itself strong and show up in the markets? But is that same mentality, you think, going to kind of show itself strong once again, even as we've seen this leg lower over these past few sessions?
Yeah, I will tell you, any inflows is stupid money at this point. You must be taking money out of this market. I mean, you have everything that is laid out perfectly for the market to go lower. You have higher interest rates, you have slow earnings, you have slow economic growth around the globe, and there's no good reason to see this market go higher. And we're already about 37.5% overvalued based on expected earnings growth over the next 12 months. So to me, any new inflows is really, really silly to do at this point. You're really committing, I don't want to call it financial suicide, but basically it's really not a smart move at this point.
Nancy, what do you think about that? Is cash where investors should be rotating to at this point and away from equities, or are you seeing some potential opportunities here given some of the volatility we've been seeing?
Well, there's always an opportunity. I always say that someone's misfortune is always someone else's fortune. And I think the most important factor involved is time frame. If you're in it for a short period of time, then yes, I agree with my counterpart here that you should not be getting in right now. But if you're in it for the long haul, it really doesn't matter because ultimately things correct and they get better. So I think it all has to do with your appetite for risk and your time frame. And whatever if you're already invested, I disagree that you should get out. I think you should stay the course because if you had to take any corrective action, that should have been done long before now. We all knew, these were all things that were very well known already. The Feds were going to raise interest rates. They were going to taper. We already knew all of this. It's a question of how and when and what's the collateral damage that's going to occur. But in time, the math always rules.
And Ed, given some of your concerns about where stocks may be heading in the near term for now, what do you think that catalyst to get back into the market is going to look like? What are you going to look for to say now is the time to be buying and getting back into stocks here?
Yeah, great question. Lower PE ratios. And the only way you get to a lower PE is either the P has to come down or the E has to go up. But no matter what, we always have to go back to what historically are the great metrics, and that is price earnings ratio. And you have a PE going forward of 22, 23, and where the 10-year Treasury is, which is at almost 2%, the acceptable PE in the market is 16. So you're going to have to see the prices come down because earnings are not going to go higher. And so, again, I agree with, my counterpart that this is not a great time to be getting out of the market. But if you're over allocated, which many people are, they should revert back to a lower balance of equities in their portfolio. Look at senior rate floating notes, look at business development companies, look at preferreds. Don't get completely out of the market per se, but reduce your exposure in the market. And the catalyst is going to be a lower price earnings multiple, just like it's always been. And everybody who says this time is different, it's not different. It's just not going to be different.
And I want to bring in Nancy here. Nancy, you've said that you're positive on the 2022 outlook, barring any derailment of fundamentals. But with producer price and inflation data out Tuesday and the Fed minutes out Wednesday, what signals do you think investors should be paying the most attention to?
How the Fed moves. I think if they get too aggressive and interest rates rise too fast and too much all at once, that could really shake up the market. Also, there's some geopolitical things going on too. What we thought was unlikely a week ago with the Russian invasion of Ukraine is now very likely. And that's not really going to affect us as much as Western Europe, but if it escalates into a full-blown NATO thing, which is very far-fetched right now, things could change. There's so many things going on, so many factors. Oil prices are going up. There are so many factors to consider. But being proactive is very, very important, and staying within where you should be in the first place as an investor. Trying to time the market is harder.
Indeed. And it is always a balancing act for the Fed. Ed, I want to bring you in here. We saw that St. Louis Fed President James Bullard told CNBC that the Fed's credibility is on the line in its quest to bring down inflation down from the current 40-year high of more than 7%. Is that a fair statement, given how long it took the Fed to really change its tone about how persistent inflation was going to be? And how does it get its credibility back?
Yeah, there's no question about it that the Fed is behind the curve here. I mean, you have inflation at 7.5%, and you have, the Fed funds rate, at 25 basis points, 50 basis points. It has to rise. And normally when you have, interest rates rising, it's because of a strong economy. You don't like to do it to combat inflation, but that's what they have to do. The economy is not so strong, and that's the reason why we're seeing inflationary numbers. We're seeing inflationary numbers for many other reasons, but you have to get the Fed to start moving and a lot more aggressive. As Nancy said, a 50 basis point move is probably necessary, but then a number of moves after that in order to slow the inflation down. And I agree that the Fed's reputation is at risk there, because they're always being told, we've always been told, that the Fed is there to slow the economy down when it starts to run away. But it's already running away. It's in a sprint right now, and we're falling further and further behind the longer we wait to raise rates.
Yeah, it's got strack shoes on for sure. We do know. Nancy Dawood, who is the Ameriprise Financial Private Wealth Advisor, as well as Ed Butowski, who is the Chapwood Capital Investment Management Managing Partner, joining us today with the insights and the breakdown. We appreciate the analysis here this afternoon. And for even more analysis post-session here, I want to bring back in Yahoo Finance's own Jared Blickery. Jared, I want to get your final thoughts on today's trading activity. We end lower across the board, but flat just barely to the downside on the tech-heavy NASDAQ.
Yeah, that's true. I've been watching some critical levels in the S&P 500, and we've now closed below them 2 days straight. And so I think we're going to revisit those lows and potentially punch through them. So kind of a precarious time for the markets. I do want to cover some breaking news. Monster might be tying up in an acquisition with Constellation Brands, the maker of Corona beers. Can see Monster Beverage over the last year, pretty much sideways trading action. It's at the downside of that range just now. Over the last 2 years, you can see holding on to gains of about 18%. And by the way, this is the best performing stock in the S&P 500, I think, over the last 20 years, something like that, up 36,000 from its IPO about 30 years ago. So Monster has been a great performer in the past, and we'll have to see if they can execute if they become a part of Constellation Brands. So let's take a look at Constellation Brands real quickly. Here we have it. We can see it's up about 9 basis points. So not a lot of investor reaction on this so far. We only saw the target up about 1%. But here you can see over the last 2 years, really trading sideways over the last year. So up 14% from that watermark that we saw 2 years ago. And we'll have to see if this comes to fruition. There's really not a lot of details on it. It would be a $90 billion tie-up, but no details on exactly how it would be paid for. Expectations are, based on the Bloomberg report citing unnamed sources, are that it would be consummated in the coming weeks if they go ahead with it. So a little bit of breaking news there on an otherwise not too great market day.
All right, Yahoo Finance's Jared Blickery, thank you so much for bringing us that breaking news. Coming up, sports gambling was a big feature of this year's Super Bowl, and Mattress Mac, the owner of Gallery Furniture, lost a costly bet at this year's game. We'll discuss on the other side of this break.
Welcome back to Yahoo Finance Live, everyone. Plenty of action on the Super Bowl this year with new states legalizing mobile betting, leading Mattress Mac to say, hold my beer. Yahoo Finance's David Briggs is standing by with Mattress Mac. David?
Yeah, 30 states plus DC expected to bet more than $7 billion on Sunday's Super Bowl, of course, won by the Rams. The two biggest bets in U.S. history were placed by one man, unfortunately for him, on the Bengals to win outright. Mattress Mac, nonetheless, joins us from Gallery Furniture in Houston, Texas, his store to take his lumps. Mac, it's good to see you, my friend. So tell us, you're the only man in U.S. history who can answer this question. How does it feel to lose $9.5 million on a football game? And when you do so, does your wife make you sleep on the couch, or does she change the locks entirely?
Well, I was watching the football game at Camp Hope, which is a place where they rehabilitate veterans with severe PTSD, and a lot of them were suicidal when they came in there and homeless. And as I watched that game with those brave men, who many of them had seen their friends get killed in combat, I realized that losing money on a football game was not a big deal, and it put everything in perspective for me. It took me about 1/2 of a millisecond to get over it, and my wife said she's good with it. We'll go to the next one. We put on our big boy britches, went back to work this morning.
That is some impressive perspective, Mac. So if my math is correct, though, you've now lost $15 million in the last 5 weeks when you had the Super Bowl to bets on the Patriots and Tennessee Titans, as well as Alabama to win the national championship. Yet your motto is saves you money. How much thought have you given to giving up gambling entirely?
Well, actually, these aren't gambles. These are hedges. We sell furniture. We sold if you buy a mattress Tempur-Pedic 3000 better or power reclining sofa 3000 better, then if the team from Cincinnati won the big game last night, you got your money back. So it's a hedge, and our sales went up about 300%. So I actually think we made money up for the whole thing. It'd been a lot better had we won the game and been able to give the customers their money back. But we did it. We brought in new customers that were very affluent, and they bought a lot of furniture. And even though we didn't win the bet, it was a hedge.
You said up 300%. Can you quantify what that is in sales for us?
During the promotion, we did about 20 million versus the normal 2 weeks, we'd do about 6.
So you actually came out ahead. You did more than the $9.5 million that you lost on the game.
That's right. And I came out ahead on the Alabama game as well. In addition, I get rebates from our manufacturers. For the more we sell a particular product, you get long-term product rebates. So, well, we did fine. We brought in a lot of new customers. We made a little money. We wish that we'd win every one of these hedge promotions, but sometimes you win, sometimes you lose, sometimes you get rained out. You put your head up and go to the next one.
So take me through those final 2 minutes. It looked like the Bengals are going to win this football game. Most of us were on an emotional roller coaster, and I only had $100 on the game. What were the highs and lows like?
Well, the highs and lows were terrific. I was saying some unfavorable words. My wife didn't like that. She wanted me to settle down. I had a guy with me from Bleacher Report, and she thought he was filming me, but of course he wasn't. So it was a tough time to see the Bengals lose there at the end, but give the Rams credit. They won the game, and it was a good game, tight game to the end, as I thought it would be. The Bengals had a chance and didn't quite get there, but the Bengals were 150-1 to win the Super Bowl at the front of the year, so they had a great year, and the Rams are now champions, and I salute my hats off to them.
Okay, so Mr. Mack, I got to know, what's the next big event that you are placing a wager on? Are you looking to March Madness? And if so, what are you looking at? What teams are standing out to you?
I did one last year that says if the favorite wins the Kentucky Derby, you get your money back. I think 5 out of the last 7 years, the favorite won the Kentucky Derby when it was competed on the first Saturday in May. And this year, the favorite for the Kentucky Derby is a horse named Smile Happy. I have a stallion standing at Claiborne Farms. His name is Run Happy. So hopefully I do a great big promotion that says if Smile Happy wins the Kentucky Derby this year, you get your money back.
So New York has come online. California likely in the next couple of months. I haven't heard much about Texas legalizing sports gambling. You're pretty influential in conservative circles. Have you put some pressure on the governor, on the legislature?
I would be surprised if Texas legalizes sports gambling in my lifetime. We're just not wired that way. So I'm not expecting Texas to legalize sports gambling, but Louisiana legalized online gambling and sports gambling about 3 weeks ago. So it's a whole lot easier for me to drive my car an hour and a half to Louisiana versus flying to Las Vegas or Colorado or New Jersey.
Next year, it's Chiefs, Rams, Bills, and Bengals as the favorites. Who do you like?
Well, I do a lot of future bets to try to get ahead of the game on these promotions. I bet 2,000 on the Astros last June when they were, I think, 16-1. And when they got in the World Series, I was live to win $32 million. So that hedge worked out very well. I'll probably pick a couple long shots and put a little money on them, see if they can come through. Maybe the Texans.
Maybe that. Now that's a long shot. That, Mac, would be the ultimate of long shots. If you are a betting man, do you think we'll even have a baseball season?
Yeah, I think we'll have a baseball season because some of these players, they realize they miss a year, they miss all that income. So sooner or later, they'll come to the table, and then when the owners will work it out, it may delay for a month or so. But a lot of these players are making the big bucks. They're up in years, and they know if they miss that year, they never get that money back. So sooner or later, the economics will bring everybody to the table.
Well, Yahoo Finance's David Briggs alongside Jim McIngvale, a.k.a. Mattress Mac, joining us today. We appreciate the time and discussing some of your future picks as well. We'll have to track those very closely. All right, with that, let me toss things on over to Emily.
Brad, as Mattress Mac said, sometimes you win, sometimes you lose. And coming up, we'll tell you the winners and losers of today's session in the markets. Stick with us. Welcome back. It's time now to chat some winners and losers, the time in our show when we break down the company or stock or individual who made headlines in a positive or negative way today. Now let's start with the good news, the winners. And today it's a good day to be an electric vehicle maker. EV companies are our winner in this session. Stocks including Rivian and Lucid Motors had been trending on the Yahoo Finance site and app earlier today. As we can see, shares of Rivian, Lucid, and Tesla all closing in positive territory. And yesterday there was a big showing of EV commercials at the Super Bowl. BMW, Polestar, Kia, all of these companies showing off some of their latest electric vehicles during the big game in a big shift towards EVs and away from some of the legacy combustion cars typically shown during the Super Bowl in years past. But Rochelle, it seems like the visibility of electric vehicles is only going to keep rising from here.
I mean, we certainly know that's going to be the case. Whether or not people are going to really get on board, a lot of people are really still waiting for a lot of these charging stations to become a reality. So while we're seeing all this incredible tech and all this investment, you have to wonder how much of this is going to end up being actually adopted by people. Now, I will say, in terms of my winner of the day, I made that Netflix. And that's because we've seen that its documentary called The Tinder Swindler has really drawn a lot more attention to some of these romance scams. We're going to have more on that coming up in the show. But basically, Tinder Swindler is about a man who romanced people out of about $10 million worth of their goods and services. It's really put these scams front and center to the point where the FBI said just in the Bay Area, around 64 million was lost to romance scams in 2021 alone. That's almost double the previous year. And what's interesting is that crypto is a large part of that increase. A lot of people on dating websites now saying, asking people if they're into crypto. So the winner is Netflix for really drawing attention to something that's clearly quite prevalent.
Yeah, and thinking through Netflix and how important these titles are, especially if they are able to get some type of virality around them too, and create that social fanfare that, if you will, can contribute to some of the uptick in either returning subscribers or net new subscribers. That's so important for Netflix because of where they've already signaled their forecast to be, decelerating growth. And so with that in mind, I think investors are looking across these titles to try and understand exactly where, not just how they can bring customers and new subscribers to the platform, but how they can maintain them, continue to monetize them beyond the entertainment and content in itself, but how that can, like a Stranger Things, and this is perhaps the only addition that they've been able to do, or title that they've been able to do merchandising, that they've been able to create that into other gaming and other content opportunities as well. And so it comes down to the documentaries. Sure, that gets people on the platform and on the premise, but where can you additionally make sure that the monetization of these titles comes forward in the future? And I think that's something investors are going to want to hear about, in addition to the net new ads, so that customers and subscribers don't feel like they're getting swindled at the end of the day too. But we got to talk about our loser on the day here, because one thing in particular that we do know is BlockFi and the newest fine that has come forward, especially at the time where this company has been anticipated to go public in 2022. Any type of fine to this magnitude, $100 million, that is extremely significant for a company in trying to prove, a company that's trying to prove their model, that's trying to prove their operations and the legitimacy of their services. And this particular fine, I think, is one for investors to take a look at to see what the allegations have been and where BlockFi is answering for some of those allegations, as revealed in this fine as well that's come forward.
Absolutely, Brad. And at the center of this fine here is the fact that BlockFi, according to the SEC, did not register the offers and sales of its crypto interest accounts. And with those, investors had been loaning their crypto assets to BlockFi in exchange for monthly interest payments. BlockFi, in turn, was using these assets to make loans to other borrowers. So at the center of the concern here for both the SEC and the consortium of states who are also going to be receiving some of this fine from BlockFi is the fact that there hadn't been an official registration from the company in regards to some of these financial instruments. So something definitely to keep an eye on here as we continue to watch the crypto regulatory front and the SEC, Gary Gensler, of course, really cracking down and enforcing some of these concerns around some of the biggest crypto players.
Well, certainly a lot to watch. So we know that crypto, it's always a lot of volatility, always a lot of things to keep an eye on. Thank you, guys. All right, coming up, feeling the hangover from Super Bowl Sunday. With millions spent in ads, we'll take a look at the biggest winners and losers. Was it money well spent? See if you agree after the break.
Welcome back to Yahoo Finance Live, everyone. Major averages and markets closed here today, and it ended on a down note, just barely for the NASDAQ, the tech-heavy average, which was oscillating in and out of gains and losses going into the close. That closed lower by not even a full point, so we'll keep tabs on that one going into tomorrow's trading session to see where the futures point as well. The Dow Jones Industrial Average, though, that closed down by about 0.5%, 171 points in negative territory. And also rounding out this down day was the S&P 500. That was lower by about 0.4%, just about 16, 17 points to the downside there. With that, let me toss things on over to Emily.
Well, this year's Super Bowl was paired with, as usual, some supersized spending on ad spots. There was humor, there were celebrities, there was crypto, and in some cases, there were shots fired at competitors. For a breakdown of the winners and losers from this year's Super Bowl, we're welcoming in Kevin Krim, CEO and president of the data analytics firm EDO. Kevin, according to EDO's data, it was the Polestar commercial that earned the top spot overall by viewer engagement yesterday. There were some pretty pointed jabs at Tesla and Volkswagen embedded in that ad. What do you think worked about this and some of the others that saw the highest engagement based on your data?
Thanks, Emily. What we see at EDO, and we've measured 200 million ad airings on TV since 2015, and we've done 7 Super Bowls now. What we see is that the right kind of Super Bowl ad has a flashy new product or brand introduction. A product launch is great. And Polestar certainly did that. No one in the country knew Polestar except maybe some auto industry insiders. Second key thing in a Super Bowl ad is that you need to be executing a really good creative idea. And the Polestar spot was stark, striking, beautiful, and very well done. And then the third is that you need to have some kind of authentic celebrity message. And in this case, they poked that rule in the eye and instead took shots at their celebrity competitors, if you will, in Tesla and Volkswagen Audi.
Well, then on the flip side, some of the top 5 worst by overall for viewer engagement, when you think about the Super Bowl ads from yesterday, Gillette, Intuit, Crypto.com, they actually featured LeBron James when you think about the celebrity spotlight there. What do you think potentially didn't work as well with these ads, and what do you think could have been course corrected?
What I would advise these kind of brands is to focus on the right kind of message for their audience and use celebrity in a very authentic way. I think crypto looks at their sponsorship of what used to be called the Staples Center, the home of the Lakers, and thought LeBron is a natural fit. But we didn't see that perform. In another case, we saw LeBron in a tonal ad last fall in a bunch of NBA games, which absolutely crushed it in our data. We saw that people responded with immediate actions, searching for tonal, engaging with tonal online in the minutes following those LeBron airings. So I think the difference between a tonal ad for LeBron and a crypto ad with LeBron in it is a big difference.
And then one ad that we certainly have to talk about is the Coinbase QR code ad and the fact that the site crashed because of the traffic that ensued just following that airing. I'm wondering, do you think that negatively impacted the company and the type of engagement that it got in the aftermath of that ad? Or was the buzziness, the virality factor of that still enough to make that crash just a blip on the radar?
Let's talk about how that ad worked out. It was a clever use of a reference to a famous Office episode with the DVD kind of logo bouncing behind Michael, the lead character. And I think it's kind of a test of when you were born, whether you knew what that QR code was doing on the screen. I think anyone a little older than I am looked at that and thought their TV was broken, and then anyone younger recognized it for what it was and thought it was clever and fun. And then at the end, if you didn't know what it was, they did tell you that this was paid for by Crypto.com in a kind of retro way. And so we saw a burst of search activity from that ad, even though a number of people were also just going straight to Crypto.com through the QR code. And I think, a temporary site crash is not going to be a huge deal. People are going to stick with it, refresh it a few times, and get through. If it had lasted much longer, I think it would have been a real negative for Coinbase.
And I'm wondering too, another theme that really came up quite a few times over the course of the Super Bowl and the commercials that ensued were a lot of these reopening themed ads between the likes of Planet Fitness and Booking.com commercials. I'm wondering, how do you think the ads and the stories and the companies that actually advertise at the Super Bowl perhaps hold a mirror to what we're seeing right now in society and potentially pave the way for the ads and the trends that we may see going forward for the rest of the year?
Well, what we saw is, I mean, it was a sign of the times. The only ad that referenced COVID that we saw was Q, the home testing platform, which, by the way, was our number 2 most engaging ad of the whole Super Bowl. But the rest of the ads, we saw a striking tone of humor, lightheartedness, fun, and those worked. We also saw themes of electric vehicles, travel being back in a big way for the first time in a long time. Those are all positives for what we think, where we think we are as a society.
All right, we'll leave it there for now. Kevin Krim is CEO and president of the data analytics firm EDO. And we thank you so much for your time and insight this afternoon. Rochelle?
All right, thank you, Emily. Now, staying in this Super Bowl range, we know that the LA Rams are continuing their victory lap. Now, some brands, though, featured during the Super Bowl are doing the same both on and off the field. To break that down for us, let's bring in Dan Kalpin, Hive Enterprise AI's president. Thank you for joining us today. So we see that a study released today by Elevate Sports Ventures and Hive Enterprise AI showed that the Super Bowl 56 telecast generates $170 million in equivalent media value for in-game sponsors. Break down how that gets calculated.
Yeah, well, thanks so much for having me, Rochelle. So much of the water cooler conversation talks about what Kevin just hit on, which is the commercials. But for the brands who are in those games, they know that commercials are only a part of the story. And as you mentioned, we found more than $170 million of equivalent media value from the brands that were exposed within the content, excluding the commercials. And there's never really been a reliable and scalable way to measure that, but it's a tremendous amount of brand exposure to be around the content for as much duration as these brands do. And so at Hive, we built a platform that provides always-on measurement of brand exposure in content every second of every program from every network every day. And we can use that to understand what happens in between commercial breaks with the programming itself.
And it's interesting because a lot of times these things wash over us, but it's verbal and it's visual. So break down the value of the brands that did well in terms of time on screen versus some of these verbal mentions, and which strategy tends to be more effective.
Yeah, it's a great question, but if you think of the challenge of a commercial, you're trying to time that 30 or 60 seconds of exposure for when someone will engage. And some, like the Coinbase ad, will break through. Other ones you might laugh, but you forget which brand it's associated with. I think what's really powerful about some of these endemic integrations, if you think of Bose on headphones of coaches, you're exposed to that. Yesterday, they were on screen for more than 8 minutes during that game, the second most exposed brand. And you might not actively be thinking about that every single time that you see a coach. But when you go in to purchase a new set of headphones, you're going to make that association of if it's good enough for the NFL, it's probably good enough to be in my consideration set. And I think that's the power of association that brands can have with live sports, and especially the NFL.
And as you mentioned, when your eyes are already on the screen, you really can't miss some of these league sideline sponsorships or things like the headphones on the coaches. How lucrative are they compared to the investment that goes into them?
Yeah, well, it's a great question. Probably the extreme example of that, where there was a lot of attention this week, was with SoFi, which is the stadium naming rights holder for the Rams Stadium in Los Angeles, and they made headlines with I think it was $625 million naming rights contract over a 20-year period. And obviously a tentpole event like the Super Bowl is a big piece of that value. And I think the challenge historically for brands has been that, unlike commercials where there's been measurement of ad spend and ad airings and ad mix for decades, there's really never been a way of having always on measure of brand exposure. And so typically this is done very ad hoc, what we call whistle to whistle, which is games only, and ignoring everything else that happens on TV. And one of the things we found actually looking at last year's Super Bowl game is that for every minute that the top sponsors, like those sideline sponsors or like SoFi as a naming rights sponsor, earned exposure within the game, there was another 3.5 to 4.5 minutes of exposure that they'll get that night and today, appearing on SportsCenter. Even the clips that you're just showing in the background are providing more exposure for those brands, and frankly, more reach to people who may or may not have actually watched the game itself.
So then talk about a few of the biggest brand winners of the day. What did they get right, and how were they able to parlay their strategy into these millions of dollars in media value?
Yeah, it's a great question. I think, unlike on the field where there's only one winner, for brands, there's lots of folks who can claim victory, and there's different ways that people get there. Nike was the most exposed brand within the game, had a staggering more than 46 minutes of total exposure, where pretty much anytime you saw a player, you saw a swoosh. And so for them, it was really just that very passive exposure of being really active in the content. For other brands, I mentioned Bose earlier. Gatorade was the third most exposed brand, and both of those are very much being used by players or by coaches. And so again, able to make that association of not just being in the background, but actually being a part of the story, even if it's maybe one step removed from the field of play. And then I think similarly on verbal mentions, when you can put those two things together the way that broadcast partners do, of having a mention to something like the Pepsi halftime show, as well as that signage, just creates that drumbeat of awareness for a brand.
We'll certainly see how that lingers in the mind of consumers going forward. Thank you so much, Dan Kalpin, there, Hive Enterprise AI's president. Thank you so much. All right, coming up, bad romance, the rise of suitors who are after more than just your heart. They might be after your hard-earned cash. A Valentine's Day to remember on the other side of this break with Yahoo Finance.
For joining.
All right, welcome back to Yahoo Finance Live. Of course, it's Valentine's Day, but all may not be as it seems. We're going to be taking a look at some interesting topics to do with Valentine's Day, but you might want to hold on to your wallet. For that, I want to bring in Yahoo Finance's own Alexandra Canal. Alex?
Thank you, Rochelle. That's right. The FTC says that romance scams soared 80% in 2021 with more than $500 million stolen. Joining us now to discuss is someone who knows a thing or two about scams, the host and executive producer of MTV's Catfish, Nev Schulman. Nev, thank you so much for joining us. You've partnered with payment platform Zelle to help educate people about this problem. First, can you define what exactly a romance scam is? And what are the signs that consumers should be looking out for when it comes to these scams?
Yeah, well, first of all, thanks for having me. And I am very excited about my partnership with Zelle because, as you've mentioned a moment ago, over $500 million were attributed to romance scams just in the last year alone. And essentially, a romance scam is something that someone does. They go onto the internet, often either dating platforms or even just Facebook profiles. They'll make connection with people, lead them to believe that they're very interested in them, falling in love with them, planning on being with them, flying to meet them or wherever it might be. And then over the course of months, gain their trust, leading up to some, emergency or issue wherein they need money to be sent to them so they can, finally fulfill their dream to come and be with you. And essentially people will send the money thinking that this is someone that they know and trust, only to then find out that it's someone who was essentially just using them to scam them for cash.
And are there any telltale signs when it comes to, a romance scam that people can really see and know, oh, maybe I shouldn't be sending money to this person?
Well, from my experience of over the last 10 years making Catfish, one example I would use as a red flag is if the person can't physically present themselves or isn't able to meet up with you in person. Now, that's obviously always a red flag, but it doesn't mean that you can't get scammed in person too. So I don't want people to think that just because, someone is actually taking them out to dinner, that they're not necessarily buttering them up to eventually take advantage of them. But that said, I do think that there have been some themes we've seen. The military is a cloak that a lot of these scammers use. They say they're overseas on deployed on some mission, and they can't talk about it because it's sort of secretive. So that gives them an excuse not to have to actually provide any details to where they are and how long they'll be there. And again, anytime someone seems to have a sequence or series of issues, emergencies that are generally either health or automobile related, whether it's, oh my God, my car keeps breaking down, or, oh, someone in my family is sick now in the hospital or had a heart attack, or, I hate to tell people to be somewhat distrustful of these things, but the reality is, you just have to always keep a little bit of curiosity and skepticism in order to avoid getting taken advantage of.
Netflix says the Tinder swindler has been making waves, putting daters on high alert. Also, clickbait, which I just watched recently, blew my mind. How important do you think it is to have mainstream pieces of content, MTV's Catfish included, to really show people how easy this is?
Yeah, I think, we've been making Catfish now for 10 years. So the fact that pretty much everyone knows that the show exists and or has seen it, and yet they're still vulnerable to getting catfished themselves, sort of just proves that the heart wants what it wants, and the brain is willing to ignore red flags, even if they're as obvious as can be. And I think, continuing to do partnerships like this, making content for the millions of people who start, their online banking and romance lives every day, just to help inform them and show them that there are things to look out for, and start a conversation so that hopefully they don't feel embarrassed talking about it if they're in a situation that feels, a little fishy.
Another scammer trend that caught my eye revolves around crypto. The FBI actually seeing an increase in romance scammers persuading individuals to send money to invest or trade cryptocurrency. What have you seen on that front, and how do you think crypto will play a larger role in criminal activity moving forward?
Yeah, well, one thing, I don't know a lot about specifically crypto, but it brings up a good point, which is urgency, right? One of the things that I've been working with Zelle to sort of get people more aware of is anytime you're feel pressured into making any kind of financial exchange, whether it's with someone you think you're in love with or someone who's presenting a really great, very timely investment opportunity. That's also something you should always look out for, because sure, you might think, oh, I have till the end of the day or even in the end of the week to send this money because I've got this great opportunity at this crypto deal before the price skyrockets. And yes, those opportunities will come around, but just taking your time, making sure you really back check and background check people and or businesses or opportunities is going to save you a lot of money in the long run.
And the latest season of Catfish kicked off last month on MTV. Like you said, you've been doing this a long time. How have you seen online fraud evolve over the years, especially with the rise of social media and digital technology as well?
Yeah, I mean, obviously technology is both helpful and harmful to fraud. The more tools criminals have at their fingertips to deceive, whether it's filters or voice changes, or the ability to create new fake numbers easily to pretend as though you're in a different place, the harder it becomes to discern what is real and what's fake. The good news is there's equally more tools on the sort of victim side, if you will. And I think just encouraging people, even though no one wants to spend money to sort of vet something, there are a lot of ways you can do it. Yeah, but I'm talking to them. Anyway, there's lots of things you can do. And some of these websites you have to pay, $15 or $20 to subscribe to run some photos or run some numbers, but it's worth it if you think about the sort of investment in the long term.
All right, some good advice. Neve Schulman, the host and executive producer of MTV's Catfish, along with your adorable son. I love that we had a little video bomb there. That's amazing. Thank you again for joining us.
All right, thanks so much, guys.
Lay down.
All right. Thanks so much, Ali, with that interview and a surprise guest appearance there. You guys, coming up on the other side of this short break, we've got the #1 story from you for you on Yahoo. Sorry, I got thrown off by The Rock just popping up on screen there. But good thing is, it has a lot to do with The Rock. Stay tuned. And on the other side, you're going to find out why.
Before we say goodbye, we want to put a spotlight on the #1 story on Yahoo Finance today. Now, it's a story our own reporter and anchor Brian Sozzi published earlier today, and the title says it all: what the Rock's arms and the S&P 500 all have in common. And yes, that is Dwayne "The Rock" Johnson he is referring to. And according to Brian, it's the fact that both the Super Bowl halftime show performers' arms and S&P 500 valuations are, to quote Brian Sozzi, huge. But guys, in all seriousness, given valuation concerns, we have started to see some major Wall Street strategists cut their year-end price targets on the S&P 500. So the Rock's arms may not be shrinking in the near term, but maybe the S&P 500 valuations will be. What do you think, Brad?
Well, there's a few ways to look at this, right? Because of all the brands that The Rock is attached to, or Dwayne Johnson, as he's probably known by his family. But at the end of the day, you look at the S&P 500, and we're taking a look at the past 5 years, up 88%, and here today closed down by about 0.4% after, of course, that Super Bowl intro that was so amazingly rendered by The Rock on the field right before the game started. But I also think about some of those other brands, not just Terramana Tequila, but a publicly traded company in Under Armour. Now, it's interesting because they've got a significant relationship, The Rock and Under Armour. He's got his own apparel line. Perhaps they'll be looking to extend that even further and make sure that The Rock is prioritized. But this is also a brand that also has athletes like Steph Curry, like Jordan Spieth. In fact, there was 1 year where all of their major athletes had won a championship or a Grand Slam. I believe back then they had Sloane Stephens that was on their roster. And you think back to that year and the performance, and it did not match up. It did not equate. It was a heavy investment year for the company, trying to get more of that saturation overseas as well. And so with the domestic and international revenues that they are seeing to this point, I think it's critical for Under Armour to monetize partnerships with people like The Rock even further, leaning into, of course, some of the lines that have done well in footwear and apparel. But we'll see where Dwayne The Rock Johnson will have a little bit more say over his brand in annexation to some of the other brands that he works with.
And Brad and Emily, it's really not surprising. Obviously, if you have The Rock anywhere, you're probably going to get a lot of traction. I'm sure a lot of people are very curious about what The Rock had to do with markets. So obviously combining that, I love it. Yahoo Finance's Brian Sozzi there comparing this to the overheated S&P valuations. Now, obviously, as we know, only one of those things you want to see get smaller, and it's certainly not The Rock's biceps. But you raise an interesting point about this very overheated market, even with a lot of these concerns, things paring back due to inflation concerns, what's happening in the Ukraine and Russia. People are still wondering, once that passes, will markets be back up again? Will some of these valuations be going through the roof? It'll be interesting to see what happens, especially after this initial concern over conflict in Ukraine perhaps dies down. Inflation, though, however, is likely to be lingering for a lot longer. So we'll have to see what happens with those valuations after that. Guys?
Absolutely, Rochelle. And just bringing it back and sticking with the topic of the markets here and those valuations. Again, we are starting to see some of those major Wall Street strategists cutting their price targets here. Goldman Sachs' chief U.S. equity strategist David Kostin just slashed his 2022 year-end S&P 500 target to 4,900 from 5,100 previously. Now, again, that does still imply upside from where markets are currently trading. As we can see here, the S&P 500 closing out today's session at about 4,400. But as many of the strategists that we've been talking to here on Yahoo Finance have been talking about, there is likely more chop in the months ahead, likely more volatility as we continue to chart the path forward, both on the geopolitical front with Russia, Ukraine, as well as what the Fed may do next in terms of monetary policy. But that is going to do it for Rochelle Akufo, Brad Smith, and me this Monday, February 14th. We'll be back at 3 p.m. Eastern tomorrow afternoon. Yahoo Finance will be back at 9 a.m. tomorrow morning. Tune back in then. But till then, have a great night.